Without objection, the committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. Without objection, all members shall have 5 legislative days within which to submit additional materials to the chair for inclusion in the record. A quorum being present, we'll now proceed to today's business. Since we don't have votes today, we're going to just as expeditiously as possible work to complete our debate, and if we need to, we can recess briefly along the way, and we'll reconvene for recorded votes. But we'll proceed until we finish today's work. Let me recognize myself for an opening statement. Good morning. Since we kicked off the 119th Congress, our members have been hard at work crafting legislative solutions to difficult problems. Today, we will consider several bills to promote financial innovation and expand access to financial services. 3 of these bills are part of our ongoing effort to promote financial innovation through sound digital asset policy, while the other 2 seek to enhance access to credit by removing compliance burdens and fostering greater competition through new bank formations. Payment stablecoins present a new and flexible payment innovation. This largely frictionless finance will simplify the ability to move money around the world in an instant. But as with all new technologies, new and difficult risks can emerge. In this committee, we have openly discussed the potential risks surrounding digital assets. Members in this room, on both sides of the aisle, have now spent years collaborating on stablecoin legislation, including leadership under Ranking Member Waters, both as ranking member and as chair. We've all come to the important conclusion: innovation needs guardrails, not roadblocks. The Stable Act, championed by Subcommittee Chair Brian Stile, is just that. To date, state regulation has allowed stablecoin ecosystem to develop in the United States, but for payment stablecoins to reach their full potential, a clear federal framework must be an option. Moreover, several foreign jurisdictions have established or are developing regulatory frameworks for payment stablecoins, making the enactment of a U.S. framework essential for our global competitiveness. Blockchain technology continues to transform the way money moves. The fact is, policymakers, regulators, and law enforcement must keep up with these changes. Representatives Nunn and Himes' leadership on the Financial Technology Protection Act will ensure that government is informed, equipped, and coordinated on emerging financial technologies. The working group established under the bill will bring law enforcement and firms in the digital asset ecosystem together to come up with ideas to improve anti-money laundering, counterterrorism, and countering other illicit financing efforts. Committee Republicans have been clear. Digital asset policies must promote private sector innovation and foster competition to ensure the United States remains the world's leader in global payments. The Federal Reserve cannot issue a digital currency without congressional authority. Majority Whip Emmer's Anti-CBDC Surveillance Act represents years of work and ensures that Americans' financial privacy by prohibiting the Federal Reserve from issuing a CBDC without explicit congressional authorization. In this committee, we are committed to increasing access to financial services for small businesses, consumers, and households. Small Business Committee Chair Roger Williams' 1071 repeal to Protect Small Business Lending Act is crucial to ensure that small businesses have access to competitive, cost-effective credit from their local financial institutions. Importantly, Financial Institutions Subcommittee Chair Andy Barr's Promoting New Bank Formation Act creates a phase-in period for de novo financial institutions to meet capital standards, helping to promote in a prudential manner new entrants to serve growing communities. The reality is that small financial institutions have struggled mightily under an increasingly heavy regulatory burden since the 1990s. Allowing new bank entrepreneurs time and flexibility to open their doors will boost competition and expand access to credit for the financially vulnerable Americans and our communities. I look forward to the discussion today. I thank members on both sides of the aisle for their work on these important pieces of legislation, and I yield back. I now recognize the ranking member for an opening statement.
Thank you very much, Mr. Chairman. When I was chair of this committee, I launched the congressional effort to create a federal framework around stablecoins. I wanted robust protections, especially in the wake of major crypto scams that robbed investors of their life savings. After years of hard work, Farmer McHenry and I came to a bipartisan agreement. While not perfect, was a great step in that direction. And Mr. Chairman, I think you worked also with Mr. McHenry to come to where we had decided we could agree on a number of things. But things have changed. Since last Congress, President Trump has come into office and leveraged the power of the presidency to establish multiple crypto schemes to enrich himself and his family, from a fraudulent meme coin, which collectively lost his investors $2 billion, while him and his family pocketed $350 million, to a crypto reserve that boosts the price of crypto held by him and his cabinet, to most recently launching, in the middle of our negotiation, his own stablecoin through World Liberty Financial. It's a display of greed. So, Mr. Chairman, I attempted to talk to you last week, and what I really wanted was that we could agree that we not pass a bill that legitimizes what is a blatant greed and corruption. And I wanted you to work with me, and I wanted inserted language into the bill that we could move forward, but would prevent the president from using this legislation to unjustly enrich himself. We could not come to an agreement on that. With this stablecoin bill, this committee is setting an unacceptable and dangerous precedent, validating the president and his insiders' efforts to write rules of the road that will enrich themselves at the expense of everyone else. And I understand that you were heard at some point to say that Trump's entanglement make this work quite more difficult. But Mr. Chairman, that is hands down the understatement of the year. Trump likely wants the entire government to use stablecoins, from payments made by the Department of Housing and Urban Development to Social Security payments to paying taxes. And which coin do you think Trump would replace the dollar with? His own, of course. But Trump, despite the fact that this absolutely harms this bill, there are some other things that I don't really agree with, and I was hoping that we may be able to work out some of these things with amendments. But if we go forward with this bill, knowing the President of the United States of America and his wife have already created their meme coins, and now in the middle of the work that we're trying to do, where you and Mr. McHenry and I have put forth such an effort, if he's not blocked from owning a stable coin bill, I cannot go any further with any amendments to try and agree on some of the other things that I have some problems with. But because of the work that we have done for so long, I'm trying, and I've tried very hard to come to some agreements. And I thought maybe with some amendments for those things I still worry about, we could come to some agreements. But if there is no effort to block the President of the United States of America from owning his stablecoin business, just as he owns crypto, which is his largest asset now, I will never be able to agree on supporting this bill, and I would ask other members not to be enablers, allowing the President of the United States to get away with this. I yield back.
The gentlewoman yields back. Pursuant to notice I call up H.R. 2392, the Stablecoin Transparency and Accountability for a Better Ledger Economy, the Stable Act of 2025, introduced by the gentleman from Wisconsin, Mr. Stile. The clerk will report the bill, copies of which were distributed in advance.
H.R. 2392, to provide the regulation of payment stablecoins and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. For what purpose does the gentleman from Wisconsin seek recognition?
Mr. Chairman, I have an amendment in the nature of a substitute at the desk.
The gentleman has an amendment in the nature of substitute, copies of which have been distributed in advance. The clerk will report this amendment.
An amendment in the nature of a substitute to H.R. 2392, offered by Mr. Stile of Wisconsin.
Without objection, the amendment in the nature of a substitute is considered read and will serve as the base text for purposes of an amendment. The gentleman from Wisconsin is recognized for 5 minutes in support of his amendment.
Thank you very much, Mr. Chairman. Thank you for holding today's markup. I'm proud to support my bill, the Stable Act, which will shape the future of digital asset regulation and protect the integrity of our financial system. The bill establishes a comprehensive framework for the issuance and operation of dollar-denominated payment stablecoins in the United States. We're living in the golden age of digital assets. The rise of blockchain technology and cryptocurrencies has revolutionized our approach to financial systems, payments, investments, and the internet. Stablecoins, digital currencies pegged to stable assets like the US dollar, are already giving rise to innovation across industries, cementing the US dollar as the world's reserve currency. They allow American manufacturers to export products abroad easily and receive payments backed by the US dollar, allow contractors at home to send payments faster and cheaper, encourage entrepreneurs in other nations to conduct business with the backing of the US dollar. They're positive developments making money movement fast, inexpensive, and secure. However, with innovation comes responsibility. We must ensure that as we embrace these advancements, we also establish the necessary safeguards to protect consumers, maintain trust, and ensure the integrity of our financial systems. The Stable Act provides the oversight needed to foster innovation, giving businesses the regulatory clarity they need to continue developing secure and effective digital payment solutions. This legislation is a foundational step towards securing the future of financial payments in the United States and solidifying the dollar's continued dominance as a world reserve currency. The Stable Act is the result of extensive collaboration between members of this committee, financial sector stakeholders, and the administration, crafting legislation that is forward-thinking, pragmatic, and designed to protect consumers while fostering innovation. The absence of consistent federal regulation for stablecoins has led to uncertainty and risk for both consumers and businesses. Issuers currently face a fragmented regulatory environment, making compliance difficult. The Stable Act creates a clear regulatory framework for stablecoins, with strict requirements for reserves, transparency, and compliance with anti-money laundering laws. It ensures that issuers are licensed, supervised, and held to robust standards of enforcement. While creating a nationwide framework, the bill also preserves the important role of state oversight, balancing both state and federal authority. As digital payments and stablecoins continue to grow, the Stable Act provides businesses, consumers, and investors with the certainty that they need to engage with emerging technologies. It ensures the U.S. financial system remains secure, competitive, and adaptable in a rapidly changing global landscape. I urge my colleagues to support this legislation as we work to empower innovators and protect consumers in today's rapidly evolving digital economy. Thank you, Mr. Chairman, and I yield back.
The gentleman yields back. Is there anyone seeking recognition to speak on this amendment in the nature of a substitute? He's not here. Gentleman from Nebraska is recognized. Mr. Flood.
Thank you, Mr. Chairman. My interest in stablecoins in the committee from the beginning has largely focused on protecting the state pathway. In 2021, I wrote and passed legislation that allows state-chartered banks to custody digital assets and creates a pathway for those institutions to issue stablecoins. The Nebraska Department of Banking and Finance immediately got to work implementing the bill and drawing up regulations, and this year, we have our state's first preliminary approval for a digital asset depository institution. Our state has done the work on this issue, and I suspect we'll see other states follow the lead of states like Nebraska and Wyoming. States are often described as laboratories of democracy, but they are laboratories of innovation as well. State regulators want to build an understanding of the entities in their jurisdiction and have an interest in regulating them appropriately based upon their unique characteristics. State banking regulators are already doing this work. They supervise state chartered banks across the country with billions in assets. I have been working closely with the chairman and his staff to ensure that Nebraska, through the Nebraska Digital Asset Depository institutions, would receive an opportunity to engage in stablecoin activities. This bill includes language giving Nebraska state charters a fighting chance. As long as the state regulatory regime meets the robust federal floor set out by legislation, this bill gives state chartered banks a state pathway that would allow them to participate in the stablecoin market and issue stablecoins wherever their customers are without the need for another set of licenses for issuance. That change is extremely important, both to Nebraska and any other state that sets up a state regulatory regime for stablecoins. And I'm very grateful to the chairman and his staff for working with us on that change. There are some details of how the state pathway would operate in practice that still need to be worked out, and I look forward to continuing to work with the chairman and the subcommittee chairman style on those items as we move towards the floor and final passage. That being said, I'm happy to support this bill and continue the committee's work to advance stablecoin legislation.
Go ahead, yeah.
Stablecoins have the ability to greatly increase the speed of payments and settlements and to make our economic system even more efficient. Stablecoins will also support the advancement of the U.S. dollar around the globe. If we allow other countries to fill the void before the United States is able to put together a robust stablecoin regime, we will regret it when the transactions around the world are done with currencies from geopolitical adversaries like China. Passage of a stablecoins bill is critical for both innovation in this country and to preserve and protect dollar dominance across the globe. With that, I urge my colleagues to support the Stable Act, and I yield back.
Gentleman yields back who seeks recognition. Chair recognizes the ranking member for 5 minutes.
I move to strike the last word.
Gentlewoman's recognized.
On March 25th, 2025, World Liberty Financial publicly launched a dollar-pegged stablecoin at the DC Blockchain Summit. Donald Trump Jr. was connected to the summit via video to cheerlead the launch of the stablecoin, which is called USD1. I'm deeply concerned that the president launched his own stablecoin exactly a week prior to this markup. I negotiated with my colleagues across the aisle for the past 3 years to create a safe regulatory framework for stablecoins. Now, we are pushing legislation through as quickly as possible without considering some of the key issues that will impact American investors and consumers. First, there is a very pressing conflicts of interest issue here. World Liberty Financial is backed by the Trump family, and Eric Trump is a manager on the board of managers of World Liberty Financial Holding LLC, the entity that holds the only member interest in the World Liberty Financial. President Trump's picture is also prominently featured on the World Liberty Financial website. Additionally, Commerce Secretary Ludnick is the former chairman and CEO of Cantor Fitzgerald, the primary custodian of Tether. While Ludnick stepped down, his son, Brandon Ludnick, is now chairman. There are just clear conflicts of interest here, which should be concerning to members on both sides of the aisle. There is also no separation of banking and commerce in the current bill. Without that separation, commercial companies like Walmart, Amazon, Facebook could all launch their own stablecoin. Our very own co-president, your very own co-president, Elon Musk, could also launch his own stablecoin on X under this bill. Additionally, the bill does not adequately address national security concerns. I recognize there is an 18-month prohibition on custodial intermediaries offering or selling payment stablecoins in the United States unless the payment stablecoin is issued by a permitted payment stablecoin issuer. This is a step toward addressing our tether concerns, but practically will not be effective. That is because there are no criminal penalties or enforcement mechanisms to hold violators accountable. To make matters worse, this bill lacks many of the consumer protections that Chair McHenry and I worked on to ensure customers could hold payment stablecoins confidentially. The bill does not include any oversight or consequences to entities that harm consumers. However, the Federal Reserve does not have any authority over state-regulated digital wallets that consumers use to hold of their stablecoins. This leaves American consumers who use those wallets vulnerable. And what if a stablecoin issuer fails? The bill does nothing to set up a resolution regime to protect consumers in that event. If we want to preserve the power of the U.S. dollar, this is not the way to do so. There will be serious consequences to the American economy if, in fact, stablecoin issuer fails, and the bill does nothing to stop taxpayer dollars from being used for a stablecoin bailout. We need the proper guardrails to protect the American people. Without those guardrails, we expose our economy to a potential crypto collapse while Trump's billionaire cabinet remains unaffected. Moreover, there is nothing stopping President Trump from forcing the American people to use his own stablecoin, USD1. USD1 could be the way Americans receive their tax returns and their Social Security checks if they receive them at all. USD1 could be used for housing grants, forcing local governments and suppliers to use the token for their critical housing projects. It is not a coincidence that Russia elites have used digital assets, particularly U.S. dollars-backed stablecoins, to evade U.S. and international sanctions. This evasion enriches themselves and Putin. Does that sound familiar? We must first address these issues before we can move forward with stablecoin legislation. Mr. Chairman, I still think we can work out some of the issues. They could get my support and other support, but not with the ownership of the president and his cabinet with stablecoins.
I thank the gentlewoman. She yields back. The chair recognizes the vice chairman of the full committee, Mr. Hazanga, for 5 minutes.
Thank you, Chairman Hill, and congratulations to you and gentleman from Wisconsin, Mr. Stiles, and the work that's been put in on this particular issue. But I also want to recognize the contributions of our former chair of this committee, Patrick McHenry, and the work that he did to get us here, frankly, cannot be overstated. And having been a part of the leadership table under now 3 different chairs, the work that everyone at that leadership table, Ms. Wagner, Mr. Barr, Mr. Davidson, others throughout that time, and Mr. Hill, you've been a part of it. We've had robust and active conversations about this particular issue, stretching back nearly a decade. And that's so important that we're here today as we debate the Stable Act. And I think it's important to take a step back and acknowledge how we as a committee got here today in the more recent history. In the 117th Congress, Republicans established a first of its kind digital asset working group. This was birthed out of the Capital Markets Subcommittee that I was chairing, and the initial group set parameters. We debated about what some guiding principles should be and can and must be included. And those parameters for what stablecoin legislation could and eventually would look like. The working group acknowledged that stablecoins could address inefficiencies in the U.S. payment system that we've seen. It acknowledged that maintaining the U.S. dollar as the world's reserve currency should always be at the forefront of any discussion. It acknowledged that the private sector must lead the way, fostering innovation and competition. And finally, it acknowledged a clear regulatory framework would be needed to usher in this modern technology. So how does today's Stable Act stack up against those initial guiding principles? Well, first and foremost, it establishes clear definitions and regulatory classifications for payment stablecoins, something that is desperately needed. Second, it recognizes several regulatory pathways for approving and regulating stablecoin issuers, specifically preserving a state option that offers a lighter touch at times. This, quote, race to the top allows states to compete to implement more stringent regulatory frameworks, signaling that their jurisdiction can offer the safest and most consumer-friendly regime. Third, it sets requirements for issuers of payment stablecoins in comparable jurisdictions abroad. While several foreign jurisdictions, including the European Union, have established or are in the process of developing frameworks for stablecoins, a U.S. federal framework is essential for maintaining global competitiveness. And lastly, and frankly, probably most importantly, it provides vital consumer protections, including a prohibition on commingling of customer funds by custodians, prioritizing payment stablecoin customers over issuers and creditors, and subjecting payment stablecoin issuers to Bank Secrecy Act obligations. So, Mr. Chairman, Congress and regulators should recognize the unique nature of these innovations and establish a regulatory framework that targets the activity and not the technology. And for the detractors, this issue is and should not be partisan, regardless, frankly, of who is president of the United States. Nearly 4 years ago, in testimony before this committee, Treasury Undersecretary for Domestic Finance, Nellie Lang, rightfully noted, quote, "We hurt both innovation and we increase risks if legislation is not passed." So, Mr. Chairman, not doing something actually has greater conflicts and pitfalls than passing this bill today. So where does that leave us? Today, there are more than 200 different types of stablecoins with a collective capitalization worldwide that exceeds $221 billion US. But after years of inaction, we have an administration that is ready to embrace these products, and the time is now. So let me close with a few observations. Applying a one-size-fits-all regulatory framework to stablecoin issuers will prevent smaller startup stablecoin issuers from being able to comply with the larger, more established players that can afford the cost of compliance with the federal banking regime. Limiting stablecoin issuance to federally chartered banks would stifle innovation and would limit the ability of both federal and state authorities to tailor regulations to the specific risks of stablecoins. Stablecoins have the potential to bring benefits to the existing payment system by supporting faster and more efficient payments, with one study estimating that stablecoins could reduce remittance costs by as much as 80%, which would save individuals nearly $30 billion per year. Not all stablecoins are created equal. With the proper safeguards to protect reserves and maintain liquidity, the risk of being a catalyst in the downfall of the financial system is minimal. Straightforward rules based on preventing fraud and promoting transparency will ensure that innovation is nurtured within the United States and not overseas. Digital asset-related crime remains a small part of the overall digital asset economy. It's comparatively smaller than the share of illicit funds involved in traditional finance. So, Mr. Chairman, I know you know this, we're at an inflection point. It comes to digital assets, and this is the first step in a long journey, but it's a crucial one, and I look forward to the debate today. Now, I yield back.
Thank the gentleman from Michigan and also for serving as our distinguished vice chair. Such a big help to the committee's work. The chair now recognizes the ranking member of the Foreign Affairs Committee, our distinguished member from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. I have long believed that clear and consistent rules of the road are essential for a well-functioning financial system. They protect consumers, help prevent illicit financing, and are crucial to maintaining our global competitiveness. And since 2015, the New York Department of Financial Services has set the gold standard for regulating virtual currency businesses in the United States. And I don't think we'd be here today without New York's innovative approach and steadfast leadership. And so with that, I'd like to thank Chairman Hill and Chairman Stile for their willingness to work with me to improve the Stable Act in a few key respects. This bill provides authority for a state licensed issuer to offer stablecoins in another state called a host state with some important guardrails. In addition to notifying the host state, the out-of-state issuer must comply with all requirements of the home and host state's regulatory regimes when conducting business in the host state, including consumer protection laws. My understanding is that the intent of the drafters was for the issuer to remain subject to certain supervision, examination, and enforcement authority of state payment stablecoin regulator of such host state. I yield to Mr. Style just to ask him, would I be correct in that assessment?
Yes, Mr. Meeks.
Thank you. And the ability to supervise, examine, and enforce is critical to ensuring that strong states like New York, with robust supervision, aren't undercut by lighter touch regimes. But I am concerned that the current language is not sufficiently clear that strong states like New York would retain these critical authorities. So, Mr. Stiles, I'm going to again ask you, will you commit to work with me as this bill makes its way to the floor to clarify this language?
Mr. Meeks, yes, I think we have a great opportunity to continue to work with you in the clarification of this point.
Thank you. I've also appreciated the opportunity to work with the drafters to strengthen the AML-BSA section of this bill and limitations on offshore issuers, among other things. But let me just also say this. I want to thank Ranking Member Waters because she was working hard in a bipartisan way to make this bill a bipartisan bill and to work together to make sure it protects all. And she's correct. It is completely inappropriate for the president's family to announce their intention to launch a stablecoin while he is still in office. The Trump family has repeatedly ignored conflicts of interest, and this is just a prime example of that. The only thing that the president seems to have achieved with his recent announcement is undermining bipartisan negotiations that are taking place here in Congress. He is and has continually moved to enrich himself and his billionaire friends. However, I looked at this and I said stablecoins are here to stay. And as I've said before, it's our responsibility to establish clear rules with a high regulatory standard for issuers to meet. I talked to individuals in my district who look to invest in stablecoins. They need that clear certainty. In my role as the ranking member on the House Foreign Affairs Committee, I've talked to some of our allies who are developing on the continent of Africa, in Central and South America. They too are using stablecoins. So there needs to be some clear rules and regulations and certainty. Certainty is important. Unlike the president's tariff policy, I believe certainty is crucial, so companies know exactly what the rules they need to follow and can plan accordingly. And so, though the president's actions have caused me to pause the certainty issue and to make sure that we have the clear rules of the game, I am going to support the Stable Act. And with that, I yield back the balance of my time.
Gentleman yields back, seeks recognition. The gentlewoman from California, Ms. Kim, is recognized to strike the last word.
Thank you, Chairman Hill, for recognizing me to speak on this very important piece of legislation. I'm proud to be an original co-sponsor of the Bipartisan Stable Act, and I believe that it builds upon our long-standing principle of fostering innovation in America and sharing it with the world. This principle has endured for decades across Republican and Democratic administrations, and it has repeatedly been reaffirmed in bills passed by Congress. As I have met with industry experts and consumers, I am always left with one takeaway. Blockchain technology is the key to promoting social good here at home and internationally. Over the last 2 years, we have heard examples of stablecoins that reduce cross-border transaction fees by over 14 times. As a result, U.S. aid can be delivered more efficiently, and we can better uphold American values and interests around the world. Domestically, President Trump has made it clear that he wants to see the federal government take advantage of digital payments. Stablecoins could enable us to deploy aid to wildfire-afflicted communities in Southern California faster and with greater transparency. There are benefits of stablecoins for our country that we have not even begun to explore. That is why I was pleased to see the inclusion of an impact study in the amendment in the nature of a substitute offered today. The report that will be produced from the impact study will provide key findings on domestic and cross-border payments, benefits that stablecoins could bring to the global south, and how to reinforce the role of the US dollar as the world's reserve currency. At the end of the day, the Stable Act is focused on answering the question of how to build jobs and investment in America and spread American values across the world. Mr. Chairman, let me add one other point. The story of this country is the innovation sparked in garages and classrooms. Those of us in California have witnessed that firsthand with all the innovative companies that call our state home. The state charter pathway that is included in this bill would preserve that innovation by giving small companies access to a regulator tailored to their risk and size. I know some may fear the preparedness of state regulators to handle the stablecoin industry. However, these state regulators will work in lockstep with the Treasury Department to ensure that their regulatory frameworks are certified as consistent with those at the federal level. This dual pathway will be critical to fostering the type of innovation that has come to define our country. Mr. Chairman, I want to thank you and Mr. Stile for the hard work that you have both done on this legislation. I urge my colleagues to support this measure, and I yield back the balance of my time.
The gentlewoman yields back, seeks recognition.
Yeah.
The gentleman from Georgia, the distinguished longtime member of our committee, Mr. Scott, you're recognized for 5 minutes.
Thank you very much, Chairman. And may I say you're doing a great job and enjoy your partnership on this measure. But this bill is full of problems. First, the bill lacks clear, enforceable requirements for stablecoin users, issuers to maintain sufficient and verifiable reserves. And consumers must be certain that every digital dollar they hold is backed by tangible assets, basic finance. Unfortunately, without strict and transparent reserve audits, issuers could engage in risky financial practices, putting everyday users at risk of losing their firms in the event of a collapse. And the bill strips the Federal Reserve of any authority over state-regulated digital wallets that consumers use to hold their stablecoins. Additionally, the bill fails to provide strong recourse mechanism. The bill also fails to establish clear refund issues requirement. And we all know in traditional banking, our deposits are insured. Why should stablecoins, which millions may rely on for everyday transactions, be any different? And worst of all, the fact that this bill does not address the massive conflicts of interest with President Trump, Elon Musk, and this administration. As Ranking Member Waters explained, the bill in its current form allows the president and his family to gain millions more from the issuance of stablecoins once he signs this bill into law. Now, I respect the president. We both attended the Wharton School of Finance at the same time. Spent many hours in Lippincott Library. I assure you the Wharton School is tough. So I respect this president. But unless we clear these concerns that Ms. Waters has brought up, there's no need for this man to have this stench on his family, on himself. It's already clear. And I just urge the president and the White House, let's come together. Let's remove any doubt that this is unfair to us as American citizens, that it puts the President of the United States in the face of having a black mark unless we move as a Congress to make sure that there is no black mark on this president. But I assure you, if we wash this under the table, this mark, without erasing these concerns that Ms. Waters has raised, and not only Ms. Waters, but there are people in the nation, around the world, who are watching us. Let us clean up this mess. I want our president to be clear and good and decent, for he is a good man. And we want to make sure that that rings true. Let us make sure that it is the duty of this committee to not stain this president. And unless we remove these charges against him and his family, it will be a disgrace on us all. I yield back.
Gentleman yields back. Our majority whip, Mr. Emmer of Minnesota, the Vice Chair of the Digital Assets, Financial Technology, and Artificial Intelligence Committee, is recognized to strike the last word.
Thank you, Mr. Chairman. I'd like to start by commending you, former Chairman McHenry, and Congressman Stile, as well as your teams, for your amazing work on this stablecoin bill over the past 3 Congresses. I'm honored to be an original co-sponsor of this legislation. Fundamentally, any stablecoin bill is about national security and preserving and extending the dollar's dominance as the world's reserve currency. Around the world, people want U.S. dollars because we have the strongest and most reliable economy and government in the world. It's the currency the world counts on to do business, and the United States' global position relies on that status. This is a nonpartisan issue, and I'm humbled by this committee's efforts to lead intellectually and legislatively on the issue, crafting what we have today, the STABLE Act. This bill is a globally competitive regulatory framework for dollar-backed stablecoins, one that encourages domestic innovation and brings transaction volume back into the United States' visibility and control. I want to thank the committee for incorporating my feedback in this new text. The STABLE Act eliminates the previous role of the Fed over non-bank issuers, and it scales back federal involvement in the state pathway. Importantly, the STABLE Act provides a pathway for global reciprocity so we can export dollars to the fullest extent possible, and it allows for invention and innovation in the payment stablecoin space, such as the creation of privacy stablecoins, which would function similar to privacy coins. Today, a vast majority of crypto activity settles in stablecoins, and with the passage of this legislation, our entire global digital economy can settle in dollar-backed stablecoins that are safe and reliable. It's not a perfect bill, but it's a perfect bill for this moment. President Trump directed Congress to pass this legislation and have it on his desk before the August recess. Today, Mr. Chairman, is a big step in doing just that. This is a tremendous opportunity for the United States financial leadership, and I'm honored to have been a deep part of this legislating process. And I encourage all my friends on this committee to unreservedly vote yes on this bill today. And with that, Mr. Chairman, I yield back.
Gentleman yields back. Thank you for your work on this legislation. Gentleman recognizes the gentleman from Illinois. Mr. Cassidy, you're recognized to strike the last word.
Thank you, Mr. Chair. I want to raise a constitutional question, and I want to associate myself with the ranking member's concerns about the Trump stablecoin. We all take an oath to defend the Constitution. I'd like to remind you all of Article 1, Section 9. No person holding any office of profit or trust under them shall, without the consent of the Congress, accept any present emolument, office, or title of any kind whatever from any king, prince, or foreign state. The ranking member had mentioned Justin Sun. Let's review the details of this. Mr. Sun runs the Tron blockchain. It's a network that's favored by drug traffickers and terrorist groups. Mr. Sun was also recently named as the deputy leader in blockchain research at the Central Party School, which trains future leaders of the Chinese Communist Party. Mr. Sun put $30 million into World Liberty Financial, which triggered a release that allowed Mr. Trump to claim 75% of the net revenue under the terms of their agreement. Mr. Tron then put another $45 million into World Liberty Financial. Now, I want to stress, Mr. Sun received absolutely no value for that. These tokens are non-transferable and they are indefinitely locked. This was just a transfer of money to the Trump family. We also know the recent Trump meme coin, not a stable coin, but bear with me, saw a surge, as we discussed on this committee, saw a surge of purchases from Chinese entities. We do not know who those Chinese entities are. If we cared about our constitutional responsibility, we would be asking questions about it. But we know that those transfers allowed the Trump family to earn over $100 million in brokerage fees for something that is completely valueless. As everybody on this committee agreed when we were discussing those kooky meme coins. Congress has not consented to that violation of the emoluments clause of the Constitution, which puts the president in direct constitutional violation. Now we could, you all are in the majority, if you think that's a good thing for the president to be taking money from Chinese nationals, princes, what have you, you could bring a vote to the floor, you could give congressional consent. I don't think you'd get any Democratic support, maybe you'd pass it. But if you haven't done that, this is a constitutional violation. And so if this bill doesn't address the issues that the ranking member raises, then we are complicit in violating our oath to the Constitution. Moreover, and I want to come back to the meme coins, we sat here yesterday talking with Chainalysis about the fact that our ability to track illegal transactions on the blockchain are a function of those transactions being on-chain. And that in fact, a lot of the ways that the illegal activity happens is to take one form of crypto, move it into an exchange, use that to buy a stable coin. That's all an off-chain transaction and you can't see it. So if you wanted to do all sorts of nefarious things, from North Korean nukes to drug trafficking and all sorts of other crimes, and use crypto to get away with it, things like the Trump meme coin, connected to with a stablecoin nexus, it's a great way to do it. Which means that it's not only addressing the existing constitutional violations, but working to close the barn door to not make it easier to commit those violations and harder for regulators to prosecute them. That does not mean that we cannot have stablecoins. It doesn't mean that we can't have robust stablecoin regulation. But we have got to close the barn door, and I hope that in the course of this markup today, we can make those changes to address our own constitutional oath, to make sure that these emoluments cannot continue, and to do so in a way that we can get to some bipartisan consensus. But my God, it should not be partisan to defend the Constitution. Thank you, and I yield back.
Gentleman yields back. Who seeks recognition? Gentleman from Indiana, Mr. Stutzman, is recognized to strike the last word.
Thank you, Mr. Chairman. Today, I urge my colleagues to support the STABLE Act. Within the first week of his presidency, President Trump signed an executive order to establish United States leadership in digital financial technology, noting specifically that the U.S. should take actions to promote the development and growth of lawful and legitimate dollar-backed stablecoins worldwide. This committee has taken seriously the issue of how digital assets will be integrated into the U.S. financial ecosystem, and it's an honor to return to this committee and take part of this historic moment. Fostering an environment for economic growth and prosperity requires regulatory certainty and a clear understanding of the landscape. The STABLE Act does just that by providing both a federal and state pathway for payment stablecoin issuers, mirroring the dual banking regulatory system that has utilized the strengths of both state and financial regulators. Several states, including my home state of Indiana, have incorporated digital assets and stablecoin into their money transmission laws to allow individuals to exchange digital currencies. The STABLE Act will increase innovation and create more options for both payment stablecoin issuers and consumers by empowering the U.S. to become a leader in the digital payment ecosystem. The use of stablecoins strengthens the U.S. dollar by expanding the use of dollar-backed assets in digital markets worldwide, underpinning the United States dollar as the global reserve currency. I applaud the leadership of Chairman Hill and Digital Assets Subcommittee Chairman Stile, and again would urge my colleagues to support this piece of critical legislation. With that, Mr. Chairman, I'll yield back.
Gentleman yields back, seeks recognition. Gentleman from Massachusetts, the ranking member of the Digital Assets, Financial Technology, and Artificial Intelligence Subcommittee, Mr. Lynch of Massachusetts, recognized to strike the last word.
Thank you, Mr. Chairman. This bill, the so-called STABLE Act, is a misnomer in the highest degree. We are not inviting stability into the financial markets by rubber stamping legislation at the request of a president who is now, I believe he's hawking his fourth digital currency to the American public in under a year. Just last week, World Liberty Financial, a Trump crypto company, announced that the president will soon be marketing a new stablecoin called USD1. According to the company, no games, no gimmicks, just real stability. That's the slogan. The stability they're referring to is the $550 million that the token sales have netted to date, with 75% of that going to the Trump family. Elon Musk is no different. We already know he's expressed an interest in rolling out his own stablecoin, X Money. We are not providing stability by rushing through industry-friendly legislation that removes essential consumer protections, impairs regulatory oversight, and will actually facilitate market volatility. That's why the Americans for Financial Reform, Better Markets, the Consumer Federation of America, and Public Citizen and other consumer advocacy organizations have already asked us to oppose this bill. To make matters worse, President Trump is nominating heads of regulatory agencies that have been handpicked by the crypto industry. The SEC is one by one dropping legitimate cases against crypto companies. These are clear examples of corruption and conflicts of interest in action. Allowing this bill to become law will undoubtedly facilitate another financial disaster. In addition, we risk derailment of our payment systems and a complete takeover of our overall financial system by big tech companies. When the next crypto crash inevitably comes, we will all be on the record for having allowed this to happen. Time and again, American taxpayers have been left holding the bag as the government rescues poorly regulated industries with zero accountability. Without an adequate regulatory framework that mirrors traditional financial laws, we increase the likelihood of runs that will trigger systemic crises. I do agree with most of my colleagues that a regulatory regime is needed, but not one that reflects the whims of industry advocates. This proposal would essentially give stablecoin issuers the privileges entitled to depository institutions without having to comply with any of the regulations that accompany those responsibilities. Following numerous financial crises, bank failures, runs, breaches, and more, as a country, we have decided and created a robust regulatory regime to ensure the integrity of our financial system. That's why America has succeeded greatly in the financial industry, because of the trust that the rule of law has created here for investors from around the world. Rules around capital liquidity, safety and soundness, and anti-money laundering. Those are what make our economy the envy of the world. Why would we allow one industry to circumvent all of our carefully crafted laws and regulations? In closing, despite industry claims, stablecoins have proven to be anything but stable, and over 20 stablecoins have collapsed between 2016 and 2022. Each of the world's largest stablecoins have lost their pegs to the US dollar on multiple occasions, and provision in this bill to do little to ensure that stability. I plan to expand further on glaring gaps in this bill through my forthcoming amendments. Thank you, Mr. Chairman, and I yield back.
Gentleman yields back, seeks recognition. Gentleman from Iowa, Mr. Nunn, the Vice Chair of the Subcommittee on National Security, Illicit Finance, and International Financial Institutions Subcommittee. Mr. Nunn, you're recognized to strike the last word.
Thank you, Mr. Chair. To both Chairman Hill, to our colleagues on the other side of the aisle, and to our leader on this, Mr. Steele, I'm very proud to be able to support Chairman Stiles' Stable Act. How we manage and provide money is rapidly transforming. We all recognize that stable coins already are offering a powerful opportunity to shape a modern and efficient payment system that candidly will reshape the future of America's financial success. So simply put, American-backed stablecoins provide a digital money designed to keep a steady value tied to something as stable as the US dollar. So for folks back home in Iowa and across the country, think of it this way. You could buy a $50 gift card at your local convenience store. This day marks the 40th anniversary of Casey's General Store. Everybody knows it from its breakfast pizza, but also one of the best places to be able to buy a gift card for your family. So whether the price of gas goes up or the price of gas goes down, the gift card is still $50. Think of it this way with stablecoin. The economy may fluctuate, but with stablecoin, unlike other cryptocurrencies that fluctuate in value, they remain consistent because they're able to buy back the real value of a US-backed dollar. American-backed stablecoins can authorize, clear, and settle payments almost instantly. This is the ability to reduce the friction, the transaction time, lower consumer fees for the ultimate American who's using it, and help manage volatility, addressing many of the concerns that may have been raised earlier with stablecoin. With stablecoin market now valued at over $234 billion with a B dollars, this market signals that it has a clear potential and makes stablecoins one of the best payment options. I would offer, however, if we continue to lack leadership in this space, we risk ceding growth and abandoning our leadership on the world stage. While the United States has hesitated, other countries have acted decisively, Mr. Chair. Japan, Singapore, folks in London, the EU, all have created clear, effective regulatory frameworks for stablecoin, and with it comes the attraction of capital, the attraction of talent, and the leadership in innovation. The United States should not be left behind or afford not only our friends, but also our adversaries to take lead in this role. If we can effectively regulate these assets, they will have the capacity to modernize our payment system and, as I noted, lower our transaction costs, help crack down on illicit financing schemes, and improve the stablecoin ecosystem. As a former counterintelligence officer, I understand how critically important it is to get AMLS BSA protections in the Stablecoin Act right. Section 4 treats stablecoin issuers as a financial institution under the Banking Secrecy Act and requires the Secretary of Treasury to issue regulatory applying tailored BSA obligations for payment of stablecoin issuers. These obligations will require issuers to do the following. 1, establish and maintain anti-money laundering and counterterrorism financing programs. 2, retain appropriate records of transaction. 3, monitor and report suspicious activity. And 4, maintain an effective consumer identification program. In addition, the bill clarifies that permitted payment stablecoin issuers must comply with U.S. sanctions laws. This is a good move. We need this legislation to ensure that stablecoins are not only safe, secure, and properly regulated, but the stakes are too high to turn our back on it. Our economic competitiveness, our national security, and the dollar's role in the world as a reserve currency, they're all on the line. We must lead in the way that building the next generation of financial technology starts with not only being made in America by Americans, but as a future for America on the world stage. With that, I'm proud to co-sponsor this bill. I'm proud of Representative Stiles' leadership and this committee taking the first step forward. Together, we have the opportunity to not only vote in favor of it, as I urge my colleagues to do, but take a leadership role for the entire world. With that, Mr. Chair, I'd yield back my time.
Gentleman yields back. The chair recognizes the gentlewoman from New York, our ranking member of the Small Business Committee, Ms. Vasquez, to strike the last word.
Thank you, Mr. Chairman. I would like to thank you and Ranking Member Waters for tackling this issue of digital assets and stablecoins head-on and attempting to craft a bipartisan compromise that could bring everyone to vote yes. I also want to thank Ranking Member Waters for her leadership and trying to craft bipartisan legislation that maintains strong oversight, consumer protection, and enforcement, while also promoting financial inclusion and supporting innovation. I believe these priorities can and should work together. From the beginning, I have said that developing stablecoin legislation should be a committee priority, and I have had hope to be able to support this bill. While I'll be offering amendments later to raise specific concerns with the text, I want to start by addressing a more fundamental concern about the environment we find ourselves in this morning. Mr. Chairman, we do not legislate in a vacuum. As we consider the merits of stablecoin legislation, we cannot ignore the actions of President Trump, Elon Musk, and other members of the administration, their connection to the cryptocurrency industry, and their broader attempts to destroy our government to meet their ends. The Trump administration is plagued by conflicts of interest and profiteering, particularly among those connected to crypto. President Trump's and co-president Elon Musk's Doge is itself a reference to a meme coin that Musk has long promoted on social media. His activity has repeatedly driven up the coin's value and sparked lawsuits alleging price manipulation. 3 days before his second term started, President Trump launched his own Trump Money meme coin and promoted it on his social media platform. Melania Trump issued her own meme coin the day before the inauguration. When the price of the coin crashed, Trump insiders sold their holdings, and it was ultimately the investors that were left holding the bag, suffering more than $2 billion in losses, while Trump and his insiders made more than $350 million collectively. Separately, Secretary of Commerce Howard Lutnick has deep involvement and connection to the cryptocurrency Tether, a digital asset widely known for its role in facilitating illicit activity. His close connection with the scandal-ridden coin raises serious conflict of interest concerns and questions about his ability to put the interests of the federal government and the American people before his own. Meanwhile, according to media reports, Elon Musk is working to turn X.com into a virtual wallet and payment platform with plans to launch his own stablecoin. Adding to this, World Liberty Financial, a crypto firm launched by Donald Trump and his sons, recently announced plans to release a stablecoin called USD1. Despite all these red flags, this legislation doesn't include any language prohibiting senior members of the executive branch, including the president and cabinet officials, from having ties to or profiting from the issuance of a payment stablecoin. To those who say that I and other Democrats are unfairly criticizing Trump and his administration, my response is simple. This kind of language is basic and should be included whether a Republican or Democrat is in the White House. But I cannot overlook the broader conflicts of interest tied to this administration and the lack of any language in the bill to address them. I urge my colleagues not to lose sight of that bigger picture either. I yield back, Mr. Chairman.
Gentlewoman yields back. Chair recognizes the Vice Chair of our Oversight and Investigation Subcommittee, gentleman from North Carolina, Mr. Moore, to strike the last word.
Thank you, Mr. Chairman. You know, for nearly a century, the U.S. dollar has been the world's currency. That's because of financial innovation, the free market system, and a dynamic economy that led to that dollar's global supremacy. Stablecoins are a key to ensuring that the U.S. dollar remains the world's reserve currency. Stablecoins expand the dollar's reach. They don't replace it. Additionally, stablecoins hold the promise of being a potential cornerstone of the modern payment system. In fact, that promise is already being demonstrated throughout the world. The U.S. cannot sit on the sidelines allowing competitors to pass us by. Earlier this year, President Trump made a commitment to strengthen the United States leadership in digital financial technology. The STABLE Act is in line with that commitment. It provides regulatory clarity for stablecoin issuers that protect consumers and promote innovation. It's a common sense solution that provides both state and federal pathways for payment stablecoin issuers. This reflects the dual banking system that underpins U.S. financial regulation. By passing the STABLE Act, we are fostering a safer, more reliable digital economy. I'm proud to be a co-sponsor, and I want to thank Chairman Hill and Subcommittee Chair Stahl for their work on this bill. Mr. Chairman, I yield the balance of my time to the gentleman from New Jersey, Mr. Gottheimer.
Thank you, Mr. Moore. I appreciate that. Since 2019, I have urged financial regulators and my colleagues in this committee to create smart, clear guardrails for digital assets to protect consumers and ensure America's competitiveness. In the 117th Congress, I drafted the Stablecoin Innovation and Protection Act to create standards for stablecoins, distinguishing them from other types of cryptocurrencies and providing guidance for firms issuing stablecoins. The STABLE Act, like my bill, provides a pathway for bank and non-bank issuers of qualified stablecoins, establishes important consumer protections, and requires issuers to back stablecoins one-to-one with U.S. currencies or equivalents. That way, if a consumer has $100 of a qualified stablecoin, they can be certain that $100 US are available to them when they decide to cash out. I want to thank Chairman Hill and Chairman Stahl for their work on this legislation and for engaging with me and my staff in recent weeks to address several outstanding issues and help advance this bill on a bipartisan basis. We've seen what happens when stablecoins do not have appropriate guardrails. Terra Luna collapsed when the algorithm that supported the so-called stablecoin was unable to deal with the run on the stablecoin, leading to a loss of $60 billion of value in a matter of days. That's why this bill is critical. It will protect consumers, create a foundation for the future of digital payments, implement safe and smart guardrails for stablecoins, and keep innovation where it belongs in the United States of America. I support this bill like I strongly supported FIT 21 and the Clarity for Payment Stablecoins Act last Congress, because we can't afford another Terra Luna or another FTX. We need regulatory clarity and certainty for digital assets. It's critically important. I again want to thank the chairman. Mr. Chairman, thank you for working across the aisle on this legislation. I'd also like to thank Ranking Member Waters for her longtime engagement on this issue. I strongly urge my colleagues to support this important bill. Thank you, and I yield the balance of my time back to the gentleman from North Carolina.
I yield. The gentleman from North Carolina yields, who seeks recognition. The chair recognizes the distinguished gentleman from Illinois, Dr. Foster, the ranking member of our subcommittee on financial institutions. You're recognized to strike the last word.
Thank you, Mr. Chairman. I will be introducing 4 amendments to this. I do not support the bill in its current form, but if these 4 amendments are accepted, I intend to support it. So I'll just go through them rapidly. Firstly, the legislation is silent on the issue of taxpayer bailouts of failed stablecoins. One of the lessons of the 2008 financial crisis is ambiguity about taxpayer backstops is the worst of all worlds. When you looked at the failure of Lehman Brothers and then one day later, the bailout of AIG, which resulted in chaos in the markets and lawsuits that went years later. So we have to be clear. Many of you have emphasized the value of clarity of regulation. Nothing is more important as making it clear does the government and does the taxpayer stand behind a failed stablecoin or not? And if so, is it the taxpayer of Wyoming or the taxpayer of the federal government or the Federal Reserve? We need clarity. The amendment I'll be offering is simply to say there will be no bailout, period, specifically about the 13.3 powers of the Federal Reserve, which is the big dog in this. So that is the first one. The second one is Republican witnesses in recent hearings have emphasized the value of the freeze and seize capability that the issuer maintains to reverse fraudulent or mistaken transactions. The Senate recognized this, and the Senate included freeze and seize conditions as a necessary thing that issuers should put in. My amendment essentially inserts the Senate language on that. The third one is a rather small ball. It's simply to establish in FinCEN a digital ID officer. Countries around the world are going to digital ID systems. The EU will have every EU citizen will have a digital ID. Most countries of the world already have this. We will be interacting with those systems, and FinCEN is the point of interaction. Having a single point of contact has been very valuable, and this would simply codify the existence of that very important role. The last one has to do with optional wallet verification and KYC. And this, I think, is crucial. This bill that we're marking up here provides a potentially vast payments highway where all of the automobiles on that highway and all the drivers have no licenses. So this would simply provide the stablecoin issuers with the option, if they want, of issuing coins into a highway where all of the participants are KYC'd. All of the drivers have driver's license. All of the cars have license plates. And there are reasons why the market might prefer those. A simple example: let's say that you're working in crypto markets and you want to keep a lot of your net worth sitting in a stable coin. And if you get hacked with the current system, you transfer it into the hacker transfers it into an anonymous wallet and you're dead. All right. However, if you're storing your stable coins in a system where only KYC participants can exist, the only thing you can transfer that hacked crypto into is to another wallet that's been KYC'd. So at least for the first step, you can find out where that stolen money went. Same thing applies to ransomware. So this, I think, would be, as I say, these four amendments, if they get adopted, would bring me to a yes on this bill, because this would be a big improvement. And with that, I yield back.
Dr. Foster yields back, seeks recognition. Gentleman from Pennsylvania, Mr. Muser, the chair of the Subcommittee on Oversight and Investigations, recognized to strike the last word.
I move to strike the last word, Mr. Chairman. Thank you. I urge my colleagues to support H.R. 2392, the Stable Act introduced by Representative Stile and Chairman Hill, of which I am an original co-sponsor. I do want to acknowledge all the work the Trump administration and crypto czar David Sachs has done to undo the very anti-crypto policies of the Biden administration. This legislation accomplishes three critical goals that serve both our national interest and the everyday needs of the American consumer. First, the Stable Act reinforces the U.S. dollar's status as the world's reserve currency by ensuring stablecoins are issued under a dollar-backed, robust framework in America. This legislation ensures the U.S. continues to lead in global finance. The reality is that stablecoins are already in widespread use, moving billions of dollars every day, and we have a unique opportunity to shape that market in a manner that strengthens American business and our currency. Second, this bill provides a private sector alternative to a central bank digital currency. I share the concerns of many of my colleagues about the risks of a government-run digital dollar, risk to privacy, to free enterprise, and to the proper role of the Federal Reserve. Stablecoins offer a market-driven solution that enhances consumer choice without opening the door to excessive government surveillance or financial centralization. This is the kind of innovation we should be encouraging. Third, the Stable Act will help modernize our payment system, reducing costs, speeding up transactions, and improving access to banking services. Stablecoins are already being used to streamline commercial transactions and increase financial access, especially for underserved communities. With the right regulatory clarity, these benefits can reach more Americans. This is a smart, measured, and forward-looking bill. It provides necessary guardrails without stifling innovation. It keeps America competitive and it safeguards the foundational values like free enterprise and individual privacy that should define our financial system. I again commend Chairman Hill and Mr. Stile, who have worked to advance this legislation. I look forward to continuing to deliver on President Trump's promise to make America the crypto capital of the world. I yield back.
Gentleman yields back. Who seeks recognition? The gentleman from Montana, Mr. Downing, is recognized to strike the last word for 5 minutes.
Thank you, Mr. Chairman, and thank you for the good work that you and Subcommittee Chairman Stile have done on this. I got to tell you, I'm very excited about this and happy and proud to be a co-sponsor of H.R. 2392, the Stable Act. Being the former Securities Commissioner of the state of Montana, I've seen firsthand what regulatory ambiguity has done to, offshore innovation and created problems, including not having reasonable signboards. So I've seen that. So I'm having regulatory clarity to be innovative in the United States of America, I think, is incredibly important. I think that this bill accomplishes that. Also, being a former, business owner, have created small businesses. Having the United States remaining the hotbed of innovation, I think, is incredibly important, and I'm really excited about that as well. We've met with lots of stakeholders on this, making sure that we've really heard about concerns as we put this together, and I really believe we've created a strong and refined product here that we have before us today. I also want to thank my Democratic colleagues on this committee for co-sponsoring this legislation. This legislation will allow for innovation to continue to thrive in the U.S. while maintaining important consumer protections. The Stable Act mirrors the successful dual banking system by allowing stablecoin issuers to pursue both state and federal regulatory pathways, which I think that is incredibly important. And the Stable Act creates a federal floor to ensure that all lawful payment stablecoins are backed one-to-one by high-quality liquid assets. All stablecoin issuers will be treated as financial institutions under the Bank Secrecy Act. All of this comes to really create, a strong piece of legislation here that I think really gives clarity and allows us to continue to innovate in this space. My other colleagues have already mentioned this, but I think it's important to note that the Stable Act will enhance U.S. dollar dominance worldwide. This is something that I'm concerned about, and I'm really happy to see that. This will expand the use of dollar-denominated assets, which I think is great for the United States financial institutions, for our financial well-being, for our security, a number of things. And lastly, I do not think we would be where we are today with this legislation if not for the overwhelming victory of President Trump, who ran on making sure the United States is the place where digital asset companies want to be and to create these jobs. On that, Mr. Chair, I yield my time.
Gentleman yields back. Is there anyone else seeking recognition to speak on Mr. Stiles' amendment in the nature of a substitute? Hearing none, I recognize myself for 5 minutes. I urge my colleagues to support the Stable Act and the good work of Mr. Stile and our subcommittee and the marvelous work of our Democratic original co-sponsors that have tried to make this a strong and effective and crucial piece of legislation that creates a clear regulatory framework for payment stablecoins. This bill is a necessary step towards providing regulatory certainty and ensuring the United States remains at the forefront of digital asset development. The need for a payment stablecoin framework has never been more urgent. In response to the November 2021 President's Working Group on Financial Markets, it highlighted the benefits and risks of payment stablecoins, and this committee began crafting bipartisan legislation in the 118th Congress to foster just that, the best part of it, the innovative part, while mitigating the risk. And I thank again former Chairman Patrick McHenry and our current ranking member, Mrs. Waters, for that initial strong work. That bill and the incredible efforts of the members in this room are foundational to how Congress on digital assets works together. Our discussion today will be passionate, but I can assure the folks at home that because we care so much about getting this right, the need for clear regulatory guardrails could not be more apparent. Just a month into the 119th Congress, President Trump issued an executive order prioritizing stablecoin regulation. In alignment with this effort, our committee, the The Senate Banking Committee and the White House Artificial Intelligence and Crypto Advisor David Sachs held a press conference emphasizing the importance of stablecoin legislation as well as market structure legislation, along with our friends on both the House and Senate Agriculture Committees. This collaboration has led to the introduction of the Stable Act by our subcommittee chair, Mr. Stile. The bill reflects on the extensive feedback from stakeholders, including state and federal regulators, financial institutions of all sizes, existing stablecoin issuers, and the broader digital asset ecosystem. Republicans firmly believe that properly regulated payment stablecoins can play a pivotal role in modernizing the U.S. payment system. However, the absence of a federal framework has led to the only option being a state-by-state regulatory landscape. The Stable Act addresses this challenge by establishing a unified regulatory structure while preserving the critical role of state oversight. The bill provides clear definitions and classifications for payment stablecoins, offering both state and federal pathways for issuers. It also sets standards for stablecoin issuers operating in comparable foreign jurisdictions. Importantly, the legislation mandates that stablecoins be backed one-to-one by high-quality liquid assets, establishing clear redemption procedures, and requires monthly disclosures on reserves and insurance. Most critically, the Stable Act incorporates robust consumer protection measures and tailored capital, liquidity, and risk management requirements. The Stable Act strikes the right balance, supporting innovation while safeguarding consumers and reinforcing United States' global leadership in digital assets. I'm a proud co-sponsor of Mr. Stiles' work. I support this bill. I'm thankful for the Republican members that worked diligently on this legislation, as well as my Democratic colleagues who remain strong partners in continuing to review and craft our legislative text today. I urge my colleagues to support this vital legislation as we work to build a regulatory framework that aligns with the realities of today's digital economy. Chair recognizes the ranking member to strike the last word.
I have an amendment.
Oh, let's see.
At the desk?
Have you already? She has, okay. Is anyone else who seeks to be recognized on the A&S? Hearing none, we'll move to amendments. Does anyone wish to offer an amendment to the A&S?
I have an
The ranking member has an amendment at the desk. And we'll pause while that amendment is distributed.
Mr. Chair, I reserve a point of order.
Gentleman has reserved a point of order. The clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Ms. Waters of California.
Without objection, the amendment is considered read, and I now recognize the gentlewoman from California to be recognized on her amendment.
Thank you very much, Mr. Chairman. This amendment would be an important protection against conflicts of interest in the stablecoin ecosystem. The amendment would ensure that entities controlled by the President, Vice President, heads of executive departments, members of Congress, and their spouses, children, sons, and daughters-in-law could not review proposed or final rule text before that text is made available to the public. Why is this important? This is important because when we pass legislation, this legislation ends up in the hands of the department that's going to put the rules together that make sure that the legislation is consistent with the intent of that was announced in the production of the bill. Now, what happens now is the President of the United States said, instead of continuing to operate so the rule is done by the so-called independent agencies and get the public involved, no, you send it over here to me, to the White House, so that we can do whatever we need to do to ensure that we are not interfered with in the way that we want to control this legislation. And so the bill under President Trump's administration, the concept of independent agencies is no more. That means that all of the agencies that once issued rules separately from the political influence of the White House must now avoid all the independent agencies who traditionally dealt with the rules. They must have their rules sent directly to the office of the president. At the same time, President Trump's World Liberty Financial, of which 60% is owned by Trump's family, just recently announced its plans to issue a stablecoin. This amendment would ensure that the Trump administration could not pass the rules under this law to his companies before they're available to the public. Without this amendment, there could be a revolving door of corruption where Trump-backed enterprises have a hand in writing rules before they're ever seen by the public, and then also make changes to their businesses based on the rules they know before anyone else. Without this amendment, other serious stablecoin issuers would be put at great disadvantage to Trump's own companies. We must stop the crypto grift happening at the highest office of this company. One thing that is absolutely clear about this president, he wants complete control. And what he has done is he has intimidated members of Congress. He has certainly chosen those who would serve in the most important agencies in his cabinet, do what they're told and not do what the Constitution would ensure they must be doing. And so he goes a step further. He's in our face. And what he's done, for example, with the Justice Department, he told us he was going to put people at the Justice Department that would help him get revenge on any of those lawyers who had a hand in investigating him, et cetera, et cetera. He goes further with this. I'm trying to tell you that what he's saying about traditionally the way that rules are developed and the public gets involved, he's getting rid of that. You pass the bill, you send it to me. I can tamper with it, I can fix it, I can do what I think protects me, and that's the end of it. Forget about this rule being handled by independent agencies that involve the public. This is absolutely ridiculous. It goes even further than those who will not protect against him being able to further enrich himself and his family by the ownership of a stablecoin company. He's saying, do not do anything in the legislation that would prevent me from owning. And further, once you pass the legislation, if I win, I'll take care of it, and I make sure it fits what I wanted to have done and not even what the legislation intended. With that, I rule back. I rule back.
Gentlewoman yields back.
Rule back. I yield back. I wish I could rule back.
Does the gentleman from Wisconsin insist on his point of order?
No.
Is there any more debate on this amendment? The gentleman from Wisconsin is recognized to strike the last word.
Thank you, Mr. Chairman. I rise in opposition to the amendment. I view it as unnecessary. I think it's important to note that the underlying bill places universal requirements on issuers of all stripes. Issuers under the Stable Act must comply with strong risk management requirements, capital standards, and disclosure requirements. If you support consumer protection and innovation, you should vote for the underlying bill. I yield back.
Gentleman yields back. Any other comments? recognize myself, 4 or 5 minutes to strike the last word. Ranking Member, thank you for your amendment. My view is that the best way to share concerns about the review of any proposed regulations that's pursuant to the Stable Act is to make sure that we enact the Stable Act and that we can do that on a bicameral basis in the Senate and have it turned into law, because that will reinforce Congress's view on directing precisely how to oversee a federal pathway and state-federal relationship on issuing stablecoins in this country. And this law applies to every potential issuer. Same obligations to all issuers and the same protection to all consumers. If you want safeguards and guardrails and a level playing field for all issuers, then you should support the underlying ANS offered by Mr. Stile. If you want safe and secure, highly liquid assets backing all stablecoins under a strong minimum floor set by the federal government, you ought to back the Stable Act. We don't discriminate against entrepreneurs based on who they are or where they come from when it comes to federal legislation. This bill does not pick winners and losers, but creates a pathway for all issuers subject to very strict standards. Our regulatory agencies are subject to leaders confirmed by the United States Senate. The House and the Senate have the power of the purse and the power of oversight over those agencies and how they conduct themselves in implementing this law. So for those reasons, I don't believe that I can lend support to it. I urge members to reject the amendment by Mrs. Waters, and I yield back the balance of my time. Is there any other debate on Mrs. Waters' amendment to the ANS? If there's no further debate, the question now occurs on the amendment offered by Mrs. Waters of California. All those in favor of the amendment shall say aye. Aye. Those opposed should say no. No. In the opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted. Ranking member asks for a recorded vote. All those in favor of a recorded vote, please raise your hand. A sufficient number of hands being raised, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceeding on the amendment are postponed. Is there further amendment to Mr. Stiles' ANS? Mr. Liccardo of California recognized.
Thank you, Mr. Chair. I have an amendment at the desk titled Licard.
The gentleman has an amendment at the desk. Let's pause while the amendment is distributed. Mr. Stiles?
Mr. Chair, I reserve a point of order.
Point of order has been reserved. Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392 offered by Mr. Liccardo of California.
Without objection, the amendment is considered read. The gentleman from California is recognized for 5 minutes in support of his amendment.
Thank you, Mr. Chair. I'm going to strike the last word. I want to thank Chairman and Mr. Stiles for their collaborative approach with regard to this legislation. I'm a co-sponsor because I believe this is a long overdue first step to sensible federal regulation of stablecoin and, for that matter, of cryptocurrency. I didn't say it was perfect, though, and I don't think there's any such thing as perfect legislation, and I very much share Ranking Member Waters' very serious concerns, particularly in light of the very recent news that this president and his family are apparently engaging in this very industry that we are seeking to have the federal government regulate today. Obviously, this comes on the heels of the issuance of a Trump meme coin only weeks ago. I am introducing an amendment to prohibit federal officials, including the president, the vice president, members of Congress, and other senior federal officials, from sponsoring, issuing, promoting, or licensing payment stablecoin. One would think this would be a fairly self-evident and obvious proposition. We want to avoid the inevitable conflicts of interest that arise where the president's appointees, such as the Secretary of Treasury, are regulating the very product that provides unique and exclusive financial benefit to the president and his family. Secondly, we should expect substantial use of stablecoin, as is today, in international payments, and we should want to prevent corrupt foreign influence that could foreseeably result where foreign governments and business entities might seek to curry favor with this president or other federal officials through the use of the stablecoin. One could imagine, for example, if we had a member of the executive branch who owned a hotel chain and how that might get abused. Third, I think we want to avoid enabling anyone's kleptocratic instincts, and whether, regardless of who it might be that's involved in this business, let's all agree this is not a sensible business for elected federal officials or senior federal officials to be involved in. For that reason, I have offered this amendment. It's obviously part of a separate bill that I have already introduced that would prohibit federal officials, including members of Congress, from getting in the business of sponsoring or issuing any financial instrument, whether it's security, commodity, or digital asset. I yield back.
Gentleman from California yields back. Mr. Stile, do you still insist on your point of order?
I withdraw my point of order.
And Mr. Stile, you're recognized for 5 minutes.
I move to strike the last word. I appreciate my colleague's engagement on the underlying bill and his co-sponsorship of the underlying bill, but I do rise in opposition to the amendment is offered. I don't think it's necessary in line with the previous amendment offered. As noted previously, the bill places universal requirements on issuers of all stripes, and so if you support consumer protection and innovation, you should vote for the underlying bill, although this amendment is unnecessary. Mr. Chair, I yield back.
Gentleman yields back. Is there further comment on Mr. Liccardo's amendment? The ranking member is recognized to strike the last word.
I move to strike the last word. This amendment would provide important ethics boundaries for the president, vice president, and other public officials in the stablecoin ecosystem. We've seen unprecedented conflicts of interest in the current administration and their crypto ventures. Now, ladies and gentlemen, not only are we making those of us who believe that the president, his cabinet, members of Congress, others should not be owning crypto, they go even further with conflicts of interest within his administration. For example, David Sachs, the President Trump's crypto and artificial intelligence czar, is linked to a venture firm that has ties to the largest crypto index fund providers with significant amounts of cryptocurrencies. Trump listed in a Truth Social post tied to a crypto strategic reserve. In other words, Sachs stands to make a lot of money with a crypto reserve. Sachs claimed to have sold his personal and direct holdings, but mentioned nothing about his indirect holdings. So this amendment is a good step towards tackling the conflicts of interest present here, as this would prevent any administration insiders from profiting off this bill. Ladies and gentlemen, why am I so focused on these conflicts of interest headed by the President of the United States of America? We're in a very, very critical period of time in governance in this country with changes that are being led in significant ways by the President of the United States of America. He is, for example, decided that he was going to fire thousands of federal employees whose only income is what they earn working for the government. At the same time, he's enriching himself and his family. He has just about moved to make it almost impossible for Social Security owners to be able to get their Social Security checks because he's destroying the infrastructure of Social Security. So telephone calls will not be answered. Those who are attempting to apply for their Social Security cannot be taken care of. He's talking about getting rid of, in HUD, Section 8 programs that is a program that helps people to have a decent rental opportunity because they don't earn enough money to pay for the high cost of rent. It goes on and on and on, destroying the Consumer Financial Protection Bureau, where people have a chance to give their complaints to someone, get them investigated, and for all of the rip-offs that are going on, that they get taken care of and not be harmed and become victims of those rip-offs and fraud that we know is throughout our society. So it is not only that it is outrageous for the President of the United States and his family to own these cryptocurrencies, it is outrageous for others that are not even mentioned here in his cabinet that are involved to own and be a part of the crypto industry as they are, while people have started to suffer already, losing their jobs. I want to tell you, when Elon Musk went into some of these departments, he said, get out by 5 o'clock. And so we're depending on the courts to give us a little help now. We have some temporary decisions that are being made by some judges, have not gone into the final hearings yet, but people are suffering, not knowing. Even when we look at the stock markets, the uncertainty is causing us all kind of problems, and the stock market is losing and going down. What are we thinking about here? Why is it we want to protect the president and others in the cabinet for being able to enrich themselves on the backs of the American public while they're destroying the opportunity for people to have decent careers and a job that they have invested in for many, many years? This is outrageous. I support the amendment, and I still insist that if this committee wanted to exclude the government, and exclude the president and the members of Congress all from being involved in this way of ownership of stable coins, of crypto, we could do it. Why not?
Thank you.
I yield back.
Gentlewoman yields back. Is there further debate on the amendment? Chair recognizes himself. I'm sorry, I didn't see Mr. Lynch. You're recognized to strike the last word.
Thank you, Mr. Chairman. I fully support Mr. Liccardo's amendment. I think it's a common sense amendment. Let's think about this. So we have seen a pattern of collapse of these stable coins. It's been a steady march of these collapses, and then the government comes in. 2023, we saw the situation with Silicon Valley Bank. Circle was involved in that. They had $3.3 billion in uninsured deposits at Silicon Valley Bank. So the FDIC had to come in and rescue that. But there have been 60 other cases where these so-called stable coins have become unpegged to their underlying reference, whether it's the dollar or some other combination. So we know for certain. This isn't like scientific theory. Scientific theory, usually, if something fails, the next iteration will improve on that vulnerability and would correct that so it doesn't fail again. But here we have stablecoins that have failed, and now we have a whole new bunch that are going to fail, and now we're connecting them directly to the overall financial system. So we sitting here, it is a certainty because of all the history we've had, and nothing's changed, that these stablecoins are going to depeg and they're going to require a bailout. And now you have a president who's issuing his own stable coins and meme coins, and those are going to fail. And you got members of Congress that have become the darlings of the crypto industry, and so the American taxpayer is going to be the ultimate loser here, because you know that members of Congress will vote for the bailout. That happened back in 2008. We saw that happen. I voted against all the bailouts, by the way, because none of the guilty parties had to take a haircut, and some of them made a ton of money after they took down the economy. But in this case, the president is going to sign off at the end on the bailout for his company. So that's why Mr. Liccardo's amendment is so important, because there's a built-in conflict here. Look at Liberty World Financial. That's the Trump family, crypto company, and so the president will be put in a position, unless you adopt this amendment, the president will be put in a position where he will have the opportunity. He'll probably be happy to do it, but he'll sign off on a bailout for his own company at the cost of the American people, at the cost of the American taxpayer. So I know that Mr. Foster and myself, a number of us have talked about the bailout aspect of this, Mr. Caston as well. There's some amendments that also try to get at that, but I think Mr. Liccardo's amendment is a good one, and we should support it, and I yield back the balance of my time.
Gentleman yields back. Is there further debate on the amendment? Seeing none, I'll recognize myself for 5 minutes. I want to thank first Mr. Liccardo for being an outstanding new member of the committee. Thank you for being so engaged on the work of the committee, and thank you for co-sponsoring the underlying bill and trying to be constructive in improving the text of the Stable Act. I know Mr. Stile has enjoyed working with you. I appreciate your offering the amendment, but as I said in regard to the ranking member's amendment, if we really believe in having rules of the road, transparency, and assert the right way to do digital assets in this country, that I would invite members on both sides of the aisle to support the Stable Act and its vigorous, strong, transparent regulatory structure, supporting both a state and a federal framework, as well as, I have to say, also help us successfully introduce a market structure framework where the rules of the road, the oversight, the responsibilities, the legal ramifications of digital assets are made transparent and clear across the country. Also, I appreciate the ranking member's remarks about the importance of Article 1 and Article 3. We have a Constitution that works together with the separation of powers. I think they're all very apparent in working in the regulatory space and the space of recent weeks. So with that, I think this amendment is unnecessary. I urge my members on both sides of the aisle to reject it, and I yield back the balance of my time. If there's no further debate on this amendment, the question will now occur on the amendment offered by the gentleman from California. All those in favor of the amendment, please say aye. Aye. Those opposed, please say nay. Nay. In the opinion of the chair, the nays have it.
Is requested.
The gentlewoman from California requests a recorded vote. All those in favor of a recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is so ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, further proceedings on this amendment are postponed. Is there further amendment to Mr. Stiles' amendment of nature of substitute? Gentlewoman from California.
Not to his further amendment. I have a different amendment. All right, thank you.
For additional amendments, the gentlewoman from California is recognized.
I have an amendment at the desk.
We'll pause while it's distributed.
Mr. Chair, I reserve a point of order.
Mr. Stiles reserves a point of order.
This amendment would ensure. All right. Oh, she's passing out. All right.
Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Ms. Waters of California.
Without objection, the amendment is considered read. And now I recognize the ranking member of the full committee, Ms. Waters, to speak on her amendment for 5 minutes.
Thank you very much, Mr. Chairman. I have another amendment here at the desk. This amendment would ensure that the Trump administration cannot require the use of a stablecoin to enter into transactions with the government if the stablecoin issuer is affiliated with the president, vice president, members of Congress, or any other officer or employee of the United States and their families. Yes, this would also cover special government employees like co-president Elon Musk. We have already seen very concerning reports that the Department of Housing and Urban Development is looking into stablecoins for their grants. We have also seen experts caution that Trump executive orders would allow alternatives to the dollar for taxes and other payments to the government, including digital wallets. Now, Trump has his own stablecoin through his World Liberty Financial Project, and Elon Musk could be soon behind without any limitations on the separation of banking and commerce in this bill. We could see a world where the Trump administration starts to require the use of his and Musk's stablecoins in order to pay taxes or enter into other arrangements with the government. This would be just another in a string of egregious conflicts of interest with the Trump administration and Musk's dodge have taken so far. So, we must pass this amendment in order to stop this from becoming a reality. I urge members to support this amendment, and I yield back. Doge, I'm sorry. Let me just say this, that there are so many ways that ownership of cryptocurrency, starting with stablecoins, can be utilized by the president and others in his cabinet to basically increase their own, their profit, what they're investing in. This is so outrageous, it escapes me why members of Congress would not want to protect the public and listen to what Mr. Lynch just said about failures that would even could cause a bailout where the president would be in a position to fund his own bailout if, in fact, it fails. And so I would plead with the members of Congress, of this committee, to recognize the harm that is now being caused to our citizens and the ways that those who are being fired as government employees do not know what the future holds for them, that our Social Security recipients are frightened to death about whether or not they're going to get their Social Security checks. The Section 8 People who have been holding vouchers and those who are utilizing vouchers do not know whether or not they will have the rent to pay for decent and safe housing. And it goes on and on and on with an attempt to destroy the Consumer Financial Protection Bureau where they could file a complaint. What is it about what we are doing here today that does not recognize the harm that could be caused by the president and the cabinet and members of Congress from ownership of crypto, period, and stablecoins that we're discussing here today? I want you to know that town halls are being made all over the country, and mostly by Democrats, where people are asking questions. Some of the Republicans are refusing to participate in town halls because they cannot answer some of the questions in a way that would satisfy the public, that somehow they are not absolutely being interfered with and intimidated by the President of the United States and afraid that they're going to be primaried, that they will lose their opportunity to serve. Give me a break. The people sent us here to represent them, and yes, we may lose our positions in Congress if, in fact, we don't do the right thing, but that should be what happens. I yield back the balance of my time.
Gentleman yields back. Does the gentleman from Wisconsin insist on his point of order?
I withdraw my point of order.
Gentleman withdraws his point of order. Does the gentleman seek recognition?
Seek recognition, you strike the last word.
You are recognized for 5 minutes.
Thank you, Mr. Chairman. As I was reviewing this amendment, I actually had to check the date on the calendar. It felt like Groundhog's Day. It's not February 2nd, it's April 2nd. But here we are again. This amendment is unnecessary, as were the previous two. As noted, the bill places universal requirements on issuers of all stripes. So if you do support protection of innovation, but also protection of consumer protections, and support consumer protections, you should be voting for the underlying bill. I think we actually continue to hear arguments in support of the underlying bill as these amendments come forward. The amendment itself, though, is unnecessary. I do not support it, and Mr. Chair, I yield back.
Will the gentleman yield?
Gentleman yields back. Who else seeks recognition on Mrs. Waters' amendment? Mr. Lynch, you're recognized to strike the last word. You're recognized for 5 minutes.
Thank you very much. I enthusiastically support Ms. Waters' amendment. And the sponsor of the bill is correct. It does set the bill does set a framework for issuers of all stripes, but this issuer is the President of the United States and is in a position of trust. And he is invested in his, he's got his family's business, and they're going to be issuers. So it's the position of trust that the President is in. He is unlike any other issuer because he's the President of the United States. He's going to sign off on the bailouts, and he's going to take U.S. taxpayer money to assist his family business when it gets in trouble. That's why the ranking member's amendment, it makes such good sense. What we're creating here is a situation where we're authorizing the president to undertake self-dealing. So in this case, the president and the president's family will be on both sides of the transaction. So they will be, actually, in this case, they'll be on both ends of the transaction and in the middle, because they'll be, in their official capacity, the president will be supporting the industry. He'll be on the other end of the transaction because he'll gain the benefit of the deal, and he'll be in the middle because the issuer collects fees. So he'll be on both sides of the transaction, the very description of self-dealing. He'll be violating his position of trust with respect to the American people. And he'll have the benefit of being on both both sides of the transaction. So this is not unnecessary. This is of the utmost importance. And I think it's fair to say that if this was a Democratic president that was trying to do this, the Republicans' hair would be on fire. And rightly so, rightly so. But look, this should not be happening. This should not be happening. The guardrails that the sponsor and the chairman has talked about are very limited. They're loose. They're not tight guardrails. We've got huge gaps in this. When we look at the underlying market structure on this, my friends on both sides of the aisle have taken all the power away from the SEC. They've gutted that agency and taken away much of its responsibilities. They've pushed all the responsibilities over to the CFTC, which doesn't have the ability to police it. So you're creating a lawless situation, and you've also handcuffed the police so that they can't come to our rescue. This is all at the beck and call of the crypto industry because they've spent so much money up here on the Hill. That's just the truth of it. So I guess for our side, all I can do is try to limit the damage to the American taxpayer. That's what our goal is here, and limit the opportunities for the violation of the trust that the president and his family, if they're in official positions, owe to the American people. So with that, I would yield back my last 48 seconds to the ranking member if she'd like to use them.
Well, I thank you very much for yielding the last 48 seconds. I simply will continue to expose what is happening in our own government, where this president of the United States and his co-president are issuing executive orders in so many ways to take over our independent agencies. And I'm going to have another list that I'm going to expose where he moves to take over the Kennedy Center and on and on and on. What's happening here? Is this, a democracy, or are we recognizing the relationship with Putin and wanting to be like him?
Gentlewoman yields back. Is there further debate on the amendment, Mrs. Waters' amendment? Does the gentleman from Wisconsin have any, let's see, he's been called on, so I guess, hearing none, I'll recognize myself for 5 minutes. So once again, I want to urge my colleagues to not support this amendment from the ranking member in California for the reasons I've outlined before, which is that if you want a strong, transparent set of guardrails and framework for digital assets and certainly for stablecoins, you should support the Stable Act. It is not a weak bill. It is a strong bill. It has strong consumer protections in it, strong AML, BSA, cyber requirements in it, strong capital requirements, strong requirements for both bank and non-bank issuers to be fully vetted and fully supported under a high standard of a federal minimum floor of requirements. And I just would remind my colleagues, we live in a democracy. We're not picking winners and losers here. If you don't want to use a payment stablecoin, don't use one. We have Article 1 authority that governs how our agencies interact and issue regulations and how they interact with each other as it relates to whether they would use a payment stablecoin or not. I believe strongly in Article 1 and the oversight responsibilities of Congress. I don't believe this amendment is necessary, and I urge my colleagues to reject it. I will yield back. Is there any further debate? And the question now occurs on the amendment offered by the gentlewoman from California. Those in favor, please say aye.
Aye.
Those no, please say no. No. In the opinion of the chair, the nays have it. and the amendment is not adopted.
I require a recorded vote.
The gentlewoman from California requests a recorded vote. All those in favor of a recorded vote, raise your hands. Sufficient number of hands being raised. A recorded vote is so ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Is there further amendments? Gentlewoman from California, you're recognized.
I have an amendment at the desk.
We'll pause for the amendment to be distributed. Clerk will report the amendment.
I reserve a point of order.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Ms. Waters of California.
The amendment will be considered as read. The gentleman from Wisconsin has reserved a point of order. The gentlewoman from California is recognized to support her amendment.
Thank you very much, Mr. Chairman. First of all, I want to thank Mr. Lynch for co-sponsoring this amendment and all the work that he's done and the expertise that he's developed on crypto and the way that he has been explaining and talking about what is going on here today and why it is absolutely ridiculous for us not to exclude the president and his cabinet and members of Congress from ownership of stablecoins. Thank you so very much, Mr. Lynch. This important amendment would prohibit non-financial commercial companies from having their own stablecoins and maintain our country's vital separation of banking and commerce. The separation of banking and commerce has been in place to ensure that no firm in the United States gains too much power in the economy. After the Great Depression, Congress passed the Banking Act of 1933, which established the separation of banking and commerce to prevent the risks arising from banking and commercial conglomerates. The dangers of not separating banking and commerce include excessive concentrations of financial and economic power and political influence, conflicts of interest that would compromise the ability of banks to act as objective providers of credit and other financial services, and finally, heightened risk of contagion between the financial and commercial sectors of our economy. This would increase the likelihood of systemic crisis that could require a federal government bailout to avoid the devastating consequences. Under this bill, the lack of separation between banking and commerce means that Elon Musk can launch his own stablecoin. Other commercial companies like Walmart, Facebook, Amazon could also launch their own stablecoins. I've worked with my Republican colleagues to negotiate stablecoin legislation that would prevent wealthy oligarchs like Elon Musk and Mark Zuckerberg from profiting off of crypto schemes to defraud Americans out of millions of their hard-earned dollars. Elon Musk has long said he wants to transform X into a much larger platform and even praised WeChat, a Chinese mega app that combines chat, payments, and social media. He has very clearly stated that he wants to create something close to that with X, where people have to conduct their entire financial world on the app. However, experts have stated that apps like WeChat have been used by the Chinese government to violate users' data privacy. On top of that, big tech companies are already using AI to become even more powerful. Now we're allowing them to get into the business of banking as well. Meanwhile, the Republicans are attempting to overturn the Consumer Financial Protection Bureau's big tech rule. If they're successful, the CFPB will no longer be able to supervise big tech companies to ensure American consumers are protected from fraud, scams, and illegal data collection when they use these apps to make payments. Thankfully, the Republican rule aiming to overturn CFPB's failed yesterday. Thank God for the courts and what they're helping us do right now. Let me be clear. I'm for financial innovation if the everyday American is adequately protected from frauds and scams. So we need to make sure there are safeguards to protect consumers and their personal data. This importance of a clear line between banking and commerce is one of power in the economy. The Trump administration wants to keep his billionaire cabinet wealthy while he takes away Social Security checks from Americans, continue to order mass layoffs of federal employees across the country, and imposes tax on consumer goods, preventing one firm or a group of oligarchs from gaining too much power has been a long-standing principle in the United States. The risks are too disastrous for Americans who are already struggling to make ends meet in this economy. I cannot stress enough, we need to protect American consumers and investors in order to keep bolstering responsibility and innovation in our economy. So I urge members to support this amendment. And let me just close by saying, you saw the billionaires with the president at his inauguration. The big boys, the Billionaires Club, have decided that they're going to take over this government. Be damned the Constitution and democracy. The big boys have aligned themselves, the billionaires. Do they care about all these people who are losing their jobs? I don't think so. Do they care about the Social Security recipients? I don't think so. I yield back.
Gentlewoman yields back. Does the gentleman from Wisconsin insist on his point of order?
I withdraw my point of order.
He withdraws the point of order. Does the gentleman seek to be recognized?
Seek 5 minutes to strike the last word.
Gentleman's recognized to strike the last word.
Thank you very much, Mr. Chairman. The bill we're considering today sets strong standards for payment coin or stablecoin issuance in the United States, regardless of who is issuing the stablecoin. We're always looking for innovation and development, and it's always been really at the heart of financial services, from the ATM to online brokerages to peer-to-peer money transfers. Technology is always improving the financial services space, and the separation of commerce and banking is an important consideration in the banking context. The payment ecosystem is dynamic and ever-evolving, and so to place the exact restrictions of the Bank Holding Company Act on those who can or can't issue stablecoins that are not really a fit for the risks that exist. And I'm concerned, Mr. Chairman, that it'll really lead to a stifling of innovation. That being said, the concerns about companies acting in an anti-competitive manner can be addressed, and I'm happy to work with my colleagues to mitigate this concern, but in a more nuanced manner. So I'd urge my colleagues to oppose this amendment, and Mr. Chairman, I will
Will the
yield
gentleman
back.
yield?
I yield back.
Gentleman yields back.
Mr. Chairman?
Mr. Lynch?
Yeah.
Recognized to strike the last word.
Thank you. Thank you, Mr. Chairman. I'm actually a co-sponsor of this, this measure, so I want to thank the ranking member for working with me on this. This bill basically destroys the separation between banking and commerce that has been a wise construct in our financial system from its inception. And the breaking down of that barrier introduces a whole new set of risks. Think about this, especially with respect to these big tech companies. What we're going to do in this bill, we're going to allow Meta to start issuing stable coins. Meta, right now, has 3.35 billion daily users every single day. 3.35 billion. So if you don't think there's some competitive risks here, They are, remember, they were trying to do this before. Zuckerberg was trying to do Libra back in the day, and we squashed that because we knew that he would overpower all the competition out there because of look at the vast amount of information that he has already on every single American. 3.35 billion people. He knows, their purchasing habits. He knows a whole lot about individual families and individual citizens because he's been vacuuming up all their data for years. And now you're going to let him issue his own currency. And he's going to be able to, use that database, that collection of daily users, 3.35 billion people. I bet there are a lot of banks and some of these small startups that are worried about that. And so these are the people that you're supposed to be representing. These are other people in this competitive market that you're trying to create. You're creating, a couple of real giants. X has about 1 billion people, 1 billion people each and every day, regular users. Amazon has about 300 million. They're small in comparison. So these big tech firms are now going to be able to operate as banks and without any of the restrictions and responsibilities that you've put on regular banks in terms of how they deal with this, and how they deal with the public. What constrictions are on their conduct. You're creating a Wild West with 2 or 3 huge players that are going to be able to dominate this field. So I don't see the strong safeguards here. As I said before, in your market structure bill, the FIT 21 Act, you basically castrate the SEC. They can do nothing. You don't add considerably to the ability of the CFTC to deal with, especially players of this size. They're just going to steamroll the regulator, especially after you've taken all their power away. And then there's the state aspect of this. What do you think the matchup is going to be when Meta, with 3.35 billion daily customers and a barrel of money, goes up against the state of Wyoming with 600,000 people, less than I have in my congressional district, one state? I think they're going to be overpowered, and I think there's a real question out there. When we need to bail out these companies, when we need to bail out when the stable coins lose their peg, is it going to be the people of Wyoming that are going to pay that? Or is it going to be spread across the United States for all 50 states? They're going to have to step up as well. That situation still has to be addressed. With that, Mr. Chairman, I feel I'm repeating myself because some of these things are so common to different aspects of the bill, but I yield back.
Gentleman yields back. Is there further amendment on Mrs. Waters' amendment? So I'll recognize myself for 5 minutes. I recognize certainly the element of repeating oneself here this morning. I appreciate Mr. Stiles' constructive comments on this discussion about separation of banking and commerce, and I thank Mrs. Waters and Mr. Lynch for raising this issue today. I want to just take a minute and elaborate on why placing the Bank Holding Company Act restriction on stablecoin issuers and some other aspects of the language of their amendment I don't believe is fit for purpose to address this issue, and I just don't think it fully addresses my colleagues' concern that they've expressed. First, the list of financial activities in the Bank Holding Company Act, which was passed back in 1956, was updated in the 1990s by Graham Leach. The current list of financial activities does not contemplate any kind of digital asset activities, which I think we would all on both sides of the aisle agree are financial in nature. In our market structure bill from last Congress, Fit 21, we exactly defined market participants and activities that we all agreed were financial in nature in a digital asset context. And I think that is a good illustration of how I think we can work together on this topic as the bill progresses. It's my intent today to move the Stable Act as we have it today, and as I've noted many times publicly, I want to make sure that we move a market structure bill in conjunction with it as we make progress here in the House. Moving both allows us to contemplate this issue in its full manner and would allow us to address a whole host of other issues that arise if we only focus on one bill, the Stable Act, versus a companion market structure bill. So I look forward to working with Mr. Stile, Mr. Lynch, and Ms. Waters, and other colleagues to provide a thoughtful solution in this topic on separation of commerce and banking. I'll make certainly personally a good faith effort to do that, but I do urge my colleagues to reject this amendment in its current form and yield back the balance of my time. If there's no further debate, the question now occurs on the amendment offered by the gentlewoman from California, Mrs. Waters. All those in favor, please say aye. Aye. All those opposed shall signify by saying no. No. In the opinion of the chair, the noes have it. The noes have it, and the amendment is not agreed to.
Recorded vote requested.
The gentlewoman has requested a recorded vote. All those in favor of recorded vote, please raise your hands. A sufficient number having raised their hands, a recorded vote is so ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, further proceedings on this amendment are postponed. Is there further amendment on Mr. Stiles' ANS?
Mr. Chairman, I have a few amendments at the desk.
Fantastic news.
I know that would surprise you.
I'm not shocked. I'm thrilled to death. Mr. Sherman has an amendment at the desk. We'll pause while it's distributed.
Mr. Chairman,
do you have your amendments noted by number?
I believe staff has arranged for this to be the amendment regarding certain governmental officials with over $10 million in crypto assets.
Okay, well, we will pause for that amendment to be distributed.
Mr. Chairman, I reserve a point of order.
A point of order by the gentleman from Wisconsin has been reserved.
Does it have the word 10 million in it?
Yes.
Is that the one?
Yes,
Yeah.
that's the one.
Have you laid these out for them? Yeah. And you have one A in case this one gets point of order. Why?
Because they're doing buckets. So they want to do this person is about Trump, then they have to do about consumer protection.
Okay. Well.
Clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Sherman of California, designated as 31.
Thanks, the clerk. And now I recognize the gentleman from California, the ranking member of our Capital Markets Subcommittee, Mr. Sherman, recognized to support his amendment.
Mr. Chairman, I will have a number of amendments to this bill. I have no illusions. I've been in this town for a long time, and I've always seen that when all the money, power, slogans, AstroTurf, and extremely high-priced consultants are on one side, and there's nothing on the other, that the side with the money, the power, the lobbyists normally prevails. That being said, I will point out to my colleagues that there is one of these amendments, because you'll have a tendency to just want to oppose them all, that you may want to think very hard about opposing. Not this one. You'll probably, my Republican friends will probably happily vote against this one, but the next one that I have on no bailouts is one that you're going to want to think a lot about. As to this amendment, there is no part of the financial world that has been more subject to fraud, Ponzi schemes, wrongful actions of all sorts than the crypto world. And there is no greater disinfectant than sunlight. Now, we are all members of Congress, and we'd like to think we're important, and that therefore it's appropriate that we make sure that all of our decisions are made without a conflict of interest that is not disclosed. And that's why we all, with some great joy, fill out our financial disclosure statements and at least let the world know of every one of our transactions. And the world needs to know because we believe we are important. But I've got news for most people in this room. You're not as important to governmental decisions these days as President Trump or Elon Musk. And so if we're going to have disinfectant in this area, we need to know what conflicts Trump, Musk, and other members of the cabinet have. This bill applies only to those who have over $10 million invested in stablecoin and other crypto assets. We know that the president fits into that category, and there's substantial reason to believe that Mr. Musk fits in that category. Donald Trump has 4 coins. Now, we've already seen Elon Musk's situation. You see, the day President Trump was elected, Musk knew that there'd be an important organization that he would head that would be very cool in the eyes of the Republican Party. But only he knew that it would be named after a meme coin. So for 1 week he had that knowledge. God knows who else had it. The election of Donald Trump caused all cryptos to go up. Bitcoin went up 22%. Dogecoin went up 6 times as fast. Some $37 billion was earned by persons unnamed who knew for 1 week between the election of the president and the announcement of the name that this coin would be more valuable. So let us bring the disinfectant of sunlight. Let us require that we know as much about the investments of Elon Musk in crypto as the world knows about any of our investments in crypto. Everything disclosed. And if a cabinet member has only modest investments in crypto, they're exempt from this bill. Otherwise, we will have to wonder, what are the motivations? Who is gaining? So who wants to speak against disclosure? Who wants to say that conflicts of interest should be unknown? Who wants to say that those who claim to be in public service are free in an undisclosed manner, hiding under the table to profit from their decisions? Let us at least bring the attention of the public to these investments. And with that, I yield to the ranking member.
Thank you very much, and I appreciate it, and I certainly support the amendment. I want to ask you something. I just had an amendment earlier that was about the independent agencies now being excluded from the rule of development, and that the president has said, you know, all rules come to me so that I can see them and deal with them, whatever. Would your disclosure help us at all with that?
Well, the disclosure would apply to the special government employee and all the cabinet members and the president, and I think those are the people making the decisions.
Gentleman yields back. I withdraw my previously made point of order. Is there further debate on the amendment? Seeing no further debate, I recognize myself for 5 minutes to strike the last word. I appreciate Mr. Sherman's interest in the space, but this amendment is outside the scope of the bill, as the amendment applies broadly to all digital assets, not just payment stablecoins. Last Congress, the majority worked closely to address concerns from some of our Democratic members about members of Congress owning digital assets. For example, in our own market structure bill would be a more appropriate forum for that conversation. Note that members of the cabinet are subject to a robust confirmation process in the United States Senate through which financial disclosure forms are filed. And so I would urge my colleagues to oppose this amendment, and I yield back. If there's no further debate, the question now occurs in the amendment offered by the gentleman, Mr. Sherman from California. All those in favor signify by saying aye.
Aye.
All those opposed, nay. In opinion of the chair, the nays have it. The nays have it, and the
Recorded
amendment.
vote requested.
A recorded vote has been requested. All those who favor recorded vote, please raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3. The committee rules further proceedings on the amendment are postponed. Is there
Mr. Chairman, I have another amendment at the desk that's very similar to this amendment, but addresses your issue, so I'll bring that up.
There's an amendment at the desk that we will pause while the amendment
This is, I guess, Sherman Amendment 1A, very similar to the last one, except it deals only with stablecoin and not with other crypto assets.
We'll pause while the amendment is distributed. I reserve a point of order. The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 2392.
Without objection, the amendment is considered read. The gentleman is recognized on his amendment for 5 minutes.
This is the same amendment as the last one, except it deals with the the acting chairman's concerns. He thought that an amendment of this type should only deal with stablecoin and not deal with other crypto assets. This amendment deals only with stablecoin and not with other crypto assets. The opportunity for corruption is in this space is enormous. All a cabinet officer has to do, all a special employee has to do, all the president has to do to accept unlimited, undisclosed gifts is create a coin and then see who buys it. And you buy the coin, the money goes right into the creator's pocket. In return, you get some code, a quote digital asset, nothing more than a non-fungible token. And the president has your US dollars, or the cabinet member has your US dollars. We may have seen a tiny portion of this when Hunter Biden was selling his artwork, but at least he wasn't a governmental official, and at least there was a physical item of art. But here, why do we even have all this disclosure stuff that you and I and cabinet members fill out if we don't disclose the easiest way to bribe a important governmental decision maker? And that is to have them make a coin and out of thin air and say, and we've seen this. We saw this I've charted Mongoose coin. In this room a couple of years ago, I said there wasn't a Mongoose coin. People created a Mongoose coin, and for a while it was worth millions of dollars. They owned it all. They said it was worth millions of dollars. There were a few transactions involved with it. And if you wanted to enrich the creators of Mongoose coin, all you had to do was buy Mongoose coin. And your name was not disclosed, and the creators of Mongoose coin had US dollars in return for Mongoose coin, which they had just created a few hours ago. So if we want unlimited bribes, totally undisclosed, available to the most important decision makers in government, then we must defeat this amendment. With that, I would yield to any of my colleagues that would like to speak. And seeing none, I yield back.
The gentleman yields back. Is there further debate on the amendment? Seeing none, I recognize myself for 5 minutes to strike the last word. Appreciate the adjustment that my colleague from California made per my previous concerns of the previous amendment, but this also is unnecessary. Also is best addressed inside the market structure aspect of our two-part bill, or two bills that will ultimately come before the committee. It is a distraction in the underlying text. I would urge my colleagues to oppose the amendment, and I yield back. If there's no further debate, the question now occurs in the amendment offered by the gentleman from California. All those in favor signify by saying aye.
Aye.
Those opposed, nay. In the opinion of the chairs, the nays have it. The nays have it, and the amendment is. The gentlewoman has requested a recorded vote. All those in favor of a recorded vote, please raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to Section C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Is there an additional amendment?
Mr. Chairman, I believe I have an amendment at the desk.
The gentleman has an amendment at the desk. We'll pause while it's distributed.
Right. That's a great amendment.
Does Mr. Downing, the gentleman from Montana, reserve a point of order?
Mr. Chair, I reserve a point of order.
The gentleman reserves a point of order.
Yeah.
Thank you, sir.
The clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to
Without
HR
objection, the amendment is
2392.
considered, the amendment is considered as read, and the gentleman is recognized for 5 minutes for his amendment.
Thank you, Mr. Chairman. Mr. Chairman, my amendment would limit the activities. So what I'm trying to do here is, because we've had such a long and strong history of these stable coins collapsing, they are not stable. That's a misnomer. And because we've had a steady drumbeat of bailouts to restabilize those coins, where the FDIC has come in, as in the situation with Silicon Valley Bank. What I'm trying to do here with this amendment is create a firewall. Since we have seen, I think, 60 of these stable coins fail, they collapsed, they had to be rescued. What I'm trying to do here is to create a firewall around the American taxpayer so that they don't get stuck with the bill on the stable coins that you are now, that the bill is now authorizing. So this amendment would limit the activities of stablecoin issuers to those that are directly related to the essential functions of issuing a stablecoin. Specifically, this includes activities such as issuing or repurchasing or transferring stablecoins or acquiring and managing the reserves that are supposed to back up those stablecoins. They can also provide custody services and any other activities that are necessary to carry out the core functions of a stablecoin issuer. What this tries to get at is the fundamental separation between banking and commerce. In the Bank Holding Company Act, Congress made a very wise decision and said, if we allowed banks to get into commercial activity, it would create such a huge risk of major contagion across our economy that it's a danger that we will not abide. And so they require that separation. This amendment would follow in line with that thinking, especially with respect to commercial activities that are speculative or high-risk ventures that we've seen time and time again lead to catastrophic results. That happened back in 2008, and I'll talk about that in a minute. What I'm concerned about is the language that would allow stablecoin issuers in this bill to undertake such non-payment stablecoin activities that are allowed by the primary federal payment stablecoin regulator, close quote. So this opens a door to unchecked activity and creates issues for regulators at both the state and federal level by creating a dangerous loophole. It would allow issuers, stablecoin issuers, to engage in activities such as lending or other high-risk investments that have directly contributed to financial stability in the past. I point to the 1980s. We had the savings and loan crisis, compounded by lax capital requirements that taught us the hard way that allowing companies to engage in speculative and high-risk activities has long-term damaging effects on our economy. And similarly, the authorization of subprime mortgages. Remember we did that by the OCC and the Federal Reserve. That led to the subprime mortgage crisis. I think it required $787 billion of taxpayer money to bail that one out, which triggered the 2008 financial collapse. So we can't afford to repeat those mistakes. By adopting this amendment, we can protect our financial system from the hazards of excessive risk-taking. We will limit stablecoin issuers to activities that are directly related. So this allows some of your bill to go forward. It allows stablecoin issuers to maintain those activities directly related to their core function of issuing a stablecoin. This is a sensible and precautionary step to ensure that we do not expose our economy and our taxpayers to unnecessary high-stake gambling with taxpayer dollars or the stability of our financial system. So I urge my colleagues to support this amendment, and unless there are other members that need 30 seconds, I will yield back the balance of my time. Thank you, Mr. Chairman.
The gentleman from Massachusetts yields back. Does the gentleman from Montana insist on his point of order?
Mr. Chair, I withdraw my point of order.
The member withdraws his point of order. Is there further debate on the amendment? The ranking member of the full committee, Ms. Waters, is recognized for 5 minutes to strike the last word.
I move to strike the last word. This important amendment would ensure that payment stablecoin issuers are limited to certain activities. Republicans have added in a glaring loophole that would allow issuers to undertake non-payment stablecoin activities that are allowed by their regulator. This extremely broad provision could mean that issuers could perform tasks like lending and could have significant impacts on our financial system. For example, the Conference of State Bank Supervisors, or that is CSBS, sent a letter highlighting a number of concerns with the bill and pointed out that not having proper limitations on activities for issuers in concert with preemption of state authority would mean states would no longer be able to, quote, protect consumers in their state by licensing, regulating, and supervising money transmitters, payday lenders, consumer lenders, mortgage lenders, and other non-banks that are connected to a stablecoin issuer. CSBS also wrote that the bill would, quote, effectively centralize power over a nascent industry in a single federal agency and, quote, create an unsafe environment where the OCC can pick winners and losers across the financial services industry, substituting a single agency lender's judgment for that of the states and Congress relative to consumer protection and safety and soundness. And so, members, as I have pointed out, the conflicts of interest and urge my members to ensure that the President of the United States, his cabinet, and even members of Congress could not own stablecoins or crypto. There are other concerns with this bill, and I have been working for a long time with the former chair and with Mr. Hill on trying to work out these issues and come to some agreements. We've not been able to do that with all of the concerns, but I even offered, even today, that if amendments could take care of some of these concerns. Well, the opposite side of the aisle have been less cooperative on everything that has been offered to make this a good, sound bill that did not in any way allow for the conflicts of interest that are obvious in the bill. And so I expect that they will not support this amendment. But this is evidence that not only the huge issues that we have that are concerned with this bill are not even recognized or cared about at all, as we're going through this difficult time in the history of this country. Again, I will repeat, where there are recipients of the support of their government that are being yanked out from under them. At a recent meeting that I had about Medicaid, and I asked all of the people in the room if they were ones that participated in Medicaid or their family, almost 100% of the hands went up in the room. And while we're trying to protect all of the recipients of government assistance, at the same time, we are helping the President of the United States and his cabinet and others become owners where they will enrich themselves, where they will increase their access to these opportunities. And so I'll keep mentioning this because it's outrageous for the opposite side of the aisle to not have anything that they care about as it relates to whether or not there's a conflict of interest, or whether or not the public is being harmed, or whether or not the people working for the government are being fired and told to get out of their offices by 5 o'clock, or whether senior citizens are going to get their checks, or where Medicaid is going to help people who cannot afford, proper medical care to be able to stay alive. This is outrageous, but I will keep mentioning it over and over and over again. I yield back the balance of my time.
Gentlewoman yields back. Is there further debate on the amendment? Seeing none, I recognize myself for 5 minutes to strike the last word. I appreciate the intention of my colleague from Massachusetts in regards to this amendment. I note that the underlying restrictions of activities in the bill in Section 4, paragraph 8, is actually pretty robust. In the amendment as offered would effectively strike subsection G, undertake such non-payment stablecoin activities are allowed by the primary federal payment stablecoin regulator. And my concern is that by doing that, we would be restricting options for market participants to engage in innovative and helpful activity. And so I think the amendment, therefore, does not move us in the right direction. I think the underlying text is best as drafted, and I will oppose the amendment, but appreciate the efforts of my colleague from Massachusetts. If there's no further debate, the question now occurs on the amendment offered by the gentleman from Massachusetts. All those in favor signify by saying aye.
Aye.
All those opposed, no. No. In the opinion of the chairs, the nays have it. The nays have it, and the amendment is not adopted.
Requested roll call.
A recorded vote has been requested. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3. The committee rules further proceedings on the amendment are postponed. Is there an additional amendment? The gentlewoman from Texas, Ms. Garcia, has an amendment at the desk. Very good. We'll pause while the amendment is distributed.
Okay.
Does the gentleman from Montana, Mr. Downing, reserve a point of order?
Mr. Chairman, I reserve a point of order.
The gentleman reserves a point of order. The clerk will please report the amendment.
An amendment to the amendment in the nature of a
Without
substitute
objection, the
to
amendment
HR.
is considered read. The gentlewoman from Texas, Ms. Garcia, is recognized for 5 minutes on the amendment.
Thank you, Mr. Chair. My amendment is very simple and short. It protects consumers by making sure we don't let stablecoin issuers buy people's favor. Since we've been talking a bit about history today, so let's look a little at history in banking. One of the key flaws that led to the Great Depression was that banks didn't hold enough in reserves. But as credit markets expanded in the early 1900s, another problem emerged. Banks started using credit as leverage, not just financially, but competitively. Businesses and families needed loans to grow, to buy homes, to keep things running. And banks realized they could use that need to push other incentives, like a toaster. Or maybe soon you can get a free ride for a week on a Tesla, or maybe a free weekend stay at Mar-a-Lago. They sweetened the deal with a little perk, and perks do get people's attentions, one that might have been too good to refuse. You all know it. You walk into a bank and they try to upsell you. Choose our bank over the one across the street and we'll give you a toaster. But there's always a catch. You only get the toaster if you open their premium account, which is going to cost you more, or you open another line of credit and you can't buy the toaster from us. The toaster wasn't really free. It was bait, a reward for locking in with that bank and locking out the competition. Now, fast forward to today, again, we could get a free ride on a Tesla for a week or maybe a weekend stay at Mar-a-Lago. So if we're embarking on building a new financial system around stable coins, let's be clear, there's no such thing as a free lunch. No free toaster, no free use of a Tesla for a week or a weekend stay at Mar-a-Lago, and definitely no free stable coin. If we don't put limits in place, we're going to see the same old tricks wrapped in some new paper. Waive your fees if you use our coin. That's not innovation, that's coercion. That's anti-competitive. Congress has regulated this kind of behavior for decades. There are clear rules and clear exemptions. Stable coins cannot be one of them. This is why my amendment would make sure they don't get special treatment just because they're the new shiny financial product hiding behind a wall of innovation. It makes sure they play by the same rules that our traditional banks use. And, Mr. Chairman, this amendment is very necessary to ensure that our consumers are protected. Thank you, and I urge the adoption of my amendment.
The gentlewoman yields back. Does the gentleman from Montana insist on his point of order?
Mr. Chairman, I withdraw my point
The
of
member
order.
withdraws his point of order. Is there further debate on the amendment? Seeing no further debate, I recognize myself for 5 minutes. While I appreciate the intentions of my colleague from Texas, as the previous amendment I noted, I share the same concern that this amendment would stifle innovation and competition. And the amendment could actually, I think, be counterproductive and limit the variety of products that are available to consumers, denying them the choice to take advantage of benefits that they see. And so while I appreciate the intention in which it is offered, I recommend a no vote on the amendment. If there's no further debate, the question now occurs in the amendment offered by the gentlewoman from Texas. All those in favor signify by saying aye. All those opposed, no. The noes have it, and the amendment is not agreed to.
We ask for a recorded vote.
We'll call that timely. A recorded vote has been requested. All those in favor of a recorded vote, please raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3. The committee rules further proceedings on the amendment are postponed. Is there an additional amendment? Ms. Tlaib has an amendment at the desk. We'll pause while the amendment is distributed.
Mr. Chairman, I reserve a point of order.
The gentleman reserves a point of order. The clerk will report the amendment in a moment.
An amendment to the amendment in the nature of a substitute
Without
to
objection,
H.R.
the amendment is considered as
2392.
read. The gentlewoman from Texas is recognized for 5 minutes on her amendment.
From Michigan, but it's okay.
I apologize. For the record, the gentlewoman from Michigan, Ms. Tlaib, is recognized for 5 minutes. I apologize.
Thank you, Mr. Chair. I just want to read directly from it. It's a very simple amendment, but it says a special government employee may not have any ownership interest in a payment stable coin issuer. This is important because I'm really incredibly troubled by the massive conflicts of interest which this bill fails to address. I'm actually really looking forward to Representative Sherman's amendment for no bailout, especially if we can't have these protections in place. We all know the President of the United States issued an executive order requiring all regulatory agency rules must be approved by the Office of Information and Regulatory Affairs within the Office of Management and Budget. This means, for folks that are listening, this means the President and those in the administration can press for changes to agency rules, which is a conflict, having them oversee their own conflict. In the present context, Trump, everybody knows this, Trump and his family have strong financial interest in stablecoins right now through their stake in the World Liberty Financial. We also know that Elon Musk, and a special government employee, wants to issue his own stablecoin with his new payments app. We know that the president and those in the administration, like Elon Musk right now, should not at all, because of their conflicts, be able to change agency rules overseeing and regulating those activities. So that's the motivation of this amendment. Many of our constituents can come together and say, look, we can't have corruption within government. They already have a high increase of distrust for many of us here serving in Congress, and it's because we do not stand up against corporate greed and conflicts of interest. They think we're here, again, rigging the system, which it is, and not fixing it, again, to make sure that we have some sort of oversight and, again, accountability. This amendment, Mr. Chair, would ban special government employees like Elon Musk, again, from owning a stablecoin issuer. This is a simple amendment to blatantly push back against any blatant, again, conflict of interest. And so I hope my colleagues would support this amendment. It's incredibly important. Again, I don't want us continuing to bail out those that are driven by corporate greed, and the conflict of interest is right in our face, and we, again, must, again, have these protections in place. With that, Mr. Chair, I reserve my time, but yield back.
The gentlewoman yields back. Does the gentleman from Montana insist on his point of order?
Mr. Chairman, I withdraw my point of order.
The gentleman withdraws his point of order. Is there further debate on the amendment? Seeing none, I recognize myself for 5 minutes to strike the last word. Appreciate my colleague from Michigan bringing forward her amendment. I'd note our underlying bill sets forward common, universal applicable standards to prevent fraud and ensure stablecoin reliability. Every issuer has to meet the same high bar. And similar to the other amendments that were raised in bringing up similar issues, this bill is not about singling out individuals. It's about universally applicable rules of the road and universal protections for American consumers. We have to protect American consumers with substantive payment stablecoin legislation that ensures these products are supported by safe and secure assets, that American consumers can have confidence in stablecoin circulation. And so with that, I encourage my colleagues to oppose this amendment. There being no further debate on the amendment, the question now occurs on the amendment offered by the gentlewoman from Michigan, Ms. Tlaib. All those in favor signify by saying aye.
Aye.
All those opposed, no. In the opinion of the chairs, the nays have it. The nays have it, and the amendment is not adopted.
Mr. Chair, can I request a record roll?
The gentlewoman from Michigan requests a recorded vote. All those in favor of a recorded vote, please raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3, the committee rules. Further proceedings on the amendment are postponed. Is there an additional amendment? Mr. Sherman is...
Yes, I have an amendment
at
at the desk, this one dealing with no bailouts.
The gentleman has an amendment at the desk. We'll pause while the amendment is distributed.
Mr. Chairman, I reserve a point of order.
The gentleman reserves a point of order. The clerk will please report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Sherman of California,
Without
designated
objection,
as
the amendment is
35.
considered read. The gentleman is recognized on his amendment.
I know my Republican colleagues are primed to vote against all amendments, but this one you're going to want to think about. Take advice from a guy who's lost his hair in the service of his country. I was here in 2008. You do not want to go home and tell people that you are pro-bailout. In particular, when we did a bailout in 2008, we were bailing out the biggest banks in the country. At least that had some relevance to our constituents. Most of our constituents work for companies that do business with the big banks. Most of our constituents have accounts themselves in the big banks. And even then, the bailout of the big banks was the least popular thing Congress has done this century. Well, now we have a situation where it is just a few billionaires and maybe 1 or 2% of the population that is actively involved in crypto. Fewer will be involved in stablecoin. And yet they expect a bailout if they're fraud, if their bad business practices, if their high risk causes them to need one. So you need to draw a line here. The chairman, when he was here, told us, if you don't want to use crypto or you don't want to use stablecoin, don't do it. Well, that's fine, until they use your taxpayer dollar to bail out a stablecoin you chose not to invest in. So what would it mean if this amendment is voted down? It would be a symbol, a statement to the entire crypto industry. Congress is ready to bail you out. The Republicans voted to allow Congress to allow institutions to bail you out. The Fed might bail you out. The FDIC may bail you out. And when Congress had its one vote against bailing out stablecoin, they said, bail them out. Do you want to go home and explain that? Go right ahead. Some of your colleagues from 2008 didn't come back. And what they were bailing out has far more relevance to the vast majority of Americans. Now, I know how powerful the crypto industry is. I know they've got all the money, they've got all the power, they've got the lobbyists, they've got the AstroTurf. They've got the most expensive consultants cryptocurrency can buy. No, they don't pay them in cryptocurrency. Those lobbyists are too smart to accept payment in cryptocurrency. They've got the best consultants US dollars can buy. And they want you to vote for them on everything, but they especially want you to vote against this amendment because they want to create an image that they are the same as the banks, that they are pillars of the economy, and if they get in trouble, they will be bailed out, and therefore your money is safe, even when Sam Bankman-Fried's cousin takes the assets to Brazil or the Bahamas. So let's see if you can simply vote against. Now, I will say, the bill contains language that says that stablecoins are not backed by the full faith and credit of the United States. That is obviously not sufficient to provide bailouts. CDs at the Bank of America do not have the full faith and credit of the United States, but we bailed them out. Bank accounts at Citibank do not have the full faith and credit of the United States, but they were eligible for a bailout. Do you want to go home and say, I was so dependent on the crypto industry that I cast a vote facilitating a bailout of stablecoin? If you do, go right ahead. But when you do, you will be sending a message that will be embraced by all of the Twitter sphere, all of the folks that are trying to promote stablecoin and other crypto, and say, don't worry. We don't need audits. We've got a bailout. They voted to bail us out if we need a bailout. And voting against this amendment is voting to send a signal that you're ready to vote to bail them out. Or to let the Fed bail them out without a vote, if you can figure out how to do that. And the smartest lawyers in the country will try. So you probably want to vote against all my other amendments. You're going to want to vote for this one. I will yield to any member who wishes to speak. And seeing none, I yield back to the chair.
The gentleman yields back. Is there further debate on the amendment? Seeing none, I recognize myself for 5 minutes to strike the last word. Before I do, does the gentleman from Montana insist on his point of order?
Mr. Chair, I withdraw my point of order.
The gentleman withdraws his point of order. The chair actually will recognize Ms. Garcia for 5 minutes to strike the last word.
Thank you, Mr. Chairman. I appreciate my colleague, Representative Sherman, for offering this sensible amendment to broadly make sure Congress is not leaving taxpayers on the hook for the risk-taking of stablecoin issuers. I have shared my concerns about how inappropriate it is for Trump and Musk to write the rules of the road for everyone while they profit off of it with their own stablecoin issuers. If Republicans are unwilling to prohibit Trump from enriching himself through the stablecoin framework, I would hope they might be open to at least ensuring that taxpayers are not required to bail out stablecoin issuers soon to be owned by President Trump and his co-president, Elon Musk. Earlier in the debate, the chairman said that if you don't want to use a payment stablecoin, they don't have to use one. Okay, well, using that same logic, I hope that he would agree that American taxpayers should not be asked to bail out stablecoin issuers either. I urge members to support this amendment, and I yield back.
The gentlewoman yields back. Is there further debate on the amendment?
Mr. Chairman?
The gentleman, Mr. Lynch, is recognized for 5 minutes to strike the last word.
Thank you. First of all, I wholeheartedly support this amendment. This is really getting at the nub of it. We're worried about the consequences of this reckless action having dire consequences on the American taxpayer. And let's think about this too. Every bailout is going to increase the national debt. So the one we did in 2008, I voted against it twice, but it passed. That cost us almost $787 billion. So that's part of that debt that's overhanging us right now. So each and every one of these failures, and there will be many, because it's the nature of these stable coins to fail, right? We've seen it over and over again. Even the best, even Circle broke the buck, and they're supposed to be like the model in the industry, and they haven't been able to operate without federal assistance. So what this would do is just take the taxpayer off the hook. That's what Mr. Sherman's amendment does. Takes the taxpayer off the hook, and it will stop these stablecoin issuers from coming to you, to Congress, for a bailout. So we can stop this whole process. You can just say to them, you know what, it's against the law. We can't do it. Sorry. And just end it right there. What I'm afraid of, though, is that they've spent so much money up here on the Hill, and the president is fully invested in this. He's got he just launched his 4th crypto currency in the matter of a year. His family has just opened a whole new line of business on crypto. So I think that whole fact has introduced a level of recklessness in the industry. All these crypto bros, they're like, this is great. This is great. We're going to take private risk, private gain, and then any losses we could just push on to the American taxpayer. It's perfect. It's the same thing that Goldman Sachs did back in 2008. They made a barrel of money, $9 billion. We bailed out AIG, and that money went directly to Goldman Sachs. They didn't even take a haircut. So that's the plan here, is to take advantage of the American taxpayer through their representative and through their president, and to take great risks with these stable coins, and then be insulated from the consequences when they fail. That way, they socialize the costs to the American taxpayer, and they privatize the gains, right? Because we don't have any clawbacks in place right now. I'll introduce one, but we don't have any clawbacks. So these company executives will be able to keep their profits, and then when business goes south, they'll be able to export their losses to the American taxpayer. That's the game here. That's the whole game. That's what this is all about. These stablecoins have failed over and over and over again. This shouldn't be the Stable Act. They should be calling this the Titanic, because it's going down. It's going down. We just know that because we've been watching this game for a long time now. Even the quote best of the stablecoins have broke the buck and needed a bailout, and nothing's changed, except they spent a ton of money up here on the Hill, and now they've got members on both sides bamboozled into thinking that this is something that they should support. So it's a sad commentary, I think, on the way our political system works, but that's a whole other issue. So unless my colleagues need additional time, I'll yield back. Thank you.
Gentleman yields back. Is there further debate on the amendment? Seeing none, I recognize myself for 5 minutes to strike the last word. I would agree with my colleague, Mr. Chairman, on our joint goal of making sure that taxpayer money is not used to bail out stablecoin issuers. And I would note for the record, the Stable Act explicitly states that stablecoins are not backed by the full faith and credit of the United States government, are not subject to FDIC or NCUA insurance, and requires the disclosure of this information on every issuer's website. Furthermore, we create a strong risk management framework in this bill to make sure that we address the concern that you just brought up. However, without adequate time to review the text before us, I'm going to urge my colleagues to oppose the amendment, but I would be happy to work with you and all of my colleagues on this committee as we move forward towards the House floor to make sure that your concerns are addressed. But I think it's important to note that the underlying structure of this bill actually puts forward a robust framework for stablecoin issuers in the United States to lessen the risk that you identified in your remarks regarding your amendment. And so I appreciate the intent.
Will the gentleman yield?
I will yield.
Robust framework. That means that they hopefully won't go bust. But of course, the biggest banks, they have a robust framework. They needed a bailout. And now we have a major member of Congress telling all the crypto investors, you can rely on this.
No, I'm going to reclaim my time. I'm going to reclaim my time because that is a.
Well, you can rely on a robust
I've reclaimed my time. The time is mine. I would note. I think that's a misleading statement of what is being said. I think we're actually saying is explicitly in the bill that these are not backed by the full faith and credit of the United States government, that they're not subject to FDIC or NCUA insurance, and requires disclosure of that fact. We're putting forward a robust framework to make sure that these stablecoins are backed by the U.S. dollar in cash and cash-like equivalents. I respect the concern that my colleague brings, and truly am open to working with you or with others who share that concern as we work to refine this bill prior to passage on the House floor. I'll note that I did not receive this amendment substantively in advance, a limited time to review, so I'm urging my colleagues to vote no, but I truly do appreciate the spirit and intent in which the amendment was given. Is there further debate?
Green from Texas.
Mr. Green is recognized for 5 minutes to strike the last word.
Thank you. Mr. Chairman, I'd like to associate myself with the comments made earlier by the ranking member. And I, too, will not sign on to capitulation legislation because that's where we are. Either we capitulate and agree to what you have, or we don't sign on. I will not sign on, and I would yield my time to Mr. Sherman.
Let us compare the situation that we're setting up for the future to where we were in 2008. Will the website say that it's not FDIC insured? Yes. And every big bank for accounts over $250,000 said, not FDIC insured, right there in the physical branches and on the website. Will this industry have a government-created structure or framework? Yes. And in fact, our Republican colleagues have done their best to create, or at least asserting to the public that they've done their best to create, a robust framework, just as Congress did its best to create a robust framework for the big banks. Is it enough to say, well, we're not going to bail them out because we have in the language that it's not full faith and credit? Well, let's look at the big banks. No, Bank of America's certificates of deposit were not full faith and credit. Everybody knew that. So you go down the list and you're back in 2008, but it's worse. Because when you say this stablecoin reflects full compliance with the best framework Congress could develop, then you're saying, and we'll probably bail you out, because if it fails, it's on us. Then you get ordinary Americans. We're not doing this stablecoin here for an industry that doesn't want to grow. They expect the average American to own stablecoin, or a lot of them. At least there'll be a few stories of people who have their whole life savings who are going to go hungry unless we bail them out. And they're going to be in Congress saying you got to bail out this coin or that coin because otherwise our whole industry will look bad. I was here in 2008. You're going there again. And saying that you haven't had a chance to look at this amendment, not only is it very short, but it really just says one thing. No government agency can bail out a stablecoin. Period. One sentence. If you vote against that sentence, if you say this industry was created by Congress creating the strongest framework that they could, or at least that's what they're telling you, then you are creating the expectation of bailout, which then leads ordinary Americans to invest, which then gives them a moral claim to your vote to vote for a bailout when that happens. So if you want to vote now and say, you don't have to invest in stablecoin, but you are being set out to bail out those who do, then go right ahead. But this is a real test of the power of the lobbying machine that the billionaire crypto boys have put together. because if you're not willing to vote for a clear statement to the investors that they're not going to be bailed out, you can guarantee that it won't be on their webpage, but all over social media. It will say, this is a federally approved framework. They had a chance to say, we won't bail you out, and they said, we don't want to prohibit bailouts. In 2008, they bailed them out. The proponents of stablecoin will say that we're building something that will be systemically important to the country, so you can almost assure yourself of a bailout, and then you're going to see the bailout. So it's your choice. You're either pro-bailout or you can't anti-bailout, and don't think you can go back to your constituents and say, well, I didn't like the paragraph on line 15 of page 1 of the amendment. They're not going to listen to that. You're either pro-bailout or you're anti-bailout, and I yield back to the gentleman from Texas.
Reclaiming my time, I support the Sherman Amendment, and again would indicate that the legislation, the underlying legislation, is capitulation legislation when you decline to accept amendments that would make it much better than it is. I yield back.
The gentleman yields back. Is there further debate on the amendment? Mr. Caston of Illinois is recognized for 5 minutes to strike the last word.
So I just make a quick observation here. It's nice to call them stable coins, but they kind of have to be stable if we're going to call them stable coins. USDC, Circle, had $3.3 billion of uninsured deposits at SVB, Silicon Valley Bank, not that long ago. When Silicon Valley Bank collapsed, and they didn't have the cash, the money wasn't in the bank because they were in uninsured deposits. They had $250,000, but not $3.3 billion. USDC collapsed to 88 cents. Not stable. Not stable if a dollar is only worth 88 cents. The only reason we even call that a stable coin today is because the feds overnight rushed money in to bail out the uninsured depositors, which was appropriate to prevent a run on the bank. Right? I'm not saying that in crises like this we should not have people, we shouldn't take extreme measures in extreme circumstances. But the only reason it's stable is because we bailed them out. So I guess I'd yield my time back to Mr. Sherman, but I would love to ask, if this amendment was in place back when SVB was crashing, would we have saved the taxpayers money because we wouldn't have had to bail out these stable coins? And would we then not have the fiction before us today that these coins are stable independent of federal subsidy? And I'd welcome you to tell me wherever it goes, but I'm still perplexed why we call them stable when they are unable to stay stable without massive federal bailouts. Mr. Sherman, I yield my time to this evening.
If I was selling an asset where in real life it was associated with fraud, Ponzi schemes, Sam Bankman-Fried, I'd call it a gold stablecoin. I'd call it a platinum stablecoin. I'd call it a God-ordained stablecoin. Whenever you're trying to hide something, you give it a title that is the exact opposite. This is not a stablecoin. Many of them will go under. The pressure will be on government to do the bailouts. And you can tell your constituents that you stood here and said no government bailout, or you can tell your constituents the opposite. And I yield back to the gentleman from Illinois.
Yield.
Gentleman yields back. Is there further debate on the amendment? Seeing none, the question now occurs in the amendment offered by the gentleman from California, Mr. Sherman. All those in favor signify by saying aye.
Aye.
Those opposed, no.
No.
In the opinion of the chair, the nays have it. The amendment is not adopted. The recorded vote is requested. All those in favor of recorded vote, please raise your hand. Sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Is there an additional amendment? Mr. Foster from Illinois is recognized.
At the desk.
The gentleman has an amendment at the desk. We'll pause while the clerk distributes the amendment.
Mr. Chair, I'd like to reserve a point of order.
Gentleman from Michigan reserves a point of order. Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Foster of Illinois, designated as 17.
Without objection, the amendment will be considered as read. The gentleman from Illinois is now recognized for 5 minutes to discuss his amendment.
Thank you, Mr. Chair. I, too, was president in this committee in 2008. I came in under this committee in March of 2008, months before Lehman Brothers fell and basically cratered the economy. And then one day later, AIG got into trouble and was bailed out. There's a sort of breathtaking description of exactly how that bailout happened, where one specific government employee transferred many, many billions of dollars to the AIG counterparties. And I also, this pin here is the 110th Congress pin. So this pin was on the floor when I voted for TARP twice after the stock market cratered. This pin was present in this committee when we talked about those bailouts. And I, in fact, lost my seat in Congress in large part with outrage by taxpayers who did not want to see their taxpayer money used to bail out irresponsible entities. And so in response to that, first off, we said, okay, we're going to establish rules of the road, the Dodd-Frank Act, that would prevent this from ever happening again. And frankly, I'm very proud that that, in fact, has been pretty successful. We have not had major crises in the time since we passed Dodd-Frank. And we also have to understand that and make darn sure we don't introduce new risks into our system that will cause that to happen again. And that risk presents us right here. My amendment here is actually a sort of restricted version of the one that Rep. Sherman just introduced. It restricts the prohibition on taxpayer bailouts to the two major vehicles by which the government is likely to make $100 billion bailouts to failed stablecoins. The 13.3 Federal Reserve Authority and the Exchange Stabilization Fund. And so these are just explicitly banned here so that when the government officials go begging, please, please, can the Federal Reserve bail out this failed coin, the answer will be no, we are not allowed by federal law. And that's a big difference between just requiring that you put on your website some words about the FDIC or something. Because the truth of the matter is, when things hit the fan, you have to rescue the economy. The bailouts are a political reality, and in fact, they're good policy. The TARP vote was probably one of the most painful votes I took because it was in large part rewarding irresponsible risk-taking. But that's the nature of it, because the damage to innocent parties would have been so much higher. That exact calculation will happen again if we get to the point where a stable coin is such an integral part of our financial system and one of them fails, that we'll have the choice of either just letting it fail and the whole system fall apart, or put some taxpayer money on the line. So I think, my guess is in the end, what we're going to do if we go down the stablecoin route is that we're going to need an explicit taxpayer bailout mechanism, like the FDIC, Deposit Insurance Fund, with some shared responsibility for the whole stablecoin industry to bail out, to take responsibility for the failure of any one single stablecoin. That's what my guess is where we're going. Nothing like that is in this bill. What's in this bill is just taxpayer on the hook once again. The next best thing is my amendment, or even better, Rep. Sherman's, that has a prohibition on that. Also, I think I will close just with a little physics lecture, since I'm the one PhD physicist. You got to sit through this from time to time. There's a concept in physics called stability and a different one called metastability. A stable system is one in its lowest energy state that will stay there forever. You can nudge on it, it will return to that low energy state. A metastable state is a state which looks like it's stable. You push on it gently. You can think of a bowling pin. You push on it gently and it seems like it's stable. You push on it a little bit harder and it flops over and it goes to its true lowest energy state. And that is the one where stable coins will live. A stable coin under mild stress may maintain its peg. Under extreme stress, everyone will view it as worthless, it will become worthless, and that is the stable state which will last forever. right? And so these are not in their lowest energy states. They are metastable coins. And there will always be the danger that a stable coin that looks stable will in fact go to its low energy state of becoming worthless. And so this is, under those circumstances, we cannot put the taxpayers at risk. And so that's the meaning of my amendment, and yield back.
Gentleman yields back. Is there further discussion on Dr. Foster's amendment?
Yes.
The ranking member from California recognized to strike the last word.
I move to strike the last word. I appreciate my colleague, Representative Foster, who is ranking member of our Financial Institution Subcommittee that has oversight of financial stability, for offering this sensible amendment. If Republicans are not willing to support Mr. Sherman's amendment, I hope they will at least support Mr. Foster's amendment to prevent the Treasury and Fed to use tools they have used before to bail out reckless financial firms. During the 2008 financial crisis, we saw how poorly regulated money market funds needed to be bailed out by the Treasury Secretary using the Exchange Stabilization Fund, or ESF. We also saw how the Fed used its emergency lending authority to provide a bailout for AIG. I'll never forget that. I served on a committee that dealt with this issue. This common sense amendment would ensure Treasury and the Fed would be prohibited from putting taxpayers on the hook for bailing out any stablecoin issuer if they mismanage their way to failure. I'd like to engage Mr. Foster for a moment with a little colloquy here.
Certainly.
Without this amendment, would the president's stablecoin that he will own as he is moved to own stablecoin, could it be bailed out?
Yes, it could. And you know, the president is inevitably engaged in that decision, although it's held by the Treasury Secretary, who serves, you know, under the president. The president will unquestionably had a voice, as had a voice in the bailout of AIG. If the president had forbidden it, it probably would not have happened. And so that you're asking, there's just a tremendous conflict of interest being built into this.
Thank you, Mr. Foster. The more we talk about this legislation, the more we discover that not only do we have this giant conflict of interest with the president and the cabinet and Elon Musk and all of these people being able to own stablecoin, then we find out that they have control of the rule, because as a rule is developed by this so-called independent agency, the president is saying, we don't do that anymore. I want that rule to come directly to me so that I can do whatever I think I need, I guess, to protect myself, he's thinking. And now, in addition to that, being able to, number one, have a stable coin, number two, to interfere with the independent agencies as they develop the rule. Now you're telling me he would be eligible without this amendment to be bailed out if he failed and had failure. Am I correct in this, Mr. Foster?
I believe so.
Well, I don't know what to say, except I want to draw the attention to all that is happening here today, particularly as it relates to ownership of stablecoin by the President of the United States and his cabinet, and Elon Musk, and all of the others that may be eligible based on the way this is moving, all of the other billionaires who are part of the oligarchy that's aligned with the President of the United States. And now, as we end up talking about this, we would bail him out if he failed. What are we thinking about here? Now, I know what we're trying to do on the Democratic side. We want to have a stable coin with guardrails. And we've been working so hard, not only with Mr. McHenry, but with Mr. Hill. When McHenry was here, he was helping him out. He was working. He know that I tried. He know that we all tried. And here we come, after doing so much work, after trying so hard with a stable coin that, with the bill on stable coins that undermined all of the work that we have been attempting to do. And I still thought, even with some that we disagree with, we could still perhaps be working on them, but not with the President of the United States of America owning stablecoin as he owns his meme coin, and the way that he has advantaged himself, having earned tremendous amount of money where others have failed because they were misdirected or didn't understand that the president's stablecoin was all about himself. Well, I can only yield back the balance of my time. I'm warning everybody, this is terrible.
In fact, you do yield
Yes.
back?
Yes.
Is there additional debate on Dr. Foster's amendment? Not seeing any, I will yield myself 5 minutes to strike the last word. Well, as we've discussed this issue extensively in the last few minutes, and my colleague, Mr. Stile, offered, we'd be happy to work together on ensuring that there's no government bailout available for stablecoin issuers. That's a subject that we agree on. I also want to note to my colleagues, I've heard a lot of conversation and debate on these most recent amendments that are arguing that somehow a stablecoin are not stable and may warrant a bailout. Well, let me say that there's a patchwork of state laws and issuers now, and there's certainly some international issuers out there where that argument might stand. But currently, this bill does not permit that. It sets the high federal floor, dollar for dollar, Treasury securities, insured bank deposits, cash, insuring dollar for dollar a stable coin. All this reference to 2008 is about the banking system leveraged 10 and 20, and in some cases, in the case of Lehman Brothers, 40 to 1, where they made some mismatched bets, some at the direction of the federal government, I might add, and lost. Here, this is a dollar for dollar Treasury-backed stablecoin in a payment system, and I just don't think the arguments are sound. But as they grow in popularity, this bill that we propose, the Stable Act, is necessary to ensure that we're in a position that we don't have a bailout. Mr. Stile and I are committed to working with our colleagues that their concerns are addressed, and as a result, like Mr. Stile, I urge colleagues to oppose this amendment, and I yield back the balance of my time. If there's no further debate, the question now occurs on the amendment offered by Dr. Foster from Illinois. All those in favor of the amendment, please say aye. Aye. All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays have it. The nays have it, and the amendment is not agreed to. The ranking member has asked for a recorded vote. All those in favor of a recorded vote, please raise your hands. A sufficient number of hands have been raised. A recorded vote is so ordered. Pursuant to subsection C5, Rule 3 of the committee rules, further proceeding on this amendment is postponed. Is there any further amendment? Mr. Lynch was first up.
Yep.
He was faster than you were, Mr. Chairman. Mr. Lynch is recognized.
Mr. Chairman, I believe I have an amendment at the desk.
There's an amendment at the desk. We'll wait for it to be distributed.
Mr. Chairman, I'd like to reserve a point of order.
The gentleman from Michigan reserves a point of order. Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Lynch of Massachusetts, designated as 31.
Without objection, the amendment is considered as read, and the gentleman from Massachusetts is recognized for 5 minutes to support his amendment.
Thank you, Mr. Chairman. Mr. Chairman, the reason that there are so many amendments to try to shield the American taxpayer from bailouts is because we've seen so many of these stable coins. 20 of the big ones in the past, half dozen years have broken the buck and have required assistance or have just gone to zero. So we would have to be blind not to recognize the likelihood that these stable coins will fail and will require a government bailout. That's why we're all trying to build this firewall to protect the American taxpayer from that eventuality. So what this amendment does, it's a different wrinkle on that. What this does is this amendment ensures that when that crypto or stablecoin issuer needs a bailout, and we know that there's enough crypto supporters in the Congress, and we definitely know we've got a big crypto supporter in the White House. When they sign off on giving taxpayer money to the crypto company or the stablecoin issuer, when they bail them out with taxpayer money, this is looking at after the fact, after you do all that, we just want there to be some consequences that after a government bailout or emergency assistance, there are consequences for the responsible party. So this amendment would ban an issuer from issuing additional stable coins for a period of 1 year after they get bailed out, or until the Treasury conducts a full review of the soundness of the issuer themselves. So I don't know how you can be against this, because this would require the bailout this would require a failure that you refuse to admit will happen. So if you don't think there's any chance of the bailout being necessary, then you should be eager to vote for this bill, because it makes those difference. Allowing this bill to become law without the basic protections afforded in this amendment would be inviting the next financial disaster. I served on this committee during the 2008 financial crisis. The similarity there and here is this: there were new, innovative financial products. That's the thing. We didn't understand them. They were so complex, CDOs, the different constructs of secured mortgage securities were new. Alan Greenspan and others, Ben Bernanke, had always said that we've never seen the value of real estate drop in this country. And they bet on that never happening again until, of course, it happened. And then, as I said before, we had to bail out AIG and others to the tune of almost $800 billion. These institutions made reckless decisions in the name of so-called innovation. Not a single bank executive was ever held responsible or faced a meaningful level of accountability. Some companies did not even take a haircut and were bailed out with a profit. They were rewarded for their action in taking down the economy. So I have serious concerns about the potential for volatility in the global stablecoin market, because that has been the history here, and how closely it is tied to the volatility of crypto assets, also very volatile and unpredictable. Stablecoins are not isolated and serve as a conduit for buying, selling, borrowing, lending, and staking crypto assets. They're volatile by design, and this connection only deepens the risk to our broader financial system. As seen throughout previous financial crises, uninsured products are highly vulnerable to runs. The government has been forced to bail out money market funds and other short-term funding markets, most notably in 2023. The government rescued Silicon Valley Bank and $3.3 billion in Circle deposits, uninsured. This bill not only opens the door to more runs, it closely links stablecoins and crypto products to our broader financial system. In closing, given this vulnerable exposure, the government is likely, almost assuredly, to again bail out a failed stablecoin company. And if we're willing to provide a basic protection in this bill, such as requiring issuers be FDIC insured, we must at least protect the American taxpayer and hold issuers accountable. So, Mr. Chairman, I yield back.
Gentleman yields back. Who seeks recognition? Mr. Lawler of New York. Move to strike the last word.
I move to strike the last word. Mr. Chairman, this amendment, like the prior two, are a solution in search of a problem. There's nothing in this legislation that authorizes a bailout. There's nothing in this legislation that provides a bailout. And in fact, if in the event that that were even a consideration, it would require congressional action. It would require Congress to actually pass legislation authorizing a bailout. So you're seeking to prevent something that is not even part of the bill, that isn't happening, and seeking to create a solution for a problem that does not exist and is not created by this bill. And ultimately, with a 1-to-1 ratio in the stablecoin backing and providing an actual framework, which is what this bill does, to make sure that we have a secure stablecoin system. The attempts here, while I'll say generously well-intentioned, frankly, are trying to create a narrative that doesn't exist. If Congress were to even consider such a remedy, it would require congressional action. So even if you pass these amendments, even if they were part of this legislation, and Congress had to act, Congress would not withstand these amendments and act. But that is not what anybody is proposing. And so I don't really understand what the purpose of this amendment is when, in fact...
Will the gentleman yield?
No. When, in fact, I've already heard your explanation, and you really didn't provide a rational one. When, in fact, if Congress did have to act, it would require legislation to do so. You can shake your head smirking, but the reality is that's what would have to happen.
I'm going to remind the gentleman to address his remarks to the chair.
So, in the end, there really is no purpose to this amendment. I yield back.
Gentleman yields back. Who seeks recognition? Ranking member, gentlewoman from California, recognized to strike the last word.
There is great purpose to this amendment, and I yield to Mr. Lynch to put him in his place. I mean, to basically respond.
Thank you, Ranking Member. I appreciate that. So, if the gentleman took a moment just to read it, what it does is in the event that we do what we did last time. So when we did the bailout in 2008, there was also no provision for a bailout. It was from whole cloth. It was because of the pressure on the economy. The fact that Circle will have a 1-to-1 reserve on their stablecoin doesn't change anything. When we bailed them out back in 2023, they had the same exact model, 1-to-1 reserve with the dollar as the reference currency. It failed. We haven't changed that dynamic. So, based on all the other stablecoins that have failed and needed relief, we know this is going to happen again. And the bailout will be required, and Congress will support it. Congress will support it because the economy will have crashed. We saw that. It's history. Those of us who were here recognize that danger. You're a newer member, you didn't go through that, so I don't fault you for that. However, the reality is that because the economy was so badly damaged, enough members here, not all, felt that they had to bail out Goldman Sachs and AIG and a bunch of other people who actually caused the problem. So I don't doubt that that will happen again. It'll definitely happen again, especially with the level of support for the crypto industry in this body, and also because of the president's position and his direct investment. He will absolutely rush to sign off on that. You know, he'll want to bail out his family's company that's deeply invested in crypto. So we know that's going to happen. What the operative part of this amendment, the operative part of my amendment, if you read it, is that when they get the bailout, there's a 1-year period that they can't issue any more stable coins unless Treasury comes in, does an assessment of that stablecoin operation, and signs off on the safety and soundness of that operation. That's the difference here. That's the difference. So if there's a bailout, this goes into effect. It's sort of a penalty for breaking the buck, and it provides the only negative consequences to a stablecoin company after they get the benefit of a taxpayer-funded bailout.
Reclaiming my time.
Okay.
You've done a great job with this, and I want to tell you, this is a very reasonable amendment. If they cannot vote for this, they won't vote for anything. Because if it was my amendment, I would say after a bailout, you're out of business for good. You allow them to make corrections, and within 1 year, come back. You can't be any more reasonable with that. And let me just say, Mr. Lynch, I thank you for doing everything that you can to ensure that we understand stable. Well, I'll yield to Mr. Foster, who's anxious.
Yeah, no, I just, a couple of points of clarification. The chair said a few minutes ago that only insured deposits were allowed to back these stable coins. It's my impression that uninsured deposits are actually allowed under this text. Mr. Chair, do you know, could you just,
I yield to
if I could
chair.
yield to you just to get confirmation one way or the
I
other.
will yield to the chair.
Insured deposits, U.S. Treasuries 90 days and under, Treasury notes with 93 days or lower in maturity, and Treasury overnight repos.
Insured, but not uninsured deposits,
Yield
is
to
that
Ms.
correct?
Foster.
Yeah, my question involves, are uninsured deposits allowable or not?
Not that I'm aware of. Be happy to check that, but not in
So if
my
we
reading of the
could get
text.
clarification, it's a simple, straightforward way for a stable coin to lose its peg if they're in uninsured deposits, and boom. And the other thing just that I'd like to clarify is that the three major bailouts, or three of the major bailouts, the reserve primary and Fannie and Freddie bailouts, they were presidential decisions, all right? And the AIG one maybe only went through the Treasury Secretary. We're checking on that, but it is, the president will get involved.
Gentlewoman's
in these
time has
bailouts.
expired. Is there further discussion on Dr. Foster's amendment, or Mr. Lynch's amendment, sorry? Mr. Sherman's recognized to strike the last word.
The proponents of this amendment say the bill doesn't require a bailout. No, but it certainly allows one, and a vote against this amendment and my amendment and others signals to the market that it will be there, that it'll be available. We're told that it would take a vote of Congress to authorize a bailout in the past. That's not what happened with AIG. And there is substantial vagueness in the Federal Reserve Act that would allow for a bailout of a systemically important entity or entities. So that is why the crypto industry is fighting so hard to make sure this language is not in the bill. They're smart people. God knows they get paid enough. They knew they could have put limitations on bailout or prohibitions on bailout. They don't want any of that. Now, we're told that no bailout is needed at the present time. That's correct. If you're building a house of cards, it doesn't fall down when you just put the first few cards there. it's going to be a while before before you need a bailout. So you don't need a bailout at the present time. Not a good argument. No, the bill doesn't doesn't require bailouts. No, but you're fighting hard to make sure the bill allows bailouts. Then we're told that there's going to be one-to-one reserves. The money market funds had that in 2008. Several of the money market funds needed a bailout. Now there, the amount of cost to the federal government was very, very small, but here it could be much larger. What does it say to this country, and what does it say to the industry, and what does it say to investors when they see, number one, this bill allows bailouts. Number two, current statutes can be read to allow bailouts. Number three, the industry is powerful enough to demand and get bailouts. And number four, the industry is powerful enough to prevent the prohibition of bailouts. And then even with Mr. Lynch's amendment, the industry is powerful enough to make sure that if they take a bailout, they don't even get a one-year slap on the wrist. That is a powerful industry. We have current statutes that allow bailouts. Many Americans will invest believing that there will be bailouts should they be needed. The industry will spend tens of millions of dollars with that as their advertising theme. Ordinary Americans will come to us and say, I thought this was safe. And then you will say, the administration won't bail them out, and Congress won't bail them out. And for you to be able to say that, it's because you weren't here in 2008, and you don't understand the pressure that there will be on the administration and on Congress. So you want to go back to your constituents and tell them that you voted to make sure that even after they get the bailout, there isn't even a one-year slap on the wrist because you wanted the crypto bros to not even have to endure that after a bailout. Go right ahead. But it's very hard to say this amendment makes this bill worse in any substantive way unless you believe that there will be a bailout. If there is never a bailout, this amendment never becomes operative. And the cost, and so its sole cost to our country is the cost of printing it in the congressional record. The only reason to vote against this amendment is not because you think there won't be a bailout, but because you think there might be, and you want to make sure that the industry is not even put in a one-year penalty box if there is. So you can't vote against this amendment just because you think it will never come to pass. And with that, I look around and see if anybody wants me to yield, and I yield back to, I yield to the gentlelady from Michigan.
Yeah, and I think Mr. Sherman is exactly right. I mean, if you don't think it's going to happen, then why not vote for the amendment? If you're that confident that we're not going to bail them out, there's no bailout that's going to be in the future, then vote and support this bill and protect the American people. They don't need us bailing out folks that are being irresponsible, reckless, and again, the number of conflict of interest that we continue to see. With that, again, I urge my colleagues to please support Mr. Sherman's amendment.
Does anyone else want to speak on Mr. Lynch's amendment? Seeing none, I'll yield myself 5 minutes. Well, I've never heard more people talk about they don't support bailouts and talk about bailing out stablecoins more than my colleagues, and it reminds me that I'm sure they all supported Janet Yellen and the bailout in Silicon Valley under the existing laws. Let me just simply say that during 2008, 2009, 10, while you all were here voting on Dodd-Frank, I was actually in a bank as a CEO during the financial crisis. And I can tell you that government policy incented that financial crisis. I'm blessed to say that our company was not a victim of it, but I saw a lot of nonsense in and around federal policy that led up to the run-up of that crisis. Some of the comments made here is, we need a firewall. Well, guess what the firewall is? It's the Stable Act. That's the firewall against a potential need for a bailout or for a poorly run stablecoin. Mr. Lynch is right. that there have been past stable coins that have, quote, broken the buck, to quote him. Guess why? Because there's no high federal standard. There's some state standards that are okay. There's some international standards that are terrible. We're setting the high federal standard to build the firewall that he's arguing for. Second point, not after the fact. We're arguing in fact that we're building a firewall today. It's the mistakes made of not passing this bill several years ago that has delayed and created consumer risk. We are the people standing in this committee under your leadership and McHenry's leadership to ask for a firewall on stablecoins, and this Congress is going to deliver it. Second point. There's a talk about money market funds breaking the bank, that they were dollar for dollar. Nothing comparable between a money market fund in 2008 and a dollar-backed stablecoin under this bill. Why? Because the money market fund offering invested in a lot of things that were not immediately liquid. And let me say, Dodd-Frank corrected that. That was a good move. They invested in the commercial paper of Lehman Brothers because it had a high rate overnight. So yeah, they broke the buck. And that's why we have in this bill U.S. Treasuries, insured deposits, in answer to Dr. Foster's question, 100% insured deposits, and overnight Treasury repurchase agreements. So we have addressed exactly the concerns that my colleagues have outlined on building a strong firewall, having high standards, have an outstanding federal regulatory assertion around a stablecoin. And if we had this in place, like we've argued for 2 to 3 years, maybe we would have protected consumers and had less mischief out in the stablecoin arena. And finally, I will conclude by saying, Chairman Stile has offered to work with our friends on the other side of the aisle to share this view. No one here is arguing for a bailout. Quite the contrary. I urge this amendment be rejected, and I yield back the balance of my time.
Mr. Chairman.
Is there additional debate on the amendment?
Mr. Chairman, I move to strike the last word.
Ms. Williams is recognized for 5 minutes.
Mr. Chairman, as someone who is here to always represent the concerns of my constituents and making sure the voices of consumers and the people back home are represented, I support the amendment to make sure that we are guaranteeing that Congress is always putting the needs of all of our people back home first before the needs of any industry in this country. And with that, I'd like to yield more time to Mr. Lynch.
I thank the gentlelady. Again, if we want to, I respect the gentleman's argument about the nature of the reserves that will be held. However, they are held against probably the most volatile financial instrument that we have in the world today, which is crypto. So that volatility and the uninsured nature of these, look, if we wanted to adopt one amendment, which would be require FDIC insurance on stable coins, a lot of this problem would go away. Because runs would not occur. There wouldn't be a rush to the exits on any of these financial products, because everyone would know, okay, my deposits, my investments are insured, and no matter, come hell or high water, I'm going to get my money back. That's not the case when a stable coin breaks the buck. There's a rush for the exits, as we saw with Silicon Valley. That money moves so quickly that we had a weekend to try to auction off control of that bank among several suitors, and that whole exercise was conducted by the FDIC and Martin Grunberg, and it was the people, it was the banks that had required insurance that bailed out the parties that did not. The idea here is to prevent that from happening again. The idea here is to protect the taxpayer. And again, if you don't think that this, as Ms. Tlaib noted, look, You may think this might be unnecessarily in the end run, but based on what has happened in the past and the number of times that the taxpayer is on the hook, why don't we just take a minute and just say, okay, how can we protect the American taxpayer on two levels? One, in the short-term rescue of a innovative financial product, and secondly, the eventuality of the bailout that might occur. As we expand the prevalence of stablecoins throughout our financial system, the bailouts are going to get bigger and bigger and bigger. So what we're doing here is trying to have the foresight to create that firewall. We don't think that the provisions in the bill right now are sufficient to prevent. This bill was heavily influenced by the industry, and they're trying to use leverage as much as possible. So they're dead set against providing deposit insurance, FDIC type insurance on these stablecoins, because they know that that's a cost factor, and they know that they will be bailed out when push comes to shove, because we've done it so many times before. So maybe this is a belt and suspenders approach, if you want to look at it that way. That there's a belt around this that the bill in itself embraces. But I think it's fair enough to say that we have gone to the federal tax, the American taxpayer so many times in the past that we need some assurances this time that they won't be on the hook again. And so what this amendment does is just provides some level of negative consequence for those stablecoin companies, maybe to take greater care, because they know negative consequences will result from them breaking the buck. And with that, Mr. Chairman, I yield back the balance. Well, I yield my time.
Gentleman yields back to Mrs. Williams. Mrs. Williams yields back to the chair. Is there any further debate on the amendment?
Mr. Chair.
Ms. Garcia of Texas, you're
I
recognized
move
to strike
to
the last
strike the
word.
last word. Thank you. I'm just baffled by the position and some of the debate that I've heard, and I, for one, want to associate myself with the ranking member and Mr. Lynch and others who have just, the bottom line is, as Ms. Tlaib said earlier, if you all really think this is never going to happen and that we're just acting, not out of order, but unnecessarily, well, then what are you afraid of? Put it in there, and if we'll never use it, we never use it. But it's always good to have a safety net in there, especially when we're talking today. I think this afternoon, I don't know if the White House has made their announcements on the tariffs, but everyone is predicting that I have seen, everyone from Moody's and Wall Street, that we're getting closer and closer to a recession. I think the number I saw last week was 30% chance. Moody's has said that it's doubled the likelihood. And if we may happen to be bailing out more than just crypto people. So I think this is extremely necessary. And with that, I plan to vote for this amendment and I yield the remainder of my time to Mr. Foster.
Thank you. I'd just like to return quickly to this issue of insured versus uninsured deposits. I might make sure we're looking at the same piece of text here. On the text that was distributed, page 14, section 4, line 16, it says it includes as among the list of allowed things to comprise reserves, funds held as demand deposits at insured depository institutions. Those are not insured to the extent that they exceed $250,000. And so it's my reading of that language, line 16 through 19, that in fact uninsured deposits are in fact allowed as reserves under this legislation. And I was just wondering if I have clarification of that.
Are you yielding? You're yielding? Yeah.
It is my time, so yes, sir, you can.
The answer is yes, they're allowed?
Yes, there are.
They're allowed.
No,
All right, so
no,
the uninsured
hang on,
deposit.
hang on. First of all, if you yield, who is yielding to me?
All right,
And what's the
I am
question?
yielding to you, and the question is, will uninsured, will deposits at demand, at insured depository institutions be allowed to the extent that they exceed $250,000 and are thus not subject to the insurance?
Funds in a demand deposits at insured depository institutions. So I don't anticipate uninsured deposits being
Well,
served.
isn't that
as-
exactly what happened? If you exceed $250,000 in your account, then everything above 250,000 is not insured.
I don't anticipate there being uninsured deposits.
So that none of the issuers will be putting more than $250,000 into any
well, I'm not going to tell you what people are going to do or not do.
But can they? But this would allow them to put arbitrarily large amounts into effectively uninsured deposits under this.
I guess I'm still
Mr.
responding.
Chairman, it is my time, and
Yeah, no, it's.
Mr. Foster, are you done, sir?
What? If you.
The bill calls for the use of insured deposits at insured depository institutions under the limitations set by regulation, subject to the FDIC and the NCUA respectively, to address safety and soundness risk of the insured depository institutions.
Mr. Chair, I did not see the word insured. You just said as insured demand deposits. If you're willing to insert on line 16 the word insured, then it would be clear that that when you go above $250,000, that you'd actually be insured. Because as I read it right now, uninsured deposits are arbitrary amount of uninsured deposits. I believe I've been told also there's going to be an amendment to discuss this exact issue. Maybe that's the time to have
Yeah,
this.
maybe if you want to get into this level of detail, we can discuss that. But I want to remind everybody, it's funds held as demand deposits at insured depository institutions in addition to treasuries. So I hear what you're saying. I know what your question is. I can't answer that directly. I'm happy to work with you on that.
Yeah, well, yeah, Mr. Caston, I believe, will be offering an amendment. So if we could just get staff level clarity on exactly what's involved prior to that. It would
Sure,
be
of course.
great.
I yield
All right,
back
thank
to
you. And I
you,
yield
and
my
you may
time.
yield back to Ms. Garcia, and your time has expired.
Thank you, sir. I yield back.
Is there further debate on this amendment? If there's no further debate, the question now occurs on the amendment offered by the gentleman from Illinois. All those in favor, please say aye.
Aye.
Any opposed, say no. No.
Recorded vote requested.
In the opinion chair, the nays have it. The nays have it. The amendment is not adopted. The ranking member has requested a recorded vote. All those in favor of recorded vote, please raise your hands. A sufficient number having raised their hands, recorded vote is so ordered pursuant to section C5 of Rule 3 of the committee rules. This proceeding, voting on this proceeding is postponed. Is there any further amendment to Mr. Stiles' A&S? Mr. Lynch,
I believe I have an amendment at the desk, Mr. Chairman.
you'll pause while we have it distributed.
Mr. Chair, I'd like to reserve a point of order. Okay.
Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Lynch of Massachusetts, designated as 22.
The, without objection, the amendment will be considered as read, and Mr. Lynch, you're recognized to speak in support of your amendment for 5 minutes. And no more, just 5 minutes.
Thank you very much, Mr. Chairman. I appreciate that. Mr. Chairman, this amendment is trying to get at the underlying bill creates a two-track system, a federal and a state system, and we respect that. However, this amendment would try to improve upon that by establishing a dual state-federal regime that while it respects states' rights, also promotes financial stability and preventing a race to the bottom sort of approach by some of these stablecoin issuers. We have deep concerns about allowing stablecoin issuers to seek a state pathway for approval without sufficient standards to maintain prudential oversight. There are stablecoin issuers who might just simply look for the path of least resistance and least oversight. Stablecoin issuers would inevitably pick and choose the states with the laxest oversight, creating what I call a race to the bottom. Legislation, we think, should provide federal regulators with sufficient authority, and states must have that ability to regulate issuers active in their states. This bill allows non-banks to issue stablecoins without obtaining federal deposit insurance and without complying with the laws governing FDIC-insured banks. As we've seen before, state-sponsored deposit insurance programs have failed. During the Great Depression, the absence of federal deposit insurance triggered systemic runs on thousands of banks, federal and state chartered depository institutions. And these programs have failed because they were poorly supervised and did not have sufficient funds. The lack of clarity in this bill between the federal and state oversight leaves room for issuers to take advantage of that gap. While advocates for this bill argue that the standards for state-qualified issuers are sufficient, I have serious doubts. State-qualified payment stablecoin issuers would not be governed by crucial public interest safeguards contained in prudential federal banking laws. Creating a state pathway undermines those federal protections. And I remind my colleague that the federal standards exist to ensure adequate deposit insurance coverage, supervisory enforcement powers, and safety and soundness protections. Lastly, the collapse of large state issuers might probably require federal bailouts to avoid systemic market failures. This committee should not allow for a state-qualified pathway that would undermine those federal protections. Mr. Chairman, I will yield back.
Gentleman yields back. Who else seeks recognition? Mr. Heisinger of Michigan.
Thank you, Mr. Chairman. I'd like to move strike the last word and love to actually pick your brain, Mr. Chairman. I'll direct my comments to you because what I'm reading and seeing in front of me and what I just heard doesn't exist. What this legislation does through OCC is it sets a floor, a federal floor. This is what I talked about in my opening remarks, where there's no race to the bottom. There's actually a race to the top. This is only going to get harder if you choose to go to another state. We do this with CAFE standards, right? I'm from Michigan. I understand the car industry. We set federal standards, and then we let California go nuts, right? And if you want to go sell cars in California, you got to adhere to their CAFE standards. But that doesn't mean it's the national standard. Now, as I understand it, Mr. Chairman, and I'd love for your input, or Mr. Stile, I know he's been in and out, or I'm sorry, he's down over there negotiating something, I think. I'd love for either of you to chime in and correct me if I'm wrong somehow, that this is a federal floor that if you choose to go to a state regulator, it's only going to get harder, not weaker. Is that accurate? I yield.
I think that's a fair description from my friend, which is that we set the definitions in this act for what are the minimum standards of prudence for the composition of the stable coin, the liquidity and capital standards, the cyber and risk management standards, the Bank Secrecy Act and AML standards. We have, if you're a bank issuer of a stable coin, your primary regulator is your overseer of that stable coin. If you are a non-bank payment stable coin issuer under this federal law, the Office of the Comptroller of the Currency is the primary federal regulator, again, holding both bank and non-bank regulated entities to the same standard and holding the states accountable that they meet that minimum standard. And this bill has the federal government's power to exercise and assert jurisdiction and actions over any laxity on the part of a state, including cease and desist authorities, judicial proceedings, and the like.
Reclaiming my time, it sounds like you've covered the waterfront there, and I guess I'll ask one more simple question here, Mr. Chairman, to you, which is this amendment necessary to make, and is this amendment going to make this bill safer somehow, or we already have this safeguarded in there? I yield.
Well, this bill builds on the good work of Mr. McHenry and Ms. Waters on how do you try to balance maintaining a state pathway where you have it in existence, such as New York State.
Which we've determined, sorry to interrupt, but we've determined is an important part of this.
It is.
Everybody has said we want the states to have an option.
It is, but as has been noted here, we didn't want to race to the bottom. And so I just would say to my friend from Michigan, that's why we set this high federal standard and set this intervention of federal regulators for both bank and non-bank issuers.
Thank you. I reclaim my time, and I don't know if Mr. Stile has been engaged enough on the discussion of this, but the simple fact is, Mr. Chairman, in my view, this again is this is a solution in search of a problem that has already been addressed and/or doesn't exist. So with that, I yield back.
The Vice Chairman yields back. Is there further debate on the amendment? Mr. Foster of Illinois recognizes to strike the last word.
Strike the last word and yield to Mr. Lynch.
I thank the gentleman from Illinois. The problem that apparently you don't see is that in this bill, for state licensed stable coins, these bills largely leave both the Genius Act over in the Senate and this bill here, leave the supervision, the examination, and the licensing authority for new stablecoin issuers to the state regulators on their own. The only time that the federal regulator gets to intervene is under, quote, exigent circumstances, which means, usually means a disaster is already in progress. So that's the floor you were referring to, but it allows a lot to go wrong before the feds can actually say, okay, we need to intervene. The other thing is that stable coin issuers would have the incentives. Once these state laws are established, the stablecoin issuers would have an incentive to choose the state with the most lax oversight and ones that ignore stronger laws that might exist in other states. For example, this bill hinders federal regulators' ability to impose reasonable capital, liquidity, and risk management requirements for stablecoin issuers. Those are powers that a federal regulator would normally have. And there, in the bill, there's really scant criteria for evaluating whether an issuer should be approved, and they don't really include the consideration of financial history and the condition of applicants, their capital structure, future earnings, the character and fitness of the issuer's management. Those are all criteria that is used in the banking world, as well as other factors that help guard against risk and instability. And lastly, the bill's provision requiring regulators to further tailor their approach to stablecoin oversight suggests that even these modest oversight measures will be pared back even more. Letting stablecoin issuers secure legitimacy through a bank-like licensing regime without adequate or comparable oversight subjects both the stablecoin customer and the financial system to undue risk and instability. With that, Mr. Chairman, I will yield my time back to the gentleman from Illinois, Dr. Foster.
Okay, and I will yield back.
Gentleman yields back. Is there further debate on the amendment? The gentleman from California is recognized to strike the last word.
Ladies and gentlemen, let me just say that Chairman Hill did allude to the fact that we had worked together with Mr. McHenry. My real issue in insisting that the Fed have involvement, that as we understood all of the desire for the states to be able to be issuers, we understood that the central bank should have a significant role. And we basically agreed on that, but what is being done by Mr. Lynch is putting some big teeth to it and making it mean something that the Feds are involved. And so I support the amendment. It further supports the negotiations that we had to make sure that the Feds were included. And so not only do I support the amendment, I think it makes what we were attempting to do even more viable and stronger.
Would the gentlewoman yield?
Yes, I'll yield.
Yeah, just on that point, it's such an important point. You know, we originally, as we worked on the bill between Mr. McHenry and Ms. Waters, we were seeking a strong federal regulatory hand, but during the Biden administration, certain Biden administration officials refused to let the comptroller of the currency be considered, which was, you know, our preference. I'm not speaking for you, but that's how the Fed, you know, was imposed in the work you're doing. The Fed still plays a role in the existing act because state member banks have the Fed as their primary regulator. So the Fed is involved in the oversight here, but I'll just yield back to the gentleman.
Yes, the state plays a role, but as I remember our negotiations and the kind of role that it played, the state issuer would basically issue, and then it would have to come to the Fed, and the Fed supposedly would say, we believe that you're in compliance with whatever the Feds would require. And if not, they would say to the state, we do not approve, and you have to go back, and you have to strengthen the state regs, et cetera, et cetera. And so all that I'm saying is that I think it's very important for the states, for the Feds to be involved. I know there's some on the opposite side of the aisle who do not agree with the central bank's involvement, but it would be a race to the bottom if in fact they were not involved. And so this strengthens the ability for the states and the Feds to work together so that we have the best oversight possible. And I think the amendment should be well received because it furthers what we were attempting to do with our negotiation.
Would you leave?
Yes, I yield.
So another important point, and I just would remind my friends on the other aisle in this particular draft that state stablecoin issuers, the regulatory structure like the superintendent for banking in Albany or in Sacramento would have to submit their stablecoin management plan and examination to the Secretary of the Treasury to be proactively approved before, you know, it would be accepted. Just I yield back to the gentlewoman.
I ask for an aye vote.
Is there more debate on the amendment? If there's no further debate on the question now occurs on the amendment offered by the gentleman from Massachusetts, Mr. Lynch. All those in favor, please say aye.
Aye.
Any opposed, please say nay. Nay. believe the nays have it. The nays have it, and the amendment is not adopted. The ranking member from California requests a recorded vote. All those in favor of a recorded vote, please raise your hands. Sufficient number having raised a hand, a vote is so ordered pursuant to Section C5 of Rule 3 of the committee rules. Further proceedings on this amendment are postponed. Is there additional amendment to Mr. Stiles' amendment of nature of substitute? Ms. Tlaib, the gentleman from Michigan, is recognized.
Thank you, Mr. Chair. I have an amendment at the desk.
You'll pause, and we'll let the amendment be distributed.
Mr. Chairman, I'd like to reserve a point of order.
The gentleman from Michigan is recognized, reserved a point of order. The clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Ms. Tlaib of Michigan, designated as 33.
The amendment will be considered as read, and the gentlewoman from Michigan is recognized in support of her amendment for 5 minutes.
Thank you so much, Mr. Chair. You know, one of the weaknesses of the Stable Act is the lack of strong consumer protections for our residents. This is reflected on the fact that this bill is silent on the authority of the Consumer Financial Protection Bureau, CFPB. The amendment seeks to remedy this omission by explicitly affirming that the authority of the CFPB with respect to stablecoin issuers and customers who own stablecoins. So stablecoin users, again, many of our residents, right, deserve the right to dispute charges, fight fraud, and contest errors. Our residents deserve the rights under the statutes like those protections under the Electronic Fund Transfers Act. And again, these are basic consumer protections that many of us, I hope, support. I would also hope that all my colleagues would agree that any regulatory framework for stablecoin issuers must prioritize robust and effective consumer oversight for our residents. I also hope that you all agree that, you know, many of the users deserve the same protections, just like we do for any other financial products. I'll also note, you know, I think this is important, that CFPB was established, as you all know, in 2008, after the 2008 financial crisis, which was facilitated by predatory financial dealings and scattershot, you know, consumer protections. In the run up to the crisis, Mr. Chair, you know, one of the regulatory protections, you know, was weakened, and commercial investment banking sectors were allowed to merge. And so the Stable Act that we have before us will similarly undermine, I believe, the separation between banking and commerce by allowing non-financial companies to own stablecoin issuers. We have seen this before, and while some benefited tremendously, it was a horror story for millions of our families. I urge my colleagues to please stand up for consumer protections. These are basic rights, and that they can prevent, again, financial disasters, both for individuals and for our broader economy. Again, I urge my colleagues to support this amendment. With that, Mr. Chair, I yield.
The gentlewoman from Michigan yields. Is there further discussion? Does the gentleman from Michigan insist on his point of order?
I do. Not.
Michigan on Michigan violence there just averted. I'm so pleased. He does not insist
Just
on
trying
the
to
point of order.
see if everybody's paying attention, Mr. Chairman.
The gentleman from Ohio, the chairman of the Subcommittee on National Security, Mr. Davidson, is recognized to strike the last word.
Thank the chairman. I do move to strike the last word, and I do oppose this amendment the Consumer Financial Protection Bureau isn't referenced by the legislation, but frankly, their authority is at least clarified when it comes to stablecoins. The CFPB has not been silent about stablecoins. In fact, just in January, on his way out, Director Chopra tried to limit the ability of individuals to own their own cryptocurrency with self-custody. He literally wanted to have the CFPB become the regulator for custody. And, the premise there is that the government somehow gives you the permission to transact, and it does not. So he with no real structured rulemaking process, decided that he was going to insert the regulatory authority of the U.S. federal government via the CFPB into everyone's transactions. So, the CFPB hasn't been silent about stable coins under, the wrong director. They may not stay silent on stable coins. And we want to clarify with this legislation what exactly the entire federal government is supposed to do with respect to stable coins. That is the point of the bill. So the idea that you're going to do nothing to limit the ability of the CFPB, to the extent CFPB continues to function the way that it has, they haven't shown restraint even in areas where they're not supposed to go. So we may need to put, further clarification to say, this means you, CFPB, because they seem to be willing to ignore other statutes and impose rules where even their underlying authorization says they're not supposed to. So I don't support this amendment. I hope our colleagues will oppose it as well. And I'm happy to yield to anyone else if they want to make the similar points. With that, I yield back to the chairman.
The gentleman yields back. Who seeks recognition?
I seek recognition.
The ranking member seeks recognition, and she is not. Yeah.
Okay.
Strike the last word.
Move to strike the last word. I thank Ms. Tlaib for this amendment. It is so important that we recognize consumers have a right to know and understand what is happening with some of the issues that they're confronted with every day, like fraud. And they need some place that they can go to have their concerns investigated so that we can cure some of the fraudulent work and efforts by those who are attempting to just rip off the consumers. Now, I love the Consumer Financial Protection Bureau. This side of the aisle, the other side, hates the Consumer Financial Protection Bureau. When we crafted it in the Dodd-Frank reforms, it was done in such a way that they would not have to depend on the Appropriations Committee of the Congress of the United States and the House of Representatives. We knew that there would come a time when they would be undermined. And so their appropriations come directly from the Fed. And the way that it was organized would give us some protections against a takeover just because a president maybe had the ability to appoint all of those who would serve on that oversight board. And so we have worked very hard over the years, and we have fought against attempts to undermine, attempts to wreck and destroy the Consumer Financial Bureau. Now here, along comes Elon Musk under the direction of the President of the United States. And they decided, because now Trump is the president, he would finally get and wreck and destroy the Consumer Financial Protection Bureau. Elon Musk went in with gangster move, and he took control and got the access to all of the records, told all of the employees to get out. I think they were ones that he said get out by 5 o'clock. Maybe it was 3 o'clock. But they were treated very badly. And I think that furniture was removed, and of course it was a lease building, and I think what they did was they tried to pay off the lease so that they could empty the office and put the police sign up. I mean, they really went after the Consumer Financial Protection Bureau. And so a lawsuit was filed by the union, I think it was the Treasury's union, and that went before the courts. And I want you to know, the court looked at this and looked at the history of this, and they decided that they would replace and return the workers to the Consumer Financial Protection Bureau. Now, we know that these decisions, for the most part, are temporary, and that these issues that we have where the courts intervene and change what Elon Musk and Trump are doing in our agencies are going to have further hearings, et cetera. But for now, the courts looked at the history and all of the comments that have been made over the years and decided that they were going to return these workers. We're very pleased about that, and I want you to know that this amendment further supports the idea that consumers should have somewhere to turn when they are being ripped off. And when I sat on the conference committee of the Dodd-Frank reforms, this is one of the most significant issues that we were able to put into law. And I'm looking forward to the courts, when they have the final hearings on this issue, will support not only the Consumer Financial Protection Bureau as it was envisioned in the Dodd-Frank reforms, but they would do it in such a way that would have Trump and Elon Musk understand you stepped over the line on this, you went too far, they are in law. This is something that you can't do with your executive order. So thank you, Ms. Tlaib, for backing us up with this amendment to make sure that the Consumer Financial Protection Bureau is protected. And I yield back the balance of my time.
Gentlewoman yields back. Who seeks recognition? Any further debate on this amendment? Hearing none, I will yield myself 5 minutes to strike the last word. First, in the work that we've done over the last couple of years in developing stablecoin legislation in the last Congress, and in this draft, you don't see the CFPB referenced, and it was not in last Congress's draft either. And that's because the direction was that in the state-federal approach to this very narrow specific policy standard that we were going to have jointly issued rules with the federal regulators to cover payment stablecoins in consultation with the state regulators, and that would build our very strong federal minimum floor. Secondly, we wanted to make sure that these bank and non-bank alike had the same high standards. So at the federal level, that includes the bank's primary federal regulators, and for non-banks, it's the Comptroller of the Currency. The OCC, for example, obviously does consumer compliance at some of the largest banks in the country. They have a full suite of consumer compliance authorities and powers. And at the state level, as I noted in the debate on the last amendment, the state regulators have to have a regime that is stood up and certified by the U.S. Treasury Department. There is no lack of consumer protection or regulatory oversight in this bill. And indeed, not only do we have rigorous state enforcement, but we also have, as I say, backup federal enforcement. So I appreciate the gentlewoman's amendment, but I would urge that it's not needed, and therefore that it be rejected, and I yield back.
Will the gentleman yield?
I'm going to yield back. Is there further debate on the amendment? Hearing none, the question now occurs on the amendment offered by the gentlewoman from Michigan, Ms. Tlaib. All those in favor, please say aye.
Aye.
All those opposed, say nay. Nay. In the opinion of the chair, the nays have it, and the amendment is not adopted.
Recorded vote requested.
A recorded vote is requested by both the ranking member of the full committee and Ms. Tlaib of Michigan. Raise your hand if you wish a recorded vote. A sufficient number having raised their hand, a recorded vote is ordered pursuant to C5 of Rule 3 of the committee rules. Further proceedings on this amendment are postponed. Is there an additional amendment to Mr. Stiles' amendment in the nature of a substitute?
Mr. Chairman, I have an amendment at the desk.
Ms. Williams has an amendment of the desk. We'll pause and wait for it to be distributed.
Mr. Chairman, I reserve a point of order.
The clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Ms. Williams of Georgia, designated as 31.
The amendment will be considered as if read, and the gentlewoman from Georgia is recognized for 5 minutes in support of this amendment.
Thank you, Mr. Chairman. Y'all, my number one priority in Congress is to close the racial wealth gap. And if we're going to build black wealth and an economy that works for everyone, lawmakers have to work with our partners in the financial services industries. And let me tell you, nowhere is that more important than in my home city of Atlanta, which has the largest racial wealth gap in the country. Building wealth is important to my constituents, and it's important to me too, y'all. I'm someone who went from being unbanked and living paycheck to paycheck to having the honor of representing my community in Georgia's Fighting 5th Congressional District. So this markup is kind of personal today. We need more stories like mine where people can achieve the American dream. I know that we need to embrace innovation if everyone is going to experience the promise of America. And as financial technology develops, Congress can't sit idly by and hope that the rules of the road will right themselves. Congress has a responsibility to keep up with innovators and make laws that give both industry and consumer certainty and predictability. So, y'all, we got started on that process last Congress. Former Chairman McHenry and Ranking Member Waters had productive discussions toward a bipartisan stablecoin regulatory framework, but the bill we have before us today kind of discards a lot of that progress instead of building on it. Today, we have a bill in front of us that would allow Donald Trump to issue his own stablecoin and create loopholes so that his rich buddies continue to get even richer. Unfortunately, as currently written, this legislation doesn't uplift both industry and consumers, which should always be our goal. Nonetheless, I think it's important to govern how we want to be governed. So I'm going to offer a common sense, bipartisan supported amendment. It won't completely fix all of my concerns with this legislation, but it'll make it a lot better for people back home. Even more importantly, it'll model how we should be putting together a bill as important as this. So let me break it down to you because it's really short, really simple. All the stable coins we're regulating under this bill have to hold reserve assets for them to have value. In this bill, we spell out what kind of assets count, like coins and currency, treasury bills, and demand deposits. All my amendment says that is if those assets become tokenized or digital in the future, those assets are still eligible to back up stablecoins. This amendment is a clarification. It's good for the stablecoin industry, and it's good for our constituents who want us to responsibly embrace innovation. And you don't actually have to just take my word for it. My amendment matches word for word a provision of the Genius Act, a Senate stablecoin bill that got marked up on a bipartisan basis with every Senate Republican on banking, housing, and urban affairs supporting it. It's supported by industry, and this should get unanimously passed into this base bill. So I urge my colleagues to join me in legislating on a bipartisan basis and passing my amendment. I yield back, Mr. Chairman.
Who seeks recognition? Ms. Waters, ranking member of the full committee, recognized to strike the last word.
Thank you very much. I do believe that Ms. Williams has offered this amendment because there was some discussion along the way about what reserves, how the reserves are handled on the blockchain. And I would now request a colloquy with Mr. Foster to see if he dealt with this issue. As I am examining it, it seems as if not enough attention has been paid to whether or not tokenized reserves on the blockchain is somehow better than the digital reserve. Are you familiar with this?
My apologies, I just stepped into the hearing here. I don't know the context, so I'd prefer to wait.
Okay, reserving my time. Ms. Williams? I do believe that what you are describing ensures that the reserves are real and that they are can be counted on. Would you further delve into that? I would yield to you to help further explain that.
Absolutely. So every currency needs to have actual assets to back it up. And in this bill, it spells out what those assets can be: currency, coins, demand deposits, treasury bills, and more. And all my amendment says is that if these assets are digitized in the future, that they're still eligible to serve as reserves for stablecoin. And it's just a clarification to be helpful as the technology continues to develop.
I don't think it makes any difference. Thank you very much. I would urge support for Ms. Williams' amendment.
Gentlewoman yields back. The gentleman from Wisconsin, the author of the bill, Mr. Stahl, you're recognized to strike the last word.
Thank you, Mr. Chairman. I'll be brief. I rise in opposition to the amendment. The amendment's unnecessary. Reserves in tokenized forms would already be captured. And so, for example, a registered money market fund that is tokenized would be a qualified reserve. So the amendment is unnecessary. I would urge my colleagues to oppose it. In brevity, I'll yield back.
Gentleman yields back. Is there any further debate on this amendment? Anybody speak in favor? Hearing none, the question now occurs on the amendment offered by the gentleman from Georgia, Ms. Williams. All those in favor, please say aye.
Aye.
All those opposed, you'll signify by saying no. No. In the opinion of the chair, the nays have it. The nays have it. The amendment is not adopted.
Recorded vote requested.
Recorded vote is requested. All those in favor of recorded vote, please raise your hands. A sufficient number having raised their hand, a recorded vote is so ordered. Pursuant to Section C5 of Rule 3 of the committee rules, further proceedings on this amendment are postponed. Is there an additional amendment to Mr. Stiles' amendment in the nature of substitute? Mr. Lynch is recognized.
Mr. Chairman, I believe I have an amendment at the desk.
Stand by and we'll have it distributed.
Thank you so much.
Clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Lynch of Massachusetts, designated as 29.
Without objection, the amendment will be considered as read, and gentleman from Massachusetts, Mr. Lynch, is recognized for 5 minutes in support of this amendment.
Thank you so much, Mr. Chairman. Mr. Chairman, I am thankful that this most recent iteration of the bill, the Stable Act, does preclude paying interest for stablecoin issuers to pay interest on payments. So I'm thankful, because that would have introduced a whole host of issues that we would have had to get into, but thankfully we can avoid that. The one gap here is, however, that it does not preclude a stablecoin exchange or crypto exchange from collecting interest, or paying interest rather, to depositors. And so that does present a whole host of concerns if exchanges now were to be in competition with savings banks and others for resources, especially the fact that so much has to be held in reserve. In many cases, the reference denomination is the US dollar, and so those reserves would be held in dollars. This amendment would prohibit crypto exchanges or other parties affiliated with stablecoins from paying interest or yield to stablecoin holders. While this bill does not include a provision that would prevent a stablecoin issuer from paying interest or yield to a holder, it does not prevent an exchange or other party from paying attractive yields on stablecoins. We've already seen the incentive crypto exchanges offer to attract stablecoin holders. Coinbase offers a 4.1% APY to its customers holding their stablecoins at Coinbase. The exchange even pays a higher 4.5% to consumers who hold Circle's USDC. Given that Coinbase and Circle are now business partners, the companies share revenues produced by Circle's USDC, and additionally, Binance offers even higher yield of 11% on USDC. So these types of business arrangements between stablecoin issuers and exchanges are a clear example of how closely stablecoins are connected with cryptocurrencies, and it refutes the claims that stablecoins do not pay interest. This essentially makes stablecoins an investment option and not just a mechanism for payments. Additionally, I have concerns about how these types of offerings will impact credit availability, particularly for local communities. I'm skeptical of claims that stablecoins issued by non-banks will not compete with bank deposits and undermine the ability of banks to make loans to consumers and Main Street businesses. Allowing crypto exchanges to pay interest on stablecoins would create competition between non-banks and FDIC-insured banks. Non-bank issuers would also face much lower compliance costs than traditional banks, allowing them to offer significantly higher interest rates, creating an unfair playing field. When consumers put fewer deposits into banks, it leaves local banks with less credit availability and therefore less capacity to support local communities through loan programs. Also, siphoning off deposits will harm the very local and community banks, which my colleagues on the other side of the aisle have stated they would like to protect. This amendment would prevent the bill from creating unnecessary and harmful competition between non-banks and FDIC-insured banks, ultimately harming Main Street businesses. That's about it, Mr. Chairman. Thank you, and I yield back.
Gentleman yields back. Who seeks recognition?
I seek recognition. Strike the last word.
Mr. Stahl.
Thank you, Mr. Chairman. Move to strike the last word. The amendment would undermine deliberately chosen language in Section 489 of the Stable Act. The restrictions carefully focused to preserve payment stablecoins as payment instruments that are backed one-to-one, not as investment instruments provided by the issuer. So to include other entities under that prohibition would be inappropriate in this bill. which is concerned with ensuring strong reserves maintained by the issuer for these payment instruments. So as you know, we're working on other digital asset legislation, including digital assets market structure, and I'd encourage my colleague to work with us on clear guidelines related to this issue as it applies to other types of entities beyond issuers. So I appreciate the amendment, but encourage my colleagues to vote no. Mr. Chairman, I yield back.
Gentleman yields back. Is there further debate on this amendment? The gentleman from California, ranking member, recognizes strike the last word.
Thank you very much, Mr. Chairman. I'm listening carefully to Mr. Lynch, and I'm listening from your side of the aisle, and it seems as if there's some agreement that these stablecoins should not be issuing interest, that it should be done by the exchange. Am I to conclude that basically there's some agreement? Mr. Hill?
Mr. Stahl.
I wish to enter into a colloquy.
I'd be happy to.
I just said that, based on what I think I just heard from you, is that there appears to be some agreement about stablecoins should not be issuing interest, and that you guys have given this some thought, and you are open to taking a closer look at this in order to make sure that it's the exchange rather than the issuer, and that you want to work further with us on this. Is that correct?
I'm definitely interested to learn more about you and your colleagues' position. I think it's important that we're preserve, as it relates to stablecoins, that we're focused to preserve the payment stablecoins as payment instruments that are backed one-to-one. But I'd be happy to engage in further dialogue, in particular as we go about completing the drafting of the market structure bill that'll be introduced for this Congress.
Thank you very much. I support this amendment by Mr. Lynch, and I yield to Mr. Lynch.
I thank the gentlelady for yielding. Yeah, we get the one-to-one backing. We get that. The last 6 or 7 stablecoins that failed all had one-to-one until they didn't. That's the whole idea. That's when they broke the buck, right? So I understand that stablecoin issuers themselves will not be able to pay interest. However, there are arrangements between issuers and exchanges like Circle and others where they have partnerships with exchanges. So what they could do, and I imagine what they will do, is they will park their stable coins at the exchange. And the exchange, under this bill, is allowed to pay interest. So that would defeat the efforts by the bank. The traditional banking community has been lobbying both the House and the Senate to get rid of that stablecoin paying interest capacity. But now it just moves to the exchange, and the exchange will pay the interest, and the exchange will compete with the traditional banks and compete for deposits. That's what I'm trying to get at with this amendment. I'm trying to get rid of that. I would like for depositors at banks to have an advantage here because their deposits are insured at traditional banks. We don't want them to begin parking their deposits at uninsured exchanges to the detriment of the lending community that services local communities. That's the idea here. It would put traditional banks, because of all the regulations that they've got to abide by, it would put them at a serious disadvantage. And it would create an advantage for the exchanges. They'd be able to pay higher interest rates for parking, stable coins at the exchange, and they would outcompete eventually that base that's located right now at our traditional banks. So it would be bad all the way around. And I yield back to the ranking member.
Reclaiming my time, I would simply ask for support for Mr. Lynch's amendment. It seems as if we're all thinking the same way about how we deal with this question of interest. And we have a lot of consideration as we look at our lending institutions, et cetera, about perhaps what maybe look like competition. So I ask for an aye vote on Mr. Lynch's amendment.
Who seeks recognition? Is there further debate on the amendment? Hearing none, the question is now occurs on the amendment offered by Mr. Lynch of Massachusetts. All those in favor, please say aye.
Aye.
All those opposed, please say no. No. In the opinion of the chair, the noes have it, and the nays have it, and the amendment is not adopted. A recorded vote is requested. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is so ordered. Pursuant to subchapter C5 of Rule 3 of the committee rules, a vote on this amendment is postponed. Is there further amendment to Mr. Stiles' amendment in the nature of a substitute? Mr. Lynch?
Mr. Chairman, I believe I have an amendment at the desk.
Amendment at the desk. Will pause while it's distributed.
Mr. Chairman, I reserve a point of order.
Gentleman from Wisconsin reserves a point of order.
Thank you so much. Thank you.
Mm-hmm. Mm-hmm. Clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Lynch of Massachusetts, designated as 11.
The amendment will be considered as read, and I yield to my friend from Massachusetts 5 minutes in support of his amendment.
Thank you very much, Mr. Chairman. This amendment is crucial to ensuring the stability of our financial system and protecting consumers from potential harm. This amendment would require all issuers and distributors of stablecoins to be federally insured depository institutions. Without this requirement, we are opening the door to significant risks, runs on these assets, failures, and ultimately a destabilized economy. Stablecoins are functionally like bank deposits. Issuers make a promise to redeem them on a dollar-for-dollar basis whenever the consumer requests it within a certain time. As my colleagues would likely agree, products that have the same risk should be required to comply with the same regulations. Therefore, stablecoins should be regulated like deposits. Institutions insured by the FDIC benefit from critical protections such as deposit insurance, regulatory oversight, and supervisory powers that ensure our financial system stays secure. We also have procedures in place for resolving failed banks, capital requirements to safeguard the stability of these institutions, and measures to ensure that they remain safe and sound. The Biden administration's President's Working Group recommended that Congress pass legislation prohibiting persons other than federally insured depository institutions from issuing stablecoins in order to provide for supervision, prudential standards, and access to a federal safety net. The STABLE Act provides a path that would incentivize most stablecoin issuers to bypass these protections, either by choosing to be uninsured state-based issuers or by selecting an uninsured OCC-chartered non-bank issuer option. This move would exclude key regulators like the FDIC, the Federal Reserve, and the NCUA from playing a meaningful role in establishing the safeguards we need for this market. Additionally, in the event of failure, the FDIC must be able to step in as a conservator or receiver. This would avoid bankruptcy proceedings for the stablecoin subsidiary as long as the FDIC determines that conservatorship or receivership for the parent bank is the best course of action. I remain deeply concerned about the risks posed by uninsured deposits in this space. Advocates for the stablecoin industry claim that these products are fully backed 1-to-1, and that the reserve requirements are more than sufficient. But history has shown us time and time and time again that uninsured deposits are vulnerable to systemic runs. When you tie stablecoins to volatile crypto products, that risk only increases. And when you allow stablecoin issuers to be involved in other commercial activities that invite risk, that risk multiplies exponentially. We should not forget the lessons from the failure of Silicon Valley Bank. Circle, one of the top stablecoin issuers, held a $3.3 billion deposit in uninsured deposits at the Silicon Valley Bank, representing a significant portion of USDC's total reserves. When SVB failed, USDC's value dropped below 88 cents, and it only retained its $1 peg after the federal government intervened and bailed out those uninsured depositors. If we don't act now to regulate stablecoins properly and provide a strong safety net, the risk of widespread runs on these assets becomes real. This amendment ensures that stablecoin issuers are subject to the same protections that our insured depository institutions must adhere to. It would create a regulatory framework that protects consumers, promotes financial stability, and safeguards our broader economy. We have a duty to act in a way that guarantees these assets are issued responsibly, and I urge my colleagues to support this amendment, and I yield.
Would the gentleman yield for a question?
I would.
Yeah, thank you, sir. The intent of the amendment is that it prohibits a non-bank from issuing a stablecoin. Is that fair? Because the way I read it, it says, notwithstanding any of the provision, only a sub of an insured bank may issue a stablecoin. So you prohibit non-banks.
If they acquired deposit insurance, they could do that.
Well, but we
They could
don't
operate.
Okay, well, we don't. But non-banks aren't subject to deposit insurance. You're saying that if that regime.
That's what we wanted to do. Yeah, we want to import that regime.
I see. Okay, so you're actually arguing that all stablecoin issuers should be FDIC insured.
Correct. Yeah.
Okay, when you look at the actual amendment, the implication was you're prohibiting because you're amending this bill that permits both, that you're, since it's running out of time, I'll yield back to you. But I now understand your point.
Okay. Thank you, Mr. Chairman.
I thank the gentleman from Massachusetts who yields back. Is there others to speak on Mr. Lynch's amendment? Hearing none, then I will call the question without objection. The amendment is, let's see, the question is now on the amendment by Mr. Lynch of Massachusetts. All those in favor, please say aye. Aye. Any opposed, say nay. Nay. In the opinion, sure, the nays have it. The nays have it, the amendment is not adopted. Would you like a recorded vote? Gentleman asked for a recorded vote. All those in favor, please raise your hand. A sufficient number having raised their hand, a recorded vote is so ordered pursuant to Section C5 of Rule 3 of the Committee Rules. Further proceedings on the amendment are postponed. Is there additional amendment to the amendment in the nature of substitute? Mr. Caston, would you seeking recognition? You're back. We're back live now. Mr. Caston seeks recognition. There's an amendment at the desk, and we'll pause for it to be distributed.
Mr. Chairman, I reserve a point of order.
The gentleman from Wisconsin reserves a point of order. Thank you so much. Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Caston of Illinois, designated as 38.
The amendment will be considered as read, and I now call on my friend from Illinois, Mr. Caston, for 5 minutes to explain his amendment.
Thank you, Mr. Chairman. So this amendment would address potential undisclosed financial relationships between stablecoin issuers and cryptocurrency exchanges or other financial institutions. As we know in this committee, and certainly spent enough time talking about it today, dollar-backed stablecoin issuers tend to mint and burn new stablecoins only when institutional customers that purchase tokens in large quantities, including exchanges, fintech firms, et cetera, before they're made available to retail clients or secondary markets. We also know that's a potential risk. In 2021, a year before its collapse, Terra USD fell below its dollar peg to 90 cents. This was an algorithmic stablecoin, of course, but we found out later that it recovered thanks to a secret deal with the U.S. high-speed trading firm Jump. Jump agreed to purchase tens of millions of dollars worth of Terra to push its price back to $1, but in the terms of that deal, Jump was allowed to buy Terra and Luna at 30, 40, and 50 cents over the next 3 years, leading to more than $1 billion of profits. That is illegal, and in fact, the founder of Terra was convicted of fraud. A subsidiary of Jump was settled a fine, both of which were brought by the SEC. Yes, that was an algorithmic stablecoin, but similar market manipulation could happen with fiat-backed or other payment stablecoins, and nothing in this bill prevents that from happening again. To the contrary, I think it makes it more likely because on page 75 of this bill, it explicitly says that payment stablecoins are not securities, which would virtually guarantee that the SEC could not prosecute market manipulation by stablecoin issuers of the type that happened with Terra Luna. This amendment simply fixes that. It would require stablecoin regulators to adopt anti-deceptive practices and anti-manipulation rules that are consistent with CFTC rules required by Dodd-Frank. As you'll remember, Mr. Hill, I had offered a similar amendment during the stablecoin markup last Congress, and you had offered to work with our office on the issue under many subsequent legislation. So I'm just trying to make sure that we address this now. And I hope the text is simple enough that it can reach bipartisan amendment to make sure that we close this proverbial barn door. Thank you. I yield back.
Gentleman yields back, seeks recognition. The author of the bill, Mr. Stile, recognizes to strike the last word.
Thank you very much, Mr. Chairman. I'll be brief yet again. Appreciate my colleague's concern, appropriately focused on manipulation, fraud, deceptive practices. It's just that they're already illegal, and so this bill is unnecessary and duplicative. The underlying text provides strong regulatory and supervisory oversight to prevent these violations, so I agree with the underlying intent to prevent manipulation, fraud, deceptive practices. The good news is they're already illegal, and the underlying bill addresses the concerns the gentleman raised. So I urge my colleagues to vote no, and I'll yield back to you, Mr. Chairman.
Gentleman yields back. The gentleman from California, the ranking member of the full committee, Ms. Waters, recognizes to strike
I
the
move to
last
strike the last word.
You're recognized.
This amendment would incorporate strong anti-manipulation language to this bill. Market manipulation in the crypto ecosystem remains a significant concern for many of us. We've seen time and time again how bad actors engage in schemes that impact the value of stablecoins and can lead to what is known as depegging. I hope Republicans will honor their commitments from last Congress to Mr. Caston by accepting this amendment. I appreciate the statement that was just made about, oh, this is already taken care of in the underlying bill. That's not good enough. As a matter of fact, if it's synonymous, what's in the underlying bill, then it certainly would cause no harm. It would just reinforce. And so I would expect that the opposite side of the aisle here could simply show some degree of cooperation on an issue such as this that really does no harm, but rather enforces the fact that we're all concerned about manipulation. I would ask for an aye vote on the amendment. I yield back.
Gentlewoman yields back. Is there further discussion on the amendment? I'll recognize myself for 5 minutes just to reiterate that I agree with Chairman Stile on this fundamental practice is certainly embedded in federal law in the oversight of this act. But I also acknowledge and recall our discussion last year as we discussed Fit 21 and stable coins in that committee markup, that we'll take this language, certainly work with you on it as we think about the bill text, and also take it into account as we think about drafting the Fit 21 2.0 bill, which this committee will consider in the next few weeks. And so we will continue to work with my friend from Illinois, but I do urge our colleagues today to reject the amendment as it is today, and I yield back.
Mr. Chairman?
Yes, Mr. Lynch, strike the last word.
I rise in support of Mr. Caston's amendment, and I yield my time to Mr. Caston.
Yep.
Thank you, Mr. Lynch. I want to just quickly comment on my friend Mr. Stiles' comment. It's fine to say something's illegal, but saying that something's illegal while you fire the sheriff it creates an enforcement problem. And there's a lot of things that happen in the crypto ecosystem that are illegal. You know, having the broker and the dealer and the exchange all being the same people issuing tokens, wash trade, and all that's illegal. But if we're not beefing up the enforcement agency, then we are not actually making it less likely to do that crime. And of course, some of the challenge with crypto is that these transactions are so fast and so immediate and so easy to hide the paper trail that we are inviting more crime. The analogy that I would use is I would encourage everybody, for a whole lot of reasons, go rent Beverly Hills Cop. German bearer bonds as a tool to facilitate money laundering is illegal. The Beverly Hills Police Department knew it was illegal, but they didn't have the enforcement arms to go through and prosecute that crime until they drew on some resources from the Detroit Police Department, who sent out a young man to come out and help them crack that case. What we find here is a situation where we're saying, right now the Beverly Hills Police Department has jurisdiction over this, that being the SEC. We're going to say this stuff is illegal, but I'm going to move this all to the jurisdiction of the town I live in, Downers Grove Police Department, much smaller town. Good police officers, don't get me wrong, they're good friends, but they don't have the resources. When we're taking this out and we're saying we're not going to use the SEC, but we're going to move this into the CFTC that's maybe a tenth the manpower of the SEC, saying that it's illegal while you're simultaneously getting rid of the police department is not a way to limit crime. So if we care about this stuff, if we don't want these markets to be manipulated, then let's include this amendment, and I hope that at some point we can also make sure that we beef up the number of Axel Foleys out there that can go and shut down this crime. Thank you, and I yield back to Mr. Lynch.
Gentleman yields back to Mr. Lynch.
If there are no other members that need time, I will yield back to the chair. Thank you.
I'm a sucker for an Eddie Murphy analogy, so I thank the gentleman from Illinois. Is there further discussion on Mr. Caston's amendment? The gentleman from Wisconsin.
I move to strike the last word.
Gentleman right
Many of the benefits of blockchain.
You've already spoken. The gentleman from Ohio.
Move to strike the last word.
Gentleman's recognized.
I yield to the gentleman from Wisconsin. Well, as fitting as the analogy is, and a good one, as Mr. Stiles pointed out, it is already illegal. There are cops on the beat, and frankly, far more responsible than where Gary Gensler was basically just putting everyone in jail that he didn't like. I yield back.
Gentleman from Ohio yields back. Is there someone seeking recognition on the Caston amendment? If there's no further debate, the question now occurs on the amendment offered by the gentleman from Illinois. All those in favor, please say aye. Aye. All those opposed to say nay. Nay. Opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted. The gentleman requests a recorded vote. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is so ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, action on this amendment is postponed. Is there an additional amendment to Mr. Stiles' amendment in nature of substitute? Mr. Caston? We'll pause for its reporting.
Oh,
Mr. Chairman, I reserve a point of order.
Gentleman reserves a point of order. The clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Caston of Illinois, designated as 35.
Without objection, the amendment will be considered as read. And my good friend from Illinois, Mr. Caston, is recognized for 5 minutes in support of his amendment.
Thank you, Mr. Hill. So this amendment would require stablecoin issuers with more than $1 billion in assets to prepare an annual financial statement, undergo a formal audit by an independent public accountant, and submit such statements and audits to applicable federal or state regulators. This is comparable to audit requirements for FDIC-insured financial institutions. Now, currently, under this bill, stablecoin issuers would have to prepare monthly reserve reports that are examined, that's the term of art in the bill, by an accounting firm registered with the PCAOB. Examined is not the same as an audit, and it's worth talking about this distinction. Stablecoin issuers have issued and continue to issue reserve reports. That's to demonstrate that they have sufficient collateral to back the total number of stablecoins in circulation. But these reserve reports only represent a snapshot of an issuer's balance sheet at a particular moment in time. The analog I'd make to all my colleagues here, because it's the beginning of a new quarter, which means that all of us were probably spending some part of the last few weeks going out and trying to raise as much money as we could into our campaign accounts. And we all did the thing that we all do where we defer making payments because we want to show as much cash on hand at the end of the quarter. That's fine. You also wouldn't catch that in the absence of an audit that's going through and looking at what your actual practices are that you're using. An audit is a different beast. Because those examinations don't review the underlying data to confirm whether the issuer's claims about its reserves are materially accurate. They don't express an opinion about the adequacy of reserves or financial stability. They don't measure the effectiveness of a stablecoin issuer's internal controls or governance. All that stuff is captured in an audit. And PCAOB has in fact recently warned investors to exercise extreme caution, their words, when relying on reserve reports. Their 2023 advisory said that reserve reports, quote, do not provide any meaningful assurance to investors or the public. The SEC and PCAOB have pointed out that there are no specific requirements for the terms of these examination engagements. Again, there's a big difference from an auditor. You hire a GAAP auditor, they are going to set the terms. In these cases, the stablecoin issuer is setting those terms. So even if you have the same auditor in two different firms, they may be given different terms and have very different definitions. So it's clear that reserve reports, even with examination, can be unreliable. That is not to suggest that reserve reports aren't valuable. They just are incomplete in the absence of a full audit. So what we're trying to do is, if we're going to make sure that stablecoins are in fact stable, that we staple these examination requirements to a proper complementary audit. In the spirit of bank-like activities, bank-like regulation, I'm hopeful that all my colleagues will support this amendment to put stablecoin issuers and FDIC-insured financial institutions on the same level playing field. Thank you, and I yield back.
Gentleman yields back. Mr. Stile, author of Stable Act, is recognized. Oh, do you continue to reserve your point of order?
I waive my point of order and move to strike the last word.
The gentleman's recognized for 5 minutes.
I appreciate it, Mr. Chairman. Appreciate my colleague's amendment. It brings up an important topic. The Senate bill, our counterpart, the Genius bill, has a similar type framework. They have a $50 billion threshold. The amendment as proposed is a $1 billion threshold for these audit requirements for issuers. I think it's really important to tailor the regulatory burden to the size and scope of the entity. And so open to working with my colleague as we work to take this bill from the committee to the floor. However, I'd urge my colleagues to oppose the bill in its current form, or the amendment in its current form, for the fact that the threshold put forward is too low and onerous. So I appreciate the intent in which it was offered. I'd be happy to continue to work with my colleague from Illinois on the topic. He brings up an important point, an important topic, something I'm willing to work on, but I'd urge my colleagues to vote no on the amendment before us.
Would the gentleman yield just for a quick response?
I will yield.
So I think there's a structural issue of, are these going to be regulated essentially as deposit-taking institutions that are earning interest on the money and are able to play with that money, or not? The $1 billion threshold is to tie this to the FDIC rules because we don't want to create an arbitrage opportunity in between. We got plenty of examples with Tether specifically, right, where they're taking deposits, they're loaning those out. Nobody's got any clarity about what the heck is inside Tether. They've never provided an appropriate audit. And if we're going to maintain a structure within the overall piece of this bill where stablecoins are not at the end of the day very stable and very boring, then we need to make sure that we've got thresholds that are no different from what we have inside banks, where they're hypothecating assets, they're loaning them out, there's less liquidity in there. So I think as it sits right now, given where some of the other amendments sit, we should make sure that this aligns with the FDIC rules. Maybe there's another scenario, but that would require a lot more surgery to this bill to get to a point where we aren't just creating an arbitrage opportunity for anyone between $1 and $49 billion.
I'll reclaim my time. I appreciate the concern. I think directionally, I'm aligned with what you're generally trying to do. I would note that there's significant differences here because these aren't deposits that are being rehypothecated. We're not talking about banks. We're talking about stablecoins in the context of a payment tool. And so while I appreciate the intent in which the amendment is over, I don't think that analogy is an exact correlation to the issue that we're addressing. Again, to the core concept of tailoring the regulatory burden to the size and scope of the entity. I am of the view that the threshold is offered by my colleague is too low. Again, I note the Genius Act on the Senate side has a similar structure as it approaches about $50 billion. Again, open to continuing this dialogue as this bill moves into final form, enters the floor, or goes forward. I will yield to the chairman of the full committee, Mr. Hill.
I just want to thank the two of you for your discussion of this. I think setting solid audit standards in this regard are merited, and I hope that you guys would work together on the style of those audits and a dollar amount. I understand my friend from Illinois, why he's suggested the amount, and look forward to working with you on that, and thank you for the colloquy.
Mr. Chairman?
It's my time. I'd be happy.
I thought you were done. I'm sorry.
No, I yield back to the chair.
Gentleman yields back. Who seeks recognition?
Mr. Chairman?
The gentleman from Massachusetts, Mr. Lynch, recognizes
you.
strike the last word.
That's a interesting, first of all, I want to support Mr. Caston's amendment. I think audits are absolutely necessary given the opaqueness of some of these systems. What I worry about as well is that as a stablecoin issuer decides what architecture to use, if they choose a public permissionless blockchain, it will be, first of all, it's impossible to figure out who is behind each node because those are in many cases anonymous. They're often bad actors. So you question whether the efficacy of an audit, whether it's adopted within the bill, will be possible. Because, and this goes to another amendment that I have, but right now, an issuer could just establish a public permissionless blockchain where we don't know who these people are, and there's no requirement for them to cooperate with an audit and to get at, what's behind the reserves and who the parties are. So I certainly support the idea of an audit. I just, without a requirement that it be a permissioned blockchain where people actually know who each node is, and there are legal recourses against those individual node operators if they don't cooperate in a lawful way, in a legal way. It could be, there could be recourse there. So just want, I do support the ongoing discussion between the chairman of the committee and Mr. Caston, but I do want to point out some of the other operational difficulties that might exist beyond that, beyond the fact of the audit itself. And unless Mr. Caston needs my time, yeah, I'll yield my additional time to Mr. Caston.
Thank you, Mr. Lynch. I just want to raise just one point about this size threshold. Let us presume for a moment that somebody says, I'm a $49 billion asset under management stablecoin, therefore I'm not subject to compliance. How do you know that? Well, because I brought in somebody to examine my reserves who, subject to my own rules, said it was $49 billion. Was it audited? No, I wasn't required to. The $49 billion, this is a lot of money, right? So we have an unaudited number, and now what happens if that entity is sitting there saying, well, my reserves are actually not what they claim to be? All of a sudden, there's a run on that stable coin, and that very quickly leads to contagion and wherever their other banks are and how you get this through. It seems to me that asking a $1 billion institution, which is not, this is not a tiny institution that can't afford to hire an auditor, right? Much less a $49 billion institution to say, get an auditor to say that if you're going to tell us the size of your operation, then we'll make a decision. I don't know how we would ever trust somebody says, I'm less than 50 billion and just trust me because I set the rules of my own valuation metrics. So I don't think this should be super complicated.
Will the gentleman yield?
I yield back to.
Of course, yeah.
I would note, just for the record, the bill has monthly attestation requirements to be certified by a CPA. So I think it'd be maybe misleading to say that there's no requirement. Then the question is, how do we scale the regulatory burden to the size and scope? Again, more than willing to work with my colleague as to what is the appropriate size and scope. We could dialogue that. I'm of the personal view that the threshold offered by my colleague is too low, but I think it would be an inaccurate statement to say that there's no requirement. The requirement is simply scaled. So it'd be a monthly attestation requirement to be certified by a CPA, a lower standard than an audit, as noted. That's correct. But the threshold for the audit, as suggested by my colleague, to me is too low. I'm encouraging people to vote no. But I am very open to engaging in an analysis and a dialogue with my colleague to find that appropriate threshold. And again, I note, just for sake of comparison, our colleagues in the Senate found 50 billion to be an appropriate number. So look forward to the conversation working with my colleagues, and I'll yield back to you, Mr. Lynch.
Yeah, thank you. Perhaps our colleagues in the Senate were anticipating Meta or somebody coming in big there. That's why they put the 50 billion mark on that. But again, Mr. Caston, do you need more time? Okay, then I yield back, Mr. Chairman. Thank you.
Gentleman from Massachusetts yields back. Who seeks recognition? Appreciate that discussion. If there's no further debate, the question now occurs on the amendment offered by Mr. Caston from Illinois. All those in favor, please say aye. You want to say aye now?
Aye.
Those who oppose the amendment say nay. Nay. Independent chair, the nays have it. Nays have it. The amendment is not agreed to.
Request a recorded vote.
The gentleman from Illinois requests a recorded vote. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is so ordered pursuant to Section C5 of Rule 3 of the committee rules. Further proceedings are postponed. Is there an additional amendment to Mr. Stiles' A&S?
Mr. Chairman.
Gentleman from Massachusetts.
Thank you, Mr. Chairman. Mr. Chairman, I have an amendment at the desk.
We'll pause and have it distributed.
Thank
you. The amendment standard gap is 5 minutes.
Mr. Chairman, I would like to reserve a point of order.
From Wisconsin reserves a point of order. Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Lynch of Massachusetts, designated as 28.
Without objection, the amendment will be considered as read, and Mr. Lynch is recognized for 5 minutes to explain his amendment.
Thank you, Mr. Chairman. This amendment would simply require stablecoin issuers to issue their products on permissioned blockchains. Just to elaborate a little bit, permissionless public blockchains, which some of them use, many of them use, are databases that are hosted on multiple different computer servers, each of which is known as a node. Instead of having one centralized entity host and maintain the database, each node runs software that allows it to host a version of the database. Permissionless means that any computer running the necessary software can become a node. There's no identification or vetting involved, which is a problem. Transactions are carried out by updating the database, but because it's quite plausible that a node could be a bad actor, nodes need to be discouraged from approving problematic transactions like double spending or transferring assets to themselves. Public permissionless blockchains rely on game theory-based consensus mechanisms like proof of work or proof of stake to discourage such behavior. So, Mr. Chairman, this amendment would require stablecoin users to issue their products on permissioned blockchains. Stablecoins are built on permissionless blockchains technology right now, meaning anyone with the right software can join the network and become part of that blockchain. This open access structure, while innovative, also comes with very serious risks. The lack of identification and vetting of participants creates a dangerous avenue for illicit activities like money laundering and sanctions evasions. These blockchains do not operate in a vacuum. They require constant vigilance and maintenance to safeguard against security flaws that could compromise the entire system. In light of these vulnerabilities, permissionless blockchains should not be the foundation for any financial services, especially one as critical as stablecoins. We need to move toward permissioned or private distributed ledgers for these types of transactions, and by using a permissioned blockchain, we can ensure that the entities involved are accountable, they're identifiable, and subject to regulation and oversight that is essential to maintain the integrity of our financial system. With that, Mr. Chairman, I yield back.
Gentleman yields back. Who seeks recognition?
Mr. Chairman, I waive my point of order and seek to strike the last word.
Gentleman's recognized for 5 minutes.
Many of the benefits of blockchain, including kind of the resilience, the openness, resistance to falsification, don't apply in the same way, to the same extent in permissioned systems. And so by forcing a choice of blockchain, you're not only taking away the decision from innovators and consumers, but also limiting blockchain future development as open public ledgers. So it really goes at the core of the bill. Indeed, one of the primary value propositions associated with blockchain technology is that it's transparent and open source. Anyone with an internet connection can view and audit the digital ledger of transactions. So if the Stable Act were to require permissioned blockchains, this transparency and accessibility would actually be lost. So Congress shouldn't be in the business of picking winners and losers in technological innovation, and I think we want to remain technology neutral. Moreover, legally mandating permissioned blockchains locks out other innovations, including decentralized, transparent, and open solutions. Technology, it's evolving quickly. As we know, it requires specific design in law, specific design in law ages poorly, and reduces flexibility. So nothing in the Stable Act prevents a payment stablecoin issuer from issuing their assets on a permissioned blockchain. That's still available. If the market decides that permissioned blockchains are more desirable than permissionless blockchains, the bill allows for it, gives it that flexibility. However, Section 5A3BI2 does not let regulators deny applications because stablecoins are issued on an open, public, and decentralized network. And so I think at its core, I disagree with my colleague's approach here. I think at its core, we want to let the market decide what type of blockchain payment stablecoins, what type of blockchains, payment stablecoins should be issued on. And so I don't think you want the heavy-handed approach that I think my colleague's amendment would bring. I think it would stifle innovation. And accordingly, I'm going to urge my colleagues to vote no on my colleague's amendment. Mr. Chairman, I'll yield back.
Gentleman yields back. Who seeks recognition? If there's no further debate, the question now occurs on the amendment by the gentleman from Massachusetts. All those in favor, please say aye. All those who are opposed, say nay. Nay. Pending chair, the nays have it. Nays have it. The amendment is not adopted. Okay. Is there additional amendment?
Yes, please. Recorded vote, please.
The largesse of the chair will permit that.
Thank you. I appreciate it, Curtis.
Recorded votes requested. All those in favor, raise your hands. Sufficient number have raised their hands. Recorded votes. So order pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings are postponed. Is there a further amendment? Mr. Caston.
Amendment at the desk.
Amendment at the desk. We'll pause for bid to distribute.
Mr. Chairman, I reserve a point of order.
Mr. Stile reserves a point of order. Clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Caston of Illinois, designated as 39.
We will consider the text as read, and I would now yield to my friend from Illinois for 5 minutes to explain his amendment.
Thank you, Mr. Hill. So this amendment, when we drafted it last night, and then I got in here as we're bouncing in and out, and I was listening to your exchange with Mr. Foster, and I was thinking I didn't do my homework properly. But I think this amendment is still necessary, and I'm hoping in the exchange we're both in agreement on it. This amendment would limit bank deposits that are eligible as collateral for stablecoins only to those that are insured. This is to protect stablecoin holders' funds during times of market stress and mitigate financial stability risks that a potential run on a stablecoin could cause. Under the current text of the Stable Act, stablecoin issuers would be permitted to invest in assets that are not particularly safe, including uninsured bank deposits. Specifically, page 14, line 16, bill says, quote, funds held as demand deposits at insured depository institutions are eligible to act as collateral, but doesn't state that those deposits have to be insured, meaning that uninsured deposits are also allowed. Now, in a prior draft of this that was posted on the Republican Committee's website on February 6th, it did actually say insured demand deposit, so I don't know if that was an oversight or a strikeout, but I'm hoping that we can get that back in, which would seem consistent with the spirit of the colloquy that you had with Mr. Foster earlier. Stablecoin reserves in the form of uninsured deposits, we know, can create systemic risks because of the panic that occurred when Silicon Valley Bank failed. At the time of that failure, as we discussed earlier in this hearing, Circle held $3.3 billion of uninsured deposits at SVB, which represent a large portion of USDC's total reserves. The value of USDC dropped to 88 cents after they failed, bounced back only after they were bailed out. So we are in a world right now, if we keep the text of the Stable Act as written, where USDC is only considered to be stable because the taxpayers bailed it out, and I don't think any of us want to continue that definition of a quote-unquote stablecoin. Now, the Republican witness at the hearing for this a month or so ago only mentioned algorithmic stablecoins as a risk, but I just want to stress that that is disingenuous. There was a 2023 Bank of International Settlement study of 60 stablecoins, including prominent ones like Circle and Tether, and they found that they had all lost their price peg at least once. That's the opposite of stable. Every single one of them had lost their price peg. Now that is because when investors have doubts about these reserves, they move to quickly redeem the tokens. That can create runs that collapse the price of the stablecoin and cause market contagion. FSOC has called attention to these run risks, warning that, quote, stablecoins continue to represent a potential risk to financial stability because they are acutely vulnerable to runs. Former Treasury Undersecretary for Domestic Finance, Nellie Lang, recently said, quote, for stablecoins to function and not cause or pose risks to financial stability, reserve assets have to be very safe and very liquid. There's a second problem that is also currently in the Stable Act, but it's the exact same problem. The Stable Act also says that stablecoin reserves can include Eurodollars, which are US dollar denominated deposits held at foreign banks. Page 21, lines 18 through 21, directs federal and state payment stablecoin regulators to establish requirements regarding approval for foreign depository institutions to hold deposits as collateral. There is nothing in that section that requires those deposits to be insured. And as we know, the Eurodollar market generally is not insured. It's estimated to have total outstanding value of about 13 trillion with a T dollars. Last year, former SEC Chair Gary Gensler warned that much of that 13 trillion is in U.S. currency held offshore by U.S. banks is in fact uninsured. He'd emphasized that Eurodollar markets have played a role in deepening economic downturns across the globe, including the 2008 financial crisis. So if we can agree, as I think the colloquy with Mr. Foster and Mr. Hill played out, that we need to make sure that that cash assets underlying stablecoins are insured, then FDIC deposit insurance plays an important role in promoting financial stability. And we also need to make sure that a run on US dollar denominated deposits at global banks is not possible. Federal government has incurred significant costs in rescuing uninsured depositors during financial crises many times, 1980, 1992, 2007, 2009, 2023. This bill would invite future taxpayer bailouts, and I don't think any of us want to say that we were here, we were warned, and we chose not to act. So I hope we'll heed these warnings from our regulators, apply these lessons, and just make sure that cash deposits that are used as reserves for stablecoins are in every case insured. Thank you, and I yield back.
Gentleman yields back. Who seeks recognition? Gentleman from Wisconsin.
I'll also waive my point of order.
Gentleman waives his point of order. He's recognized
to
to
strike the last word. Thank you, Mr. Chairman. This is really taking us back to the previous discussion with Dr. Foster. So Section 4A of the Stable Act includes the following as permissible reserve assets. I think it's just let's stage set here. So demand deposits or other deposits that may be withdrawn at any time, held at insured depository institutions subject to limitations established by the FDIC and CUA, respectively, to address safety and soundness risks of such insured depository institutions. So this means that for insurers holding deposits that exceed the deposit insurance limits, they'll be subject to rigorous requirements. So let's think about that. First, the FDIC and the NCUA determine how much in uninsured deposits they're able to hold to help avoid uninsured deposit concentration risk. Second, issuers face reserve asset diversification requirements under the joint federal rulemaking. So this would include requirements covering the amount of deposits an insurer is able to have at a single depository institution. And then third, insured depository institutions already have deposit concentration risk requirements that limit how many deposits they're allowed to hold from a single customer. So if we establish that issuers were only able to hold insured deposits, they'd have to do so with the help of a deposit sweep network, resulting in frictions to redemptions that could actually leave consumers worse off. And so furthermore, my colleagues struck the ability of insurers to hold their reserves at foreign depository institutions. One of the benefits of stablecoins is their ability to be used abroad to process global payments. Section 4 of the Stable Act gives our regulators the ability to jointly determine which jurisdiction or institutions would be appropriate for issuers. So this amendment, in summary, is unnecessary and impedes the payment stablecoin ecosystem from reaching its full potential. So I would urge my colleagues to oppose the amendment as drafted, and Mr. Chairman, I will yield back.
Gentleman yields back. Who seeks recognition? Mr. Foster of Illinois.
Yeah, and just like to, this point about.
Recognize and strike the last word.
Yeah, strike the last word. Just in response to the gentleman's discussion previously, it doesn't seem like a bad thing for the consumer if these things are put into sweeps that spread the stablecoin reserves into multiple insured accounts. It seems, it's regularly done. It is very inexpensive, and it means that you're not going to have one stablecoin that will be shakier than another one and will presumably trade differently than those or behave differently under stress. It's a well exercised model to do that, and I don't see what's the objection to it. There'll be a small fee associated with it. It will make the issuer slightly less profitable, but it seems like that is a very small risk compared to having unlimited numbers of uninsured deposits. I'd be happy to yield.
I'll take the moment there. I think what we're looking at is the resulting friction to redemptions that would exist, and I think the second point is the underlying amendment struck the ability of insurers to hold reserves at foreign depository institutions. And again, one of the core concepts of this is people's ability to use a U.S. dollar-backed stablecoin on a global basis. And so there's layers of risk management in the underlying text of the bill. So I wouldn't want to walk away and say that there's none if we don't take this. There's a robust layer of risk management, kind of as laid out by me, from the FDIC, NCUA, reserve asset diversification, insured depository institutions have deposit concentration risk requirements. And so there's layers of risk avoidance in the underlying bill. I just don't think that the layer that's being offered in the underlying amendment outweighs the burden it places in the friction that it would pose in the system. Yield back.
No, I understand, but I think the friction is going to be a very small impact on the overall profitability of the issuer, and so that doesn't seem to be a major objection to this. I should mention, I'm going to be offering a simpler version of this. That simply, we've had some confusion here in this hearing. The chair has said, I believe repeatedly, that only insured demand deposits are accessible. So I'm going to have a similar amendment that will just insert the word insured where relevant. And that should clarify whether or not only insured deposits are here. Anyway, that was my comment. Can I yield to Representative Caston?
Thank you, Dr. Foster. I just want to point out that if, in fact, there's already all sorts of belts and suspenders in here, it does raise the question of why the February 6th draft was modified, because the February 6th draft that we were first reviewing said insured demand deposit. So there was a decision made by the Republicans here to take that out, and we're now arguing that what's there directing the executive branch to fix this is going to cover that. I would argue in this Loper-Bright era, we should be clear about our intent, not count on the regulators to figure out what we meant. And if I was a bank who was trying to take advantage of this, I'd say, well, they had that language and they didn't put it in there, so clearly that wasn't Congress's intent. Put the language back in. And with respect to Eurodollars, look, I get it. We could make lots of parts of our financial system much bigger, much faster if we took off the brakes. That in and of itself is not valuable. Why would we say that these are stable? if we are going to allow the cash that we are depositing to be in a place where we don't know if it's there when we need it. An uninsured deposit in a U.S. bank is no different from an uninsured deposit in a European bank. If it ain't there, it ain't there. And therefore, it's not stable. And again, we learned this lesson with SVB on this committee. Most of us in this room were here. Most of us remember that point where, I think it was the weekend, we all got pulled over on the side of the road talking to the FDIC and the Treasury saying, holy smokes, this bank is melting down. We have to inject a bunch of money into it. What did we learn from that? If what we learned from that is let's do it again, it's a mistake. This seems like common sense. Yield back to Mr. Foster.
Now yield back.
Gentleman yields back. Who seeks recognition? Mr. Lynch.
You know, and I certainly support Mr. Caston's amendment. I think it's common sense, and it could avoid much of the damage that we expect if one of these stable coins breaks the buck. However, there's also another part of this, which is that the underlying legislation also permits the merger of banking and finance. Banking and commerce. It allows, it basically is unlimited as to what stablecoin, what other businesses a stablecoin issuer might engage in. And, you know, for a very, very long time in this country, that was something that Congress was very careful about and very protective of depositors and protective of the integrity of our financial system. And that's going away in this bill. That's going away. We're blowing it up. So that someone who actually is creating currency out of thin air can also engage in any level or extent of commercial activity, including the biggest players, including Meta and Amazon and X and everybody else. So it really, we're looking at the likelihood that some source of volatility will cause these one or more of these stable coins to break the buck. I think that's automatic. That's going to happen. And so I think what Mr. Caston is wisely trying to do is to limit the damage that might be caused or the likelihood that one of those unpegging event occurs. So I appreciate his thoughtfulness on this, and I hope members will support his amendment. I yield back.
Gentleman yields back. Who seeks recognition? There's no further debate. Question now occurs on the amendment offered by the gentleman from Illinois. All those in favor, please say aye.
Aye.
Any opposed, say nay. Nay. Opinion of the nays have it. The nays have it. The amendment is not agreed to.
Request a recorded vote.
Recorded vote is requested. All those in favor of recorded vote, raise your hands. Sufficient number having raised their hands, recorded vote is so ordered. Pursuant to Section C5 of Rule 3, the committee rules for proceedings are postponed. Is there further amendment? Mr. Ricardo, recognized.
Thank you, Mr. Chair. There's an amendment at the desk.
We'll pause and let the amendment be distributed.
Thank you. It's the one numbered 010. Thank you. This is
Mr. Chairman, I reserve a point of order.
I think we've passed out the wrong amendment.
okay.
You gave me a Foster amendment, not a Ricardo amendment.
Criminal penalties? Yep. No, this is the right one. If it's criminal penalties. Huh? Criminal penalties? Yeah.
Yeah, Ricardo. Yeah. This is Ricardo in Section 3.
Should be 010.
Got it, yeah. I'm here till midnight. Clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Liccardo of California, designated as 1010.
Without objection, the amendment will be considered as read, and the gentleman from California is recognized to explain his amendment.
Thank you, Mr. Chair. Currently, this draft of the bill contains no criminal sanction for the unpermitted issuance of a stable coin, and the current provisions for civil penalties would penalize a violation for up to $100,000 per day. That's under Section 3B3. Obviously, there is concern with regard to this Section 3 around extraterritorial enforcement. The largest stablecoin company in the world is headquartered in El Salvador. And to my knowledge, I don't believe El Salvador is the beacon for sound financial management globally. We should be concerned about this, as well as other companies elsewhere in the world. There are criminal penalties in other parts of this bill. Specifically in Section 4, it criminalizes submission information that doesn't fairly present financial status for monthly certification by a CEO or CFO. Section 4 also criminalizes misrepresentation of FDIC insured status. So there are criminal penalties here, but not for this particular violation, which is the unpermitted issuance of stablecoin. Now, the Senate version does contain this language that would impose criminal penalties for unlicensed issuance. It is of particular concern to me because as we think about what the civil penalties are, up to $100,000 per day, and you consider just the profit last year made by that one company headquartered in El Salvador, Tether, $13 billion last year, $6 billion in the fourth quarter alone. So if Tether wished to operate in an unpermitted state, it could do so at a cost of $9 million for a quarter, in which it earned $6 billion profit. Let me be clear about that. That was profit, not revenue, but net revenue, profit. So to take Mr. Caston's Beverly Hills cop analogy one step further, if the civil penalty for moving some billions of dollars of German bearer bonds with a $6 billion profit was only a $9 million civil penalty, I think most crooks would take that risk. Certainly not suggesting that's the case with this company, that they're in any way crooked or they're intending to be unpermitted. The point is, there is a great temptation for anyone to operate well beyond the bounds of the law. And so I would like to see some more significant penalty imposed here if we're going to ensure that everyone's operating lawfully. Now, I guess through Mr. Chairman, I know that Mr. Stahl and I have had some conversations, and I'd certainly welcome colloquy. I have been informed that there may be some consideration around penalties, and I'd certainly welcome Mr. Stahl's.
Will the gentleman yield?
Yes.
First, appreciate your engagement on this bill. It's been constructive and have enjoyed working with you on the drafting. Would further commit to working with you as we look at the penalties in this section. You're correct, there are criminal penalties in Section 4. It's currently drafted not in Section 3. We want to make sure we right-size the penalties to hold bad actors accountable and very open to further dialogue as it relates to Section 3. And so with that commitment, I would ask if the gentleman would be willing to withdraw his amendment as we work to further refine the bill in this section in particular prior to floor action.
Chair. Yes, I would be willing to withdraw. I certainly can see where the votes have been going. I would also suggest, I think, in negotiation with the Senate, should this pass, as I expect it will in the House, there'll be an opportunity for us to revisit this.
I appreciate that and look forward to continuing to working with my good friend from California.
I'll ask for unanimous consent, then withdraw.
The gentleman's amendment is withdrawn. I appreciate the colloquy and the willingness to work together on this important proposal, and I thank the gentleman from California for it. Is there further amendment? Mr. Foster is recognized.
This is for a new amendment?
The one that was previously passed
I
out?
have an amendment at the desk, yes.
It's at the desk. We'll pause for, I think it's been distributed. May I ask the clerk, no? Yeah, that's what I've got. Yeah. Okay, got it. Pause while the clerk distributes Dr. Foster's amendment.
Mr. Chairman, I'd like to reserve a point of order.
Gentleman from Wisconsin reserves a point of order. The clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Foster of Illinois, designated as 22.
I thank the clerk. The amendment will be considered as read, and I now call on the gentleman from Illinois, Dr. Foster, to explain his amendment.
Yeah, very briefly, my amendment is simply sort of a stripped-down version of Rep. Caston's previous amendment, just to clarify whether the intention here is that uninsured deposits be allowable or only insured deposits. So my amendment simply inserts the word insured 4 places on the last paragraph on page 14, and as indicated. And so that's pretty much it, and I think it'd be very valuable. If you're willing to accept this amendment, then what the chair's indication that only insured deposits will go through. Otherwise, I think a recorded vote will be useful to get the committee on record as to what our intent is here.
Well, I appreciate the gentleman. And I just would, I said to Mr. Caston, I would say to my friend, if he'll yield to me, that, we'd love for our staffs to work with you on this section and make sure everyone on both sides of the aisle fully understands how the banking industry has recommended that this be done for safety and soundness purposes, and make sure you understand the existing authorities in the draft about the limitations that the bank regulators are going to impose as well. So I'm not asking you to withdraw the amendment, but I am explaining to you that I think we ought to have some conversation about it. I'm happy to put it up for a vote again, but I think that would be helpful to you and Mr. Caston as well. But
Yeah, so,
I'll yield back to him.
yeah, thank you. And yeah, I guess at this point, well, let's proceed, but I intend to put it up for vote. It'll just be useful to have everyone on record here.
Yep. The gentleman yields back. Who seeks recognition? If there's no further debate, then the question now occurs on the amendment offered by Dr. Foster. All those in favor, please say aye.
Aye.
Those opposed, please say nay. Nay. In the event chair, the nays have it. The nays have it. The amendment is not adopted.
Request recorded vote.
Recorded vote is requested. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is so ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Is there further amendment? Hearing no further amendments, the question now occurs on ordering the bill as amended, reporting to the House with a favorable recommendation. Those in,
Mr. Chairman?
I've asked twice, but I'll now yield to the gentleman.
We're
if you
waiting
have
for
an
a vote. I thought, I don't know, it just went radio silent there. I didn't understand what you were talking about.
Well, I was looking for something, but we didn't go radio silent. I asked if there was any more amendments, and I didn't hear
Yeah,
anybody say anything.
Yeah,
Okay.
I do, yeah. Thank you.
Gentleman's recognized for 5 minutes. Or, I
Chairman,
beg your
believe
pardon,
I
you've
have
got
an
an amendment at the
amendment
desk.
at the desk, yep.
Wait for the clerk to report it.
Thank you.
Clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Lynch of Massachusetts, designated as 20.
Without objection, the amendment will be considered as read. Gentleman from Massachusetts recognized to explain his amendment.
Thank you, Mr. Chairman. This amendment would prohibit all foreign-issued stable coins from being offered or utilized in the U.S. absent authorization. To safeguard the integrity of our financial system, we must ensure that foreign actors are not able to bypass U.S. regulations and potentially compromise our economic stability. Many of my colleagues also share the concern that if this bill were to become law, there is little to prevent large foreign issuers such as Tether from continuing to operate outside U.S. law, playing by its own rules and undermining the very regulatory framework that we're trying to establish here tonight. I also have grave concerns that this bill might incentivize U.S.-based stablecoin issuers to relocate overseas simply to continue offering their products to American consumers from abroad. This would defeat the very purpose of this bill. Additionally, Tether has repeatedly been at the center of reports linking it to illicit activities, including being a preferred financing method for terrorist organizations and sanctions evaders. This is not a risk we can afford to ignore. If foreign issuers are allowed to operate freely in the U.S., they could continue to exploit the system to facilitate these dangerous activities. According to the Wall Street Journal, which has reported extensively on the abuse of digital assets by Russian middlemen to evade sanctions and trade for billions of dollars worth of weapons parts, quote, for Vladimir Putin's war machine, Tether has become indispensable, close quote. Russian companies have specifically relied on stablecoin to procure drone parts and other high-tech equipment for Vladimir Putin's invasion of Ukraine, with Russian middlemen converting rubles into Tether and paying out local currency to foreign suppliers in China and the Middle East. Our prior oversight work on this committee has evidenced the same. Just last December, we learned that Treasury's Office of Foreign Asset Control sanctions several individuals and entities associated with the TGR Group. This international money laundering network used Tether and other stablecoins to facilitate illicit activity and sanctions evasion on behalf of Russian elites. If this committee wants to maintain a transparent, secure, and accountable U.S. financial market that is the envy of the world, then we need to ensure that foreign actors do not undermine our system. Allowing foreign-issued stablecoins like Tether to operate without proper oversight would only expose American consumers to financial harm, but it would enable bad actors to continue exploiting loopholes in our regulatory framework. So I urge my colleagues to support this amendment to ensure that foreign-issued stablecoins cannot be used as a backdoor to circumvent the regulations that you are working to put in place. This is about making sure that the U.S. remains a leader in financial regulation and that our financial system is not compromised by those who operate outside of our laws. So if we are to pass this bill, it would be great if it actually applied to all stablecoins, and that for those that would not comply, we keep those outside our borders. It's not outside of what you've already considered in the main bill. It just, it harmonizes, I think, our national interests with the purposes of the bill. Thank you, and I yield back.
Gentleman yields back who seeks recognition. Did you reserve a point of order?
I will withdraw my point of order.
You didn't reserve one, but I'm going to assume that you reserved one and then you just withdrew it. Is that fair?
I reserve and withdraw, Mr.
There you
Chairman.
go. Thank you.
And I would move to strike the last word.
The gentleman from Wisconsin has gone to point of order, and he is recognized for 5 minutes.
I thank the chairman. I think it's worth noting that in the United States, we have a history of allowing foreign firms that are from countries with substantially similar regimes to the U.S. to be able to operate in the United States. And so as we leave stablecoins and we think about other financial services spaces, we can think about the banking sector where RBC, Royal Bank of Canada, is able to operate with integrity in the United States. And so as we look back at how we structured the stablecoin bill, the amendment as offered would not allow any person to, and I'm going to quote this, would not allow any person to, quote, transact using a payment stablecoin through the use of any medium or by any means of access to interstate commerce, end quote. So it would set up a structure of punishing an individual from using a foreign-issued stablecoin, maybe that they acquired abroad. So you can envision a scenario where a U.S. citizen travels abroad, they engage in commerce with a stablecoin outside the regime of the United States, outside the jurisdiction of the United States, and then would return back to the United States, maybe with that digital asset in their personal wallet. That I don't think is something that we want to criminalize the behavior of. The Stable Act instead takes what I view as a balanced approach by restricting non-permitted stablecoins' ability to be offered on an exchange, but do not punish individuals for merely having a token in their wallet. And so I appreciate kind of the thought process here of the underlying amendment, but I think the underlying text of the bill is a balanced approach, is well-reasoned, and I think it works well. And I encourage my colleagues to vote no on the amendment before us.
Gentleman yields back. Seeks recognition. The ranking member.
I move to strike the last word.
Gentlewoman's recognized.
This amendment would include critical language that was originally proposed under my bipartisan legislation that I had worked out with former Chairman McHenry, which addresses a loophole for risky offshore firms like Tether to issue a stable coin in the United States. This amendment would simply make it unlawful to issue directly or indirectly a payment stable coin for use by consumers in the United States that is not approved under this bill. This language would ultimately block foreign issuers like Tether, which is the largest global stablecoin issuer, from issuing stablecoins for use by U.S. consumers without being subject to proper regulations, examinations, and enforcement by U.S. regulators. Tether is widely known for its opaque operations and recognized as the stablecoin of choice for criminal activity across the world, like money laundering, terrorism, illegal trafficking, cyber fraud, and more. Financial regulators and policymakers have long raised concerns regarding Tether's violations of economic sanctions and anti-money laundering rules. Tether's attestations also failed to provide sufficient transparency and address concerns about the company's practices. This amendment would ensure U.S. customers are not subject to the risk arising from Tether and similar shadowy stable coin firms without proper oversight. I think I heard Mr. Stiles say there's no need for this, that somehow it's covered or taken care of or will be covered and taken care of. I don't know which he said, but it seems to me we would all be concerned about this. We're forewarned about Tether and some of their past activity and what they're capable of doing. What's wrong with adopting language here today that would ensure that we do not allow them to operate in this manner in this country? Mr. Hill,
Are you yielding back?
I yield to you.
Well, okay. I think the Senate bill was insufficient on this point, and I think our bill is quite clear that a stablecoin issuer that's not incorporated and operating under the laws of the United States may not offer directly or indirectly that stablecoin in the U.S. unless they come into the United States and be subject to the U.S. law, or they operate in a jurisdiction that, like we do for banking and like we do for securities, has a substantially similar enforcement and regulatory system that our Treasury Secretary certifies as substantially similar. This is how we've operated globally. We have, as Chairman Stahl noted, foreign banks, foreign broker-dealers, others doing business in the United States, and they are admitted into the country either as a branch in the case of some banks, or they're operating the company pursuant to a reciprocal arrangement with their host
We're
country.
closing my time, Mr. Chairman.
Yield back to the
I'd like to
gentleman.
get back to Mr. Lynch. He would not have proposed this if he thought it had been well taken care of. I yield to Mr. Lynch.
Thank the ranking member. Look, this empowers our country. So it prevents a foreign stablecoin from being offered directly or indirectly in the United States unless the government authorizes it. So this is a shield. So look, we all know that Tether is operating in Iran. It's facilitating the conversion of resources to Iran, Venezuela, Russia. So this would allow your law that you're passing to be applied to those foreign stablecoins. This would empower what you're trying to pass by giving the ability of Treasury to authorize those stablecoins that you welcome and want to have in the country. But it gives you the ability to reject those that are feeding, terrorism, illegal finance, tax evasion. So,
Gentleman yields back.
this is not a hostile amendment. This was to be in harmony with what you're doing here
Gentleman's
today.
time has expired.
Mr. Chairman,
Who seeks recognition?
Timmons from South Carolina.
Mr. Timmons of South Carolina, recognized to strike the last word.
Thank you. I move to strike the last word. I too want to speak against this amendment. The purpose of the Stable Act is to create a global system that protects consumers and allows digital assets to thrive, not only in the United States, but in the global economy. This is not a U.S. We want to be the center of the crypto future, but we are not going to exclude the rest of the global economy. And while I disagree with this amendment, I actually do have an issue that I'd like to discuss regarding Section 3. And it's from the last 6 years of my time in Congress. My concerns with Section 3 is the role of the Treasury Secretary and their ability to unilaterally deem a foreign regulator out of compliance. So we see the wild swings in policy from administration to administration, whether it is at the SEC, the CFPB, DOJ, FBI, and the business community wants stability. They want predictability. They want to be able to invest long-term and know that the world is not going to so violently change. And if that's not enough, just the predictability aspect of it, we also have the weaponization aspect of it. So the last administration, you saw political appointees abusing their authority at the CFPB, at the SEC, at the DOJ, and we need to learn from the past, and we need to make the Stable Act more protected and insulated from political whims. So to that end, and I had an amendment that I was working on, but I am not going to submit it. We've agreed to a colloquy, and this is something that we're going to work on long-term, but I believe that the Treasury Secretary, if he deems a foreign regulator out of compliance, that there needs to be a notice requirement where that foreign government receives a written notice of deficiency of what is wrong with their system, and then have an opportunity to cure that deficiency with also having a national security exemption for exigent and extraordinary circumstances. I think that that additional check and balance will further allow the Stable Act to thrive and allow digital assets to thrive in the global economy while making sure that the U.S. is still the best place to start and to build a business. And I appreciate Chairman Hill and Chairman Stiles' willingness to work with me on this, and I look forward to making sure this issue is addressed in the bill that the President's going to sign shortly.
Would the gentleman yield?
Yes.
I thank you for raising this issue. I think it's very important that we get the Treasury Secretary's role correct here, and I'll say in conjunction with all the regulatory agencies, because it's in consultation with the stablecoin regulators collectively that make a determination if a nation is comparable to the requirements under the Act. That's the standard. And this is the same kind of standard we use in other cross-border financial regulatory situations, so that we can count on the enforcement and the regulatory standards in the foreign country. And so I think it's important that analysis and that there be an appropriate balance there. So I thank the gentleman from South Carolina for his work on this, and I yield back to him.
Thank you, Mr. Chairman. I yield back.
Gentleman yields back. Who seeks recognition? I'll recognize myself for 5 minutes. I want to thank Mr. Lynch for his, I'm sorry, Mr. Sherman, did you want to speak on this amendment? No, well, we're not ready for that yet. Just un momento. I want to thank Mr. Lynch for his thoughtful amendment. I think he raises an important point. I think it's shared with both sides of the aisle that we want America to be the name and rule of law as it relates to issuing payment stable coins, and that people want access to the American market. They need to come in and be incorporated here and be subject to American regulation and supervision. And I respect his views on that. I think this certification process that we have of foreign jurisdictions, because I've seen it work in banking and securities, can be made to work in a successful manner. I urge my friend from Massachusetts to engage in thinking about that. The other thing that I note in his amendment, I just would call to his attention, Chairman Stile referenced it early in his initial response, is unlawful for any person. So when we talk about it in an institutional context, in an issuer or a regulated entity under the Act, so an exchange or someone engaged in the business. But as Mr. Stile noted, people can incidentally not be in the business but would fall afoul of your wording. They could come back, or they could have a business in Argentina. They could be using a non-U.S. stable coin in that business efforts outside the United States, have it in their wallet and seek to convert that back into dollars, for example, in the United States, and they might run afoul of the way your amendment is precisely worded, because they're not holding themselves out doing business, they're just doing it incidentally, which is why we phrased it the way we did in Section 3 of the draft bill. I'd urge my colleagues to work with Chairman Stile if they have suggestions on Section 3. I think it's adequate to enforce the laws, and it does not permit a non-compliant stablecoin issuer to come in to the U.S. and issue or offer stablecoins without being in a jurisdiction that's fully vetted and recognized by the United States. And I'd also just say for our discussion, I don't know of a stablecoin issuer in the state of New York or internationally that's active that would meet the standards under the Stable Act, meaning I think they all have a lot of work to do to meet the full requirements that are contemplated by the Stable Act in order to be fully in compliance. But again, I thank my friend. He and I have worked on illicit finance issues for years together. He raises an important point, and I yield back the balance of my time. But I do urge my my colleagues to reject his amendment, and let's work together on section 3. If there's no further debate, the question now occurs on the amendment from the gentleman from Massachusetts. All those in favor, please say aye.
Aye.
All those opposed, please say nay. Nay. In opinion of the chair, the nays have it. The nays have it. The amendment is not adopted. Roll call votes have been requested. All those in favor of recorded vote, raise your hands. Sufficient number having raised their hand, recorded vote is so ordered pursuant to subsection C5 of Rule 3. The committee rules. Further proceedings on the amendment are postponed. Is there an additional amendment? Mr. Lynch.
Thank you, Mr. Chairman. This amendment would, excuse me, I have an amendment at the desk.
Pause for it to be distributed.
Mr. Chairman. Mr. Chairman, request a point of order.
The gentleman from Kentucky is recognized for a point of order. Oh, you're reserving a point of order. I'm sorry, I thought you had a question. Beg your pardon. Gentleman's reserved a point of order. Clerk will report the amendment. Yep, sorry. Stand by. We have the wrong Sherman amendment. Stand by.
Whatever is easiest. I'm happy to do whatever you guys want. I'm going to cooperate.
Yeah, Mr. Chairman, I have an amendment at the desk, which I believe is the one they may have been handing out.
The clerk is distributing the amendment.
Yes. Okay.
Okay, so I'm going to go. It's okay, they're going this one, I guess.
Sherman?
Okay, here we go. Shiver.
He's got two back-to-back.
Doing my two back-to-back, good.
Money laundering.
Nope.
It's this one. It's this one.
Okay,
There are 4 more minutes before you.
Okay. I'm good. That's okay, that's okay. I'm surprised it's gone as smoothly as it has. I'm surprised it's gone as smoothly as it has.
They're not going to vote for it whether they read it or not.
Mr. Sherman, you got it's AML, and then after that is
Mixers.
mixers.
Right,
Yep.
that's
so
it.
you're back to it.
Good.
They're giving the right one. Yes.
The Sherman amendment has now been distributed. A point of order on the Sherman amendment has been held by the gentleman from Kentucky, and the clerk will please report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Sherman of California, designated as
Without objection, the
28.
amendment is considered as read. The gentleman from California is recognized for 5 minutes on his amendment.
The crypto universe can thrive only if it is both above and below the water. You see, if it's just a method that's subject all entirely to know your customer and anti-money laundering, it has no particular advantage over the US dollar and a lot of disadvantages, including the price changes every few minutes. So it has to be above the water. A portion of it has to be subject to the know your customer. And then it also has to function below the water without know your customer so that it becomes a payment system that has a substantial value to some people. Others may use it just because it's there, but it has to have a substantial advantage to the majority of users. That advantage is that the underwater portion will be excluded from the anti-money laundering provisions. Now, this amendment would apply anti-money laundering and know your customer requirements to all persons that transfer payment stablecoins between wallets, including unhosted wallets. So the crypto world isn't going to like this because it deals with the unhosted wallets. And an unhosted wallet, I think as we all know, is a situation where you're sending the money to a number, but you have no idea who that person is, and there's no way for law enforcement to find out even if they had a warrant. So I can't say that I'm going to get a whole lot of support on the Republican side for this amendment, but this amendment would apply the anti-money laundering provisions to both the hosted and the unhosted wallet. Both the account at Coinbase, where a court order could reveal the information, and the numbered account where nobody knows who it is. So if you have an unhosted wallet and you're unwilling to reveal who you are, then you can't play with the stablecoin, nor can the portion of the stablecoin ecosphere that is above the water do business with you. I think it's a simple amendment, and I'm looking to see if anybody wants me to yield time, and seeing none, yield back to the chair.
Gentleman yields back. The gentleman from Ohio, Mr. Davidson, is recognized to strike the last word.
I thank the chairman. Look, the gentleman's amendment sounds like it protects people, but the reality is the underlying bill already offers the exact same protections. The know your customer obligations are very explicit on stablecoin issuers and frankly the banks that customers would use to move money with their cash to acquire stablecoins. So the know your customer provisions are already there. There are on-ramps and off-ramps. That's where the surveillance is. Individuals aren't complying with the Bank Secrecy Act today. It would require rulemaking for people that aren't even covered directly by it. The Bank Secrecy Act applies to people that operate banks and money service businesses, and the underlying Stable Act requires compliance with those laws. So the protections are in fact already there.
Will the
I
gentleman
urge
yield?
opposition to the bill, and I yield to the chairman.
Will the gentleman yield?
I yield to Chairman Style.
Okay.
The gentleman is yield back. Does any other member seek recognition?
Can you give me a minute?
Mr. Foster is recognized for 5 minutes.
I'll yield to
strike the last
Mr.
word.
Chairman.
Yeah. If the gentleman's right and the amendment is harmless, I would hope that the Republican majority would accept it. If the amendment has teeth and will prevent the use of unhosted wallets to evade the anti-money laundering provision, then I'm sure that all those who support every part of the program of the crypto community will oppose the amendment. So if the strongest argument against this amendment is that it's harmless, I think it would be accepted.
Would
And
the
I'll
gentleman
back to
yield?
the gentleman from Illinois.
I yield back.
The gentleman yields back. Does any other member seek recognition? Seeing none, I recognize myself for 5 minutes on the bill. Requiring FinCEN and KYC of every single self-hosted wallet, not only not really appropriate in this particular legislative vehicle, but it would also really apply bank-like standards to individual Americans making transfers for their own personal and family purposes. It'd be like KYCing every physical wallet with cash in it. It'd be a dramatic invasion of personal liberty. So the good news is with blockchain technology, there's transparency. So law enforcement can leverage the transparency of the blockchain to follow the money between bad actors. But individual Americans should not be treated the same as financial institutions. And so I will be opposing this amendment and happy to yield to my colleague from Ohio if he wishes.
I think the chairman made the point exactly. It wouldn't be a harmless amendment. It would actually create a rulemaking burden on Treasury to somehow find a way to start regulating individuals as if they were banks. And so it's a very bad idea, and I yield to the chairman.
The gentleman yields back. Is there any further debate on the amendment? If there's no further debate, the question now occurs in the amendment offered by Mr. Sherman from California. All those in favor signify by saying aye.
Aye.
Those opposed, nay. The opinion of the chair is the nays have it. The nays have it, and the amendment is not adopted.
On that, I request a recorded vote.
A recorded vote is requested. All those in favor of recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, further proceedings on the amendments are postponed. Is there an
Who has one?
additional amendment?
Yes, I have an amendment at the desk.
Mr. Sherman has another amendment at the desk.
This is the one that deals with mixers.
We'll pause while the clerk distributes the amendment.
Mr. Chairman, reserve a point of order.
The gentleman from Kentucky reserves a point of order. The clerk will please report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392.
Without objection, the amendment is considered read. The gentleman from California, Mr. Sherman, is recognized for 5 minutes on his amendment.
I think I can get a round of applause in the room by indicating this is my last amendment to this particular bill.
True.
This amendment is quite simple. It prohibits the use of mixers for any of these stable coins, and by the nature of, and of course, being added to the bill, it's authorizing and directing the Secretary of the Treasury to issue the appropriate regulations. What is a mixer? A mixer is there to help make sure that even with a court order, the information is not available to law enforcement. A mixer is there to mix up law enforcement. Who wants to mix up law enforcement? People who are doing illegal things. So if we want these stable coins to play a good role in our society, we would not want them to be subject to use to a mixing device, which is there to confuse law enforcement. I'll point out that just last month, the Trump administration removed sanctions against Tornado Cash, which is a crypto mixer, which was responsible for getting U.S. dollars to terrorist organizations. I hope that we would, there is no legitimate purpose of a mixer unless you think it's legitimate to hide transactions from the court system, including family law, where spouses are fighting about money, or you think it's legitimate to evade law enforcement, including the IRS when they have a warrant. And if this is a chance for people to show whether they're on the side of law enforcement or on the side of those who can make money by designing a tool which is usable in a mixer system, the sole purpose of which is to evade U.S. law and to promote and facilitate criminality. With that, I'll look around. I see nobody asking me to yield time, and I yield back to the chair.
The gentleman yields back to the gentleman from Kentucky insists on his point of order. The gentleman withdraws his point of order. The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes to strike the last word.
I thank the chairman. mixers sound okay until, when you listen to Mr. Sherman, but the reality is there is a legitimate use case. When you have a checking account, and in the old school days, you would write longhand the checking account, it had your routing number and checking account number. That was a security risk, so people have diminished checks, but it didn't reveal how much money you have in your bank account. The reality is, because a public blockchain is there, it's knowable how much is in the wallet that the money was transferred from. So you wouldn't want to necessarily reveal how much money you have. So what the gentleman refers to as mixing is simply sometimes taking a wallet that has a significant amount of money in it and mixing it so that you move it into a smaller wallet, so you're only paying the $200 for the service and not revealing that you might have, $10,000 in the wallet that it was moved from. So it is a useful purpose for legitimate uses by law-abiding citizens, and it shouldn't be undermined by the gentleman's amendment. And I yield to the chairman.
The gentleman yields back. Does any other member seek recognition? The incorrectly nameplate labeled Mr. Caston from Illinois is recognized.
Mr. Caston, Ms. Waters, whatever you'd like to refer to me as. Thank you, Mr. Chairman. I support Representative Sherman's amendment, and I wish we could have a conversation about this issue that doesn't so quickly get into intellectual dishonesty. We hear on the one hand that we don't need all this enforcement, we don't need all this tracking because the blockchain lets us know all the history of transactions. On the other hand, it's really important for us to have anonymity because there's all sorts of reasons why we have to have mixers. Those two things are not intellectually consistent. And we need Representative Sherman's amendment to do something really important, to say that entities who are deemed payment stablecoin issuers under this bill would have to prevent their tokens from being laundered through mixers because that's what they do. We know that mixers, which obfuscate the source, destination, or amount involved in their transactions, play a serious role in financial crime, including money laundering. Treasury's Financial Crime Enforcement Network, working with law enforcement and other national security agencies, issued a determination in 2023 that convertible virtual currency mixers were, quote, a primary money laundering concern. This rare designation from FinCEN was issued because, as FinCEN said at the time, quote, mixing transactions are frequently used by criminals and state actors to facilitate a range of illicit activity, including but not limited to money laundering, sanctions evasion, and WMD, weapons of mass destruction, proliferation by North Korea, Russian-associated ransomware attacks, and illicit darknet markets. Further, a recent assessment by FinCEN determined that the percentage of transactions processed by mixers that originated from likely illicit sources is increasing, end quote. To say that payment stablecoin issuers would have to build protections into their technology to block mixer addresses on their blockchains is to say that these US dollar-backed stablecoin issuers will take action to make it harder for ransomware perpetrators, cyber thieves, and fraudsters to launder the proceeds of their crime. That seems important. It's one that I would think everybody here should support, especially if we're all concerned, as I think we are, with fentanyl trafficking, Iran, North Korea's nuclear ambitions. The idea that this is just some noble person who wants to hide their bank account violates all the fact that we know how people are using this. They're using it to do bad things and to hide their trails. I can't imagine under what circumstance it is in the United States' interest to make it easier for people to traffic drugs, to facilitate weapons of mass destruction, to fund the North Korean nuclear program. I don't think that is the purpose of US fiscal policy. We need Mr. Sherman's amendment, not just vote for it, we need it if we're going to say we believe what we say we believe. Urge my colleagues to support the amendment and yield back.
Gentleman yields back. Does any other member seek recognition on the amendment? Seeing none, I recognize myself for 5 minutes to strike the last word. I think this broader conversation as it relates to sanctions is a pretty worthy conversation of the committee. The bill is really just not the appropriate vehicle for this type of restriction that would fall on entities other than payment stablecoin issuers because it falls on other market participants. So in addition, this amendment I think is also a little overly broad and under-specified. It risks sweeping into a prohibition that providers of software services that can be used by the general public, including for lawful purposes. And so the gentleman is only interested in prohibiting mixers being used to evade other sanctions, and that is a different amendment with a narrower scope than the one he's proposed, something that's probably worthy of a conversation in a dialogue as we look to move forward in the broader digital asset space. So I appreciate maybe the intent of the underlying amendment, but I don't think that it's specific. I think it's outside the context of the underlying bill, and so I'd encourage my colleagues to vote no on the bill. Is there further debate on the amendment? Seeing none, if there's no further debate, the question now occurs on the amendment offered by the gentleman from California, Mr. Sherman. All those in favor signify by saying aye.
Aye.
All those opposed, no. No. In the opinion of the chair, the noes have it. The noes have it, and the amendment is not adopted.
I ask for a recorded vote.
Recorded vote is requested. All those in favor of recorded vote, raise your hand. A sufficient number having raised their hand, recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Is there an additional amendment? Mr. Foster is recognized.
What? So, or my amendment, yeah, okay. Yeah, I have an amendment at the desk.
It is Foster. Mr. Foster has an amendment at the desk. Does the gentleman from Kentucky request a point of order?
Reserves a point of order.
The gentleman reserves a point of order. The clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to
Without objection, the
HR
amendment is considered
2392.
read. The gentleman from Illinois is recognized for 5 minutes on his amendment.
Thank you, Mr. Chair. My amendment simply inserts the language from the Senate bill that will require stable coins issued under this bill to build the capability to freeze, seize, and burn the tokens themselves when they are identified to have been used for illicit purposes, such as drug trafficking, terrorism finance, you name it. And these provisions just allow stablecoin issuers in coordination with law enforcement officials to freeze, confiscate, or destroy these stablecoins. Nearly all of the major stablecoin issuers operating in the United States today have this capability already built into their stablecoins. And this amendment would simply make clear that this should be the standard for all stablecoins issued here in the United States. In our March 11th full committee hearing, one of the Republican witnesses enthusiastically pointed out that they had been very successful at blocking some major illicit activities using these capabilities. In fact, just this last month, stablecoin issuers have reportedly used this capability to freeze nearly $30 million in stablecoins associated with suspicious activity or sanctions. Digital assets without this capability have almost no mechanism to limit their movement around the world, allowing them to be stolen by bad actors, sent overseas, run through a mixer, and deposited into the pockets of scammers, criminals, and our adversaries. It's not perfect, but it allows you, among other things, you can't always detect which wallets have been used for bad purposes. But when you do detect that, it provides a mechanism to be able to freeze and reverse mistaken or fraudulent transactions. So although this language won't entirely halt the use of stablecoins in illicit finance, it allows the assets to be made useless or inaccessible to criminals once they've been identified. So I appreciate why the Senate included this language, and that's why I'm offering this amendment. That's it. Yield back.
The gentleman yields back. Does any member seek recognition? Does any member seek recognition? Does the gentleman from Kentucky insist on his point of order? The gentleman withdraws his point of order. Mr. Caston from Illinois, now properly labeled, is recognized to strike the last word.
Thank you, Mr. Chair. I want to support Mr. Foster's amendment. This amendment would add important national security capabilities to this bill. It would ensure that regulators require payment stablecoin issuers to build into their technology the capacity to freeze on chain. So that means that payment stablecoin issuers who are created by this bill would have the tools to restrict access to funds held in those stablecoins in the event that they need to do so to comply with regulations to prevent illicit activities. Let's just imagine a scenario. The FBI comes to a payment stablecoin issuer, proof, court order, says that U.S. registered corporate entity to which it sold its stablecoins is actually owned by Iran's Islamic Revolutionary Council Guard or the Sinaloa cartel or some other bad actor. The issuer would then have the tool to freeze the addresses, blacklist, and even confiscate those tokens. That would ensure that bad actors would not be able to access or transfer those tokens to continue with their fraud, money laundering, or sanctions evasion violations. Many of the prominent existing stablecoin issuers, such as Paxos, Tether, and Circle, already have this capability, and many new companies that arise should be compelled to do the same. I would add that similar language is already in the Senate's Genius Act, so we should have the same protections in the House stablecoin bill. Urge members to support the amendment, and I yield back.
The gentleman yields back. Is there further debate on the amendment? Seeing none, I'll recognize myself for 5 minutes. I'm going to strike the last word. Statutorily requiring all payment stablecoin issuers under the Bank Secrecy Act to block, freeze, or reject transactions would raise legal, technical, and policy problems. We want to be careful not to push innovation into closed systems and risk driving development offshore, undermining the open, interoperable financial ecosystem that stablecoins help enable. The Stable Act already requires issuers to engage in robust BSA compliance, including via AML programs, monitoring suspicious activity, which can include appropriate distributed ledger analytics, as well as compliance with sanctions. Because of that, I urge my colleagues to reject this amendment, and I yield back. Is there further debate? If there's no further debate, the question now occurs on the amendment offered by the gentleman from Illinois, Mr. Foster. All those in favor signify by saying aye.
Aye.
All those opposed, no. No. In the opinion of the chairs, the noes have it, and the amendment is not adopted.
Recorded vote.
The gentleman requests a recorded vote. All those in favor of recorded vote, please raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Is there an additional amendment? Who would like first?
Whatever you want to go first.
Mr. Caston of Illinois has an amendment at the desk.
I'd like to reserve a point of order.
The gentleman from Kentucky reserves the point of order. The clerk will please report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392.
Without objection, the amendment is considered read. The gentleman from Illinois is recognized for 5 minutes on the amendment.
Thank you, Mr. Chairman. I want to just comment, there's a consistent theme here that when the Democrats are introducing legislation to prevent criminal activity, the response is this would constrain innovation. I would note that if we were to pass a bill that said Walter White cannot excavate a cavern underneath a dry cleaner, that would also constrain Walter White's ability to innovate. Not all innovation is good, my friends. There are a lot of smart criminals in the world who do a lot of innovation. It ain't always good, even though I'm told that meth that Mr. White made was really exceptional. What this amendment would do is to build on Mr. Foster's amendment by directing the Treasury Department in consultation with the Department of Justice to propose a rule that outlines under what scenarios a stablecoin issuer must act to block illicit stablecoin transactions without explicit authorization. The amendment would also apply to foreign issuers like Tether. Similar to traditional banks, stablecoins can play an important role in restricting access to assets limited to criminal activity. Financial institutions today have systems in place to block, freeze, reject transactions, report suspicious transactions to FinCEN, file currency transaction reports with OFAC, SARS, what have you. Similarly, stablecoins are generally centrally controlled, allowing issuers to freeze and even burn tokens associated with illicit activity. We've heard people in this committee who've been prior hearings have made that point. Stablecoin issuers work with law enforcement agencies and blockchain analytics firms to monitor transactions in real time. That happens already. When suspicious wallets are identified, stablecoin issuers can blacklist addresses, preventing criminals from using the frozen funds and assisting authorities in recovering those funds. Stablecoin issuers generally only act to freeze stablecoin transactions if they receive a court order or a directive from a federal law enforcement agency, although I would note that there have been instances where stablecoin issuers have acted without explicit authorization to blacklist wallets linked to North Korean state-sponsored hackers. However, there has been some criticism of at least one stablecoin issuer, I believe this was Circle, for taking 4 months to cut off North Korea's funding streams. We got to understand 4 months, and this goes back to the comment I made before about Axel Foley and Beverly Hills Cop. It is one thing to say these things are illegal. It is something else to say, do our enforcement authorities have the ability to move quickly enough? It took them 4 months to shut off North Korea's funding returns. Well, let's review the bidding. Last month, it took just 2 minutes for North Korean hackers to steal $1.5 billion from Bybit, one of the largest cryptocurrency exchanges, and start moving those funds. The hackers were able to launder 300 million of that, or 20% of that total, of those stolen funds almost instantaneously because of the nature of digital money. According to the blockchain analytics firm Elliptic, those funds have, quote, gone dark and will likely never be recovered. In that context, if you're going to take 4 months to shut it down, you might as well take never because the money's gone. Since 2017, North Korea has stolen more than $5 billion worth of cryptocurrency, including this latest exploit. Experts say that the North Korean hackers are working nearly 24 hours a day and potentially funneling the money into the regime's military development, including their nuclear weapons program. In fact, national security officials estimate that half of North Korea's nuclear program is funded by cryptocurrency theft and cyber attacks. So if this committee is serious about addressing those national security risks, lawmakers, regulators, and industry have to remain vigilant about it and consider tactics to respond to activities like North Korea's use of cryptocurrency to develop nuclear weapons. I think this amendment strikes the right balance between providing adequate tools to detect and prevent illicit activity while also safeguarding against unreasonable searches and seizures and protecting privacy. I urge my colleagues to support this amendment, and I yield back.
Does any other member seek recognition? Mr. Foster of Illinois.
I just want to say that there are examples you can think of pretty simple rules that all of us would agree should trigger action. You know, for example, if it's found that this wallet is under the control of a sanctioned entity, you know, there should be a default understanding that everyone involved should immediately freeze that. And so, you know, there are simple rules. There are times when you have to go to a court. If the situation's complicated, go to a court, have it discussed, you know, get a warrant and have an action taken that way. But there's a real merit to having rules for the simple cases, and that's why I support this amendment.
The gentleman yields back. Gentleman yields back. Mr. Lynch, Massachusetts, recognized for 5 minutes.
Thank you. I certainly support Mr. Caston's amendment. Given the nature of stable coins themselves, but also recognizing that since February 10th, President Trump has suspended the Foreign Corrupt Practices Act, and so we have very little operationally to thwart the type of activity, illicit and illegal activity, criminal activity, that Mr. Caston is trying to get at in his amendment. So with that, I'll yield back.
Gentleman yields back. Does any other member seek recognition? Seeing none, I'll recognize myself for 5 minutes for the purpose of striking the last word. I rise to oppose Mr. Caston's amendment. I think it's really important to note that under current law, OFAC already requires all U.S. persons, including entities in the U.S. and incorporated in the U.S., to block transactions involving sanctioned persons. So in other words, blocking is already part of OFAC regulations, and so therefore the amendment is unnecessary. There's also a litany of other tools that digital asset firms and stablecoin users use to prevent these kinds of transactions before they happen in the first place. So with that said, I urge my colleagues to oppose the amendment, and I yield back. Is there further debate on the amendment? If there's no further debate, the question now occurs on the amendment. If the gentleman from Kentucky withdraws his point of order, so the question now occurs on the amendment offered by Mr. Caston of Illinois, properly labeled. I should be able to get this. All those in favor of the amendment shall signify by saying aye. All those opposed, no. In the opinion of the chair, the noes have it. The amendment is not adopted. A recorded vote is requested. All those in favor of a recorded vote signify by raising your hand. A sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, further proceedings on the amendment are postponed. Is there an additional amendment? Mr. Lynch of Massachusetts is recognized.
Thank you, Mr. Chairman. Mr. Chairman, I believe I have an amendment at the desk.
Mr. Lynch has an amendment at the desk. The clerk will distribute the amendment. The clerk will please report the amendment.
Thank you, sir.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Lynch
Without
of
objection, the amendment is considered as read. The gentleman from Massachusetts, the gentleman from Montana is requesting a point of order.
Mr. Chairman, I'd like to reserve a point of order.
Point of order has been reserved by the gentleman of Montana. Without objection is considered as read. The gentleman from Massachusetts is recognized for 5 minutes on his amendment.
Thank you, Mr. Chairman. Mr. Chairman, this amendment would prohibit stable coins from being issued if they are pegged to the national currency of a hostile foreign power. This committee should not allow stable coins to be redeemable in money issued by China, Iran, Russia, North Korea, and other nations that are hostile to U.S. interests. Additionally, stable coins should not be redeemable in money issued by the China-sponsored Asian Infrastructure Bank, the China-sponsored New Development Bank, and the Russian-sponsored Eurasian Development Bank. As reported by the President's Working Group on Digital Assets, stablecoins and other digital assets can be readily exploited by terrorist financiers and money launderers, and governments proliferating weapons of mass destruction to perpetrate illicit activities and evade U.S. and international sanction regimes. In particular, foreign stablecoins, CBDCs, and other digital assets could be developed to operate outside an integrated international financial system, thus making it easier for rogue actors or countries that are subject to sanctions to avoid those U.S. sanctions. Given the national security concerns and the lack of robust financial regulatory regimes and the President's February 10th suspension of the Foreign Corrupt Practices Act, stable coins issued in the U.S. should be limited to the money issued by the Fed or G7 nations. With that, Mr. Chairman, I yield back.
Gentleman yields back. Who seeks recognition? The gentleman from Wisconsin. I'm sorry, I beg your pardon. Mr. Downing from Montana is recognized to strike the last word.
Yes, I'd like to withdraw my point of order.
Withdraw your, sorry, thank you. And he withdraws his point of order. Mr. Stile, you're recognized to strike the last word.
Thank you very much, Mr. Chairman. First, I think it's worth noting the Stable Act does not permit foreign government-issued obligations to act as reserves. So this amendment is really a solution in search of a problem. Second, the amendment specifies foreign governments that are subject to sanctions, but by definition, it'd be illegal to transact with such a government as all property and interests in property of the government would be blocked. So in other words, even if the bill allowed foreign government-issued reserves, which, again, it doesn't, it would still be illegal to purchase securities of sanctioned foreign governments. So the amendment is actually two solutions in search of one problem, two problems, three problems that don't exist. So I urge my colleagues to reject the amendment. And Mr. Chairman, I yield back.
Gentleman yields back. Who seeks recognition? Mr. Caston is recognized to strike the last word.
Thank you, Mr. Chair. I want to commend Mr. Lynch for offering this amendment to ensure that the payment stablecoins discussed in this bill cannot be backed by currencies of nations that present a national security threat to the United States. Representative Lynch's amendment prohibits government-backed obligations of nations like Iran, Russia, Burma, Belarus, and North Korea from being included in a payment stablecoin's reserves. Importantly, it also means that the currencies and central banks of those nations will not have the benefit of being commingled in the same basket with stable, reliable, credible, and real currencies like the US dollar, euro, British pound, what have you. We've targeted with sanctions the governments, government-backed enterprises, and officials of those nations for good reason, and we have designated certain nations as state sponsors of terrorism for very good reasons. Representative Lynch's amendment will make it clear that those who want their stablecoins to be used by U.S. individuals and entities cannot provide economic benefits to those bad actors as well. I urge my colleagues to support this common sense amendment and yield the balance of my time to Mr. Lynch.
Thank you very much. I thank the gentleman for yielding. I would like to remind my colleagues that earlier the majority rejected an effort to prohibit foreign-issued stablecoins from being sold in this country. So there's nothing to stop foreign stablecoins from being backed by those foreign assets at all. There's no prohibition on that at all. And my amendment would have been to authorize the government to reject those applications.
Will the gentleman yield?
I would.
I think it's worth noting, maybe there's a point of clarification that would be helpful here in the structure of the bill. A foreign-issued stablecoin would still be subject to the rules and regulations of the bill. It would be a foreign-issued stablecoin from a substantially similar regime is authorized by the Secretary of the Treasury, and so therefore the functions of the bill would apply to that stablecoin.
If you're allowing them to operate either directly or indirectly without authorization by the United States, how would you know? How would you know? And on a permissionless public blockchain, how would you know? Okay.
Gentleman yield?
I yield.
I'm happy to yield to a colloquy. I think it's my time, but I'll yield to the chair.
Oh, okay.
good. Sorry.
Thank you. Sorry, forgot about that.
No, I'm happy to yield.
Well, let me just respond briefly on that, just to reiterate that a foreign issuer, somebody that is a foreign stablecoin issuer outside the United States, may not issue that in the United States, in the secondary market, or issue directly without being in a regime, the United Kingdom, Switzerland, you name the location, that has been certified by the Secretary of the Treasury and the federal payment stablecoin regulators that it is substantially similar both on the reserves, the audit standards, the enforcement standards, et cetera. So I'm going to yield back to the gentleman. That's my only point there.
Well, this would just solidify that investing or having assets backed by any of these hostile powers would not be substantially similar to or under that regime, under that protocol.
Well, gentlemen, I know we're still
I yield.
your time. Gentlemen, yield. Was the gentleman from Illinois, let me answer that question.
I'll yield to the gentleman who I yield to the gentleman from.
So I hear what you're saying, but of course, we already, in a hostile regime, that wouldn't be a certified entity because under all the other laws, the Secretary of Treasury wouldn't do that, and the bank regulators wouldn't do it, and they wouldn't qualify.
Okay, reclaiming my time.
Okay, yield back.
So it seems like we are bending over backwards in this bill to refrain from taking any action against anybody who's operating, even hostile powers. Those, that's a bridge too far. We cannot protect the consumers. We cannot protect them from bankruptcy. We cannot protect them from bailouts because, dear Lord, that might inhibit the operation of these stable coins. We can cut 80,000 people from the VA. We can lay off, 20,000 researchers at HHS, but we can't find a way to protect the American people in this bill. So I'll yield back. I yield back to the gentleman from Illinois.
I yield.
Mr. Caston yields back. Who seeks recognition? Is there any further debate on the amendment? If there's no further debate, the question now occurs on the amendment offered by the gentleman from Massachusetts, Mr. Lynch. All those in favor, please say aye. Aye. All those opposed, say no. No. The noes have it, and the amendment is not agreed to. The gentleman requests a recorded vote. With those wanting a recorded vote, raise your hands. A sufficient number having raised a recorded vote is agreed to. Pursuant to C5 of Rule 3, the committee further proceedings on the amendment are postponed. Is there additional amendment to the style A&S? Mr. Foster.
We have an amendment at the desk.
Stand by. Let us have it distributed. Gentleman from Montana.
Mr. Chairman, I'd like to reserve a point of order.
Gentleman reserves a point of order. Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Foster of Illinois, designated as 19.
The amendment will be considered as read, and I yield to the gentleman from Illinois, Dr. Foster, for 5 minutes to explain his amendment.
Thank you, Mr. Chair. This bill authorizes every stablecoin issuer to create a potentially vast payment highway with unlimited numbers of anonymous, unlicensed vehicles and with anonymous, unlicensed drivers on it, with everything dangerous that can happen on such a roadway. I believe that there is a marketplace, will be a market demand for a similar type of payment mechanism where the participants are actually licensed in some way, specifically KYC'd or something similar to that, so that you have an assurance. For example, if you go on a social media account and there's a blue check mark, that this is a person who is a real person who, if they do harm, is legally traceable. You don't have to know who they are, but you have to have some assurance that if they do you harm, if your screen locks up with ransomware, demanding a payment in this coin, that you can actually go to the legal system, figure out who they are, and haul them into court if they've done something illegal. Without that assurance, everyone operating on the payment rails that are proposed by this bill, must understand that they may be aiding and abetting criminal activities simply by using these, and not many people want to do that. And so there are multiple ways that this can happen. It was pointed out earlier in the debate that you could have a permission blockchain where simply the permission was getting KYC'd. And I think that would be a very simple, certainly technically feasible mechanism. And then operating with that coin, you'd know that everyone was KYC'd. I want to emphasize this was an optional thing. This is something that should be allowed and recognized by this legislation, that some people may want to have coins where all of the participants in that coin are simply legally traceable people, with all the anonymity that normal banks and more would allow. This would also be very useful for self-hosted wallets, which is not immediately obvious. The mechanism proposed here would allow you, if you spin up a self-hosted wallet and you say, okay, this is, I have my little piece of hardware with a self-hosted wallet on it, but I want to participate in a coin where all of the players are legitimate and traceable. Still, they can be anonymous until a criminal activity has been detected. But you can then register that self-hosted wallet with an entity, get yourself KYC'd, and then anyone looking at a transaction to your self-hosted wallet would be able to tell that, okay, you are a legally traceable person, you are not a crook. Because the vast majority of people using stable coins are not crooks. They're operating off exchanges. They've already been KYC'd, in fact, in all probability. But there is an edge case of the people that are not, and we do not, I believe, want to construct an on-ramp for converting dirty money back into clean money. And this would allow you, back to the self-hosted wallets, actually there's some benefits in self-hosted wallets. If you're worried that the exchange you're operating on will go bankrupt and all of your coin will be tied up in bankruptcies, you feel more secure with a self-hosted wallet, that's fine. But at the same time, with the mechanism proposed by this amendment, or similar ones, you can actually participate and have the benefits of self-hosting and the benefits of everyone involved in that coin know that you are not a crook. And I think that's the benefits of that sort of mechanism are going to be much wider than simply coins, stable coins rather. For example, NFTs, the market's basically shut down because of the amount of fraud on it. If all of the participants there had the ability to identify themselves in a legally traceable but anonymous way, I think there might be a hope of actually rescuing the NFT market and making it into something more successful than it currently is. Anyway, that's the mechanism that this is about, and there are multiple ways of accomplishing that, but I think it'd be very valuable if this legislation recognized that there was a role for coins where the players in that coin are basically KYC'd. And that's the purpose of the amendment, and happy to work with anyone who'd like to perfect this. But I think it's a very valuable thing and that we should be pursuing. Would be very important in getting my support for the underlying bill. Thank you. I yield back.
Gentleman yields back. Who seeks recognition? Mr. Stahl, you're recognized to strike the last word.
Thank you very much, Mr. Chairman. I rise in opposition to Mr. Foster's amendment. I think it's important to note the Stable Act already treats stablecoin issuers as financial institutions under the Bank Secrecy Act and even delineates with strict requirements issuers that issuers must comply with. The treatment already encompasses appropriate know your customer procedures. So this is another amendment that restates current law, and for that reason I view it as unnecessary and urge my colleagues to oppose the gentleman's amendment. I'd also note my colleague's amendment is really outside the scope of the bill, and private sector entities are already working to provide options that my colleague is concerned about by providing wallet verification and broader analytic services. Optional wallet verification by the government's not appropriate for a discrete payment stablecoin bill designed to ensure the soundness of stablecoins. And so with that, I would urge my colleagues to oppose the amendment, and I'll yield back to the chair.
Gentleman yields back. Is there further debate? Mr. Downing, do you continue to ask for your point of order?
Mr. Chair, I withdraw my point of order.
Who seeks recognition? Ranking member is recognized to strike the last word.
I move to strike the last word.
You're recognized.
This amendment would seek to develop a path by which an individual wallet holder could choose to have their personal wallet verified as compliant with the Bank Secrecy Act. In asking the Financial Crimes Enforcement Network, that is FinCEN, to establish standards, centralized exchanges, payment stablecoin issuers, and other financial institutions that have customer identification programs and which do customers' due diligence could add essentially a seal of approval to a willing customer's wallet. Such a seal could travel with the customer through their transactions, facilitating their safe, secure onboarding into the financial system. The concept is an interesting one that seeks to create a voluntary option for those who wish to choose accessible, secure identity over the anonymous and dark corners of the crypto ecosystem. So I support the idea and support Mr. Foster's amendment. I yield back.
Gentlewoman yields back.
So what?
Anyone seek recognition to talk on Dr. Foster's amendment?
Mr. Chairman,
Gentlelady.
I would yield to Mr. Foster.
I just want to emphasize the voluntary nature of this, that I think it will be very useful if there's someone on the other side of a crypto transaction. You don't have to know who they are, but it would be very valuable to know that if something bad happens, that you actually, you have some assurance that you'll be able to figure out who they are under some appropriate legal pattern. I think there would be a real appetite for that. It could be very lightweight. For example, you could get out your Real ID compliant digital driver's license, go hit competent federal authority and said, yep, you have just passed KYC for that purpose. So that this could be a almost instantaneous thing that would not be really very intrusive to the customer who was a good actor and simply wanted to be able to prove it and prove to the world that this wallet was a clean wallet. And so that's the purpose of the amendment. I think it would be a real boon, frankly, to the whole stablecoin ecosystem and the crypto ecosystem as a whole. Thank you. I'll yield back.
Gentlewoman, yield back. Gentlewoman yields back. Who seeks recognition? If there's no further debate, the question now occurs on the amendment offered by the gentleman from Illinois. All those in favor, please say aye.
Aye.
Those who are opposed shall signify by saying nay. Nay. Independent chair, the nays have it. The nays have it. The amendment is not adopted. Recorded vote is requested. All those in favor, recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is so ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, proceedings are postponed. It's my intention to push through and continue this markup until we've completed consideration of all the noticed legislation. So I invite members and staff to be prepared for votes late into the evening. Is there an additional amendment to Mr. Stiles' amendment in the nature of a substitute? Mr. Liccardo.
Thank you, Mr. Chair. I believe I have an amendment at the desk.
If you'd pause, we'll have it distributed.
Should be the one with the number 008. Thank you.
Mr. Chair, I move to
Downing?
reserve a point of order.
The gentleman's recognized.
Mr. Chair, I move to reserve a point of order.
A point of order is reserved by the gentleman from Montana. Clerk will report.
Amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Liccardo of California, designated as 8.
The amendment will be considered as read, and I now call on the gentleman from San Jose, California, to speak for 5 minutes in support of his amendment.
Thank you, Mr. Chair. Again, this amendment is focused on Section 3 because I think we recognize what's happening in the market with stablecoins. The largest issue, of course, is outside the country, and the extraterritorial effect of our regulation is of concern, and certainly we know that very, very limited. Reciprocity is the framework that's set out in this bill, and I understand why. I know it's a very pragmatic approach. My concern specifically is that the determination of the Secretary of Treasury about whether the regulatory regime of that foreign country is, in the terms of the bill, comparable to the requirements under this act is not guided by any specific criteria, in my view. And the word comparable, I believe, could be strengthened. What I had suggested is language very similar to what we see in the Senate version of this bill that would require the Senate to consider a number of specific elements such as the reserve requirements, supervision, sanctions, compliance standards, and other elements that we know are critical for any appropriate regulatory regime that we should have confidence and trust in. Of course, the elephant in the room is, again, Tether, which I have no reason to believe is anything other than a well-operating company. I don't pretend to know anything about Tether beyond what I read in the news, but I am concerned about conflicts of interest given the position that Commerce Secretary Lutnick held as CEO of the company that was or is still the primary custodian of Tether. I know he stepped down as CEO. His son is now the current chairman of that company. I am concerned that we have very clear, very specific guidelines for the Secretary of Treasury's determination so that we can all have confidence about reciprocity and how it will be applied. I know I've had good conversations with Mr. Stile and the chairman, and I appreciate that. And certainly I'd welcome Mr. Stiles' response if the chair would be willing to enter a colloquy.
I appreciate my colleague from California, Mr. Liccardo, and appreciate your thoughtfulness and approach to this legislation and your work to further refine the bill, and in particular, Section 3. As noted, the current draft provides the Secretary the ability to determine when foreign regimes are comparable to the requirements of the Act. And so it's my intention that comparable regimes be subject to robust standards and that the American holders of stable coins are protected. I think that we share this as a mutual goal. And so my colleagues looking for more assurances, I'm happy to work with you in further clarification of this between now and when we enter this to the floor. The same dialogue occurred earlier as it relates to the same section with Mr. Timmons and his interest as it relates to this broader process. And so with that commitment, I would request my colleague to withdraw the amendment and engage in a conversation with myself, with the chairman of the full committee, Mr. Hill, and others as we work to further refine this prior to bringing the bill to the House floor.
Thank you, Mr. Stiles. I appreciate that. And with that, Mr. Chairman, I would request unanimous consent to withdraw.
Gentleman withdraws his amendment. I appreciate his work on this. I certainly reiterate that I'll work with him and with Chairman Stile to accommodate his very specific constructive comments on how to make the B paragraph on Section 3 more robust. The gentleman withdraws his amendment.
Yes, Mr.
Is
Chairman.
is there additional amendment to Mr. Stiles' draft? Seeing no further amendments. Okay, well, I don't know how many times. I know.
There's a list, and Ms. Vasquez has 2, and then I'm after her. I'm just waiting.
Okay, well, I don't have a list. I'm not going to be testy. I'm just going to simply say I asked for amendment. No one spoke up, so.
Mr. Chairman, I have an amendment of the day.
Okay. Mr. Lynch.
Oh,
No, it's Ms. Vasquez
Okay.
first.
All right.
Ms. Velasquez.
Very good. Be delighted to hear from Ms. Velasquez.
Thank you so much.
You have an amendment at the desk?
Yes, I have an amendment.
Let's
at the
wait till
desk.
it's distributed, please.
Mr. Chair, I move to reserve a point of order.
Gentleman from Montana has reserved a point of order.
This is the one. This. We're tired, you know.
Clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Ms. Velasquez of New York, designated as 15.
The amendment will be considered as read, and I now yield to the gentlewoman from New York 5 minutes to explain her amendment.
Thank you, Mr. Chairman. My amendment is simple. It requires the Secretary of the Treasury, as Chair of the Financial Stability Oversight Council, to include in their annual report to Congress an assessment of the threat that payment stablecoins and the issuances of payment stablecoins pose to the financial stability of the United States. We established FSOC as part of the Dodd-Frank Act following the 2008 financial crisis to take a broad-based look at the financial system, look across agencies and regulators to study, investigate, and, if necessary, address potential sources of systemic risk. In my opinion, requiring the FSOC to report on a new financial innovation like payment stablecoins that have the potential to do significant damage to our financial system is exactly what we designed the FSOC to investigate and report on. As of March 5th, the market capitalization of stablecoins was approximately $230 billion. While some may argue the $230 billion market capitalization of payment stablecoin is dwarfed by the U.S. equities market by comparison, which currently has a market capitalization of more than $62 trillion, and therefore these coins pose little or not systemic risk. I would argue this market has expanded rapidly over the last several years. For example, in March 2020, the market capitalization of payment stablecoins was only $5.4 billion, and now look at it, it's at $230 billion. That is a growth rate of 46 times over just 5 years. And now we are legitimizing this industry through legislation. I expect this industry to expand even more rapidly. We have already seen in other circumstances how rapid expansion and crashes of markets have the potential to pose a significant systemic threat. Stablecoins have already depicted on numerous occasions. For example, algorithmic stablecoins were an early breed of untested stablecoins. BitUSD began trading in 2014 and collapsed just 4 years later in 2018. After only 8 years and multiple other crashes, algorithmic stablecoins have already been generally dismissed as a viable enterprise. Collateral and fiat-backed stablecoins have also failed to hold their pegs on multiple occasions. Between June 2021 and June 2023, Binance stablecoins, BUSD, depegged several times and by as much as 13 cents. The regional banking crisis in March 2023 resulted in Circle's USDC losing its peg to the dollar by as much as 13 cents. It is also important to note that Circle held $3.3 billion of USDC's reserves in uninsured accounts at Silicon Valley Bank, reserves meant to ensure that consumers could redeem USDC at its alleged price of $1. And those reserves were given special treatment and guaranteed by the banking regulators after the collapse of the Silicon Valley Bank held off a broader banking crisis. Stablecoins also have operational risk challenges that can arise from the failure of participants in the network to respond to demand for processing transactions and the lack of accountability for risk management given the decentralized environment. Stablecoins are also vulnerable to bugs and hacks. They are also an unreliable form of settlement, and users are not always able to redeem their rights in full and on demand. Should users be unable to redeem their rights in full on demand, it could certainly cause risk to the stablecoin issuer and the financial institution that store the reserve. While some may argue that the issues I'm bringing up have been accounted for or are never likely to occur, I will say that through my time on this committee, I have seen on multiple occasions events that people said could never happen. That is the exact purpose of the FSOC and the reason for my amendment here today, to guard against this risk and ensure the impossible never occurs with payment stablecoins. Thank you, Mr. Chairman, I yield back.
Gentlewoman yields back. Does the gentleman from Montana maintain his point of order?
Mr. Chair, I withdraw my point of order.
Gentleman withdraws his point of order. Who seeks recognition? Gentleman from Wisconsin, the author of the Stable Act, Mr. Stile.
Appreciate that, Mr. Chairman, and move to strike the last word. I appreciate my colleague's amendment. However, I'm urging my colleagues to vote no on the amendment. FSOC already includes information on stablecoins and digital assets in their annual financial stability report. So I'm not implying that FSOC shouldn't be able to look at stablecoin activities in any financial stability consideration they pose through a balanced activities-based approach. This amendment just puts an unnecessary spotlight on stablecoin issuers. So if we recall, even former Treasury Secretary Yellen testified before this committee that stablecoins didn't pose a systemic risk to the financial system. We should instead ensure FSOC is responsive to the real financial stability risks our nation faces instead of being distracted. And so with those comments, Mr. Chairman,
Would gentleman yield?
I yield to the chair.
Yeah, I thank the gentleman for his clarification. I think the gentlewoman from New York brings up an excellent point that's thoroughly vetted. As the chairman said, not only has the Treasury Secretary testified to this fact before the committee, but stable coins and their risk to the economy and the analysis around them was fully outlined in the 2024-2025 FSOC report, and it was a very thorough discussion. So I think this amendment's unnecessary, and I agree with Chairman Stile that people should not support it as it's already being taken care of. Who seeks recognition? The gentlewoman, ranking member of the full committee. Strike the last word.
I move to strike the last word. This amendment would require the Secretary of the Treasury to include the Financial Stability Oversight Council's annual reports to Congress, a section that discusses the status of the threat payment stablecoins pose to the financial stability of the United States. FSOC has systemic risk tools that can help prevent under-regulated stablecoins from threatening the stability of the U.S. financial system. FSOC's efforts to evaluate stablecoin risk and share that information with Congress are necessary given the broader economic risk that President Trump has recklessly adopted for the country. Since taking office, Trump's actions and policies are on track to engineer a recession and move our country into a period of higher inflation, reckless tariffs, and mass layoffs. On today's so-called Liberation Day, Trump has announced reciprocal tariffs of a minimum of 10% that runs as high as 49% that will not only hit our country's allies, but also American consumers who will have to deal with a sharp hike in prices. We've also learned from past collapses that stablecoins contain fragilities that make them vulnerable to runs and also pose risk to monetary policy, financial stability, and fair competition. These confirmed factors present apparent economic risk to American consumers who are already struggling. For these reasons, we must support the FSOC's efforts to continue to inform Congress on payment stablecoin risk, and I yield to the gentlelady from New York.
Thanks, the gentlelady, for yielding. It is true, Mr. Chairman, that FSOC is already charged with monitoring financial stability and reporting on those risks to Congress. But there is nothing in the statute that specifically requires FSOC to monitor or report on stablecoin. Following the financial crisis, we determined that there were gaps in the regulatory system, given segmented jurisdictional authority of regulators. Regulators were too siloed and missed emerging threats. FSOC was designed to help coordinate the regulatory agencies. Mr. Chairman, I am one of only a few members on this committee that was here prior to the financial crisis, and we listened to the experts tell us that these new and innovative products called credit default swap that were designed to ensure mortgage bonds were safe and an appropriate vehicle for banks and investors to park their money and will show them substantial returns. And look what happened. Subprime mortgages and their correlated credit default swap torpedo our financial system and our economy. I am not saying that stable coins will do that here. I hope they don't. But what I'm saying is that experts have told us that concerns being raised by new and innovative financial products are unfounded and could never happen, and yet they happen. This amendment will ensure we are monitoring those risks.
Would the gentleman yield?
Yes.
Yes, thank you so much. Thank you so much.
Time I yield.
Oh, I'm sorry.
Yeah.
Thank you. And I couldn't agree with you more. You've outlined it perfectly that, as they said, risks were hidden in plain sight, which was why FSOC was created to comprehensively look at bank and non-bank threats to the economy. And I think they have, and that's what Chairman Stile and I are noting, is that they have noted that these kind of financial innovations may pose risk and that they thoroughly cover them in the report. I don't think they're shirking their responsibility from Dodd-Frank. I yield back to the gentleman.
Reclaiming Ms. Waters' time. Mr. Chairman, requiring the FSOC to monitor and report on this new and rapidly expanded market is a prudent charge. I don't want to be here next year and telling you, I told you so. If this market and payment stablecoin issuers pose no systemic threat, then FSOC's job will be easy and inclusion minimal. On the other hand, not requiring FSOC to investigate and monitor this market could be catastrophic. And I yield back.
The gentlewoman yields back, who seeks recognition. Is there any further debate on the gentlewoman's amendment?
Mr. Chairman?
Mr. Lynch? Are you on her amendment? Yeah.
Mike.
I'd like to strike the last word.
Yes. Gentleman recognized.
Thank you. I fully support Ms. Velasquez's amendment. I think it's well-designed. It's targeted perfectly to the people who would be most interested in the safety and soundness of our financial system, including Treasury, the Fed, CFTC, the SEC, as well as the comptroller of the currency. But importantly, there are a number of non-voting members of FSOC that represent state interests, state banking, state insurance, that I think also, because of the structure of this bill, would have a big impact on state financial systems as well. I do want to note that when Janet Yellen made her comments about risk on the part of stablecoins, she did not anticipate or expect the expansion that this bill authorizes, which would greatly, I think, amplify the impact of stablecoins across our economy. With that, Mr. Chairman, I yield back.
Mr. Lynch yields back. Who seeks recognition? If there's no further debate on the amendment, the question now occurs on the amendment offered by the gentlewoman from New York. Those in favor, please say aye.
Aye.
Those opposed, please say nay. Nay. In the opinion of the chair, the nays have it. The nays have it. The amendment is not adopted.
Chairman, I request a recorded vote.
The gentlewoman from New York requests a recorded vote. All those in favor of a recorded vote, raise your hand. A sufficient number have raised their hands, and a recorded vote is so ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, further proceeding on amendment are postponed. Is there further amendment?
Mr. Chairman?
Of the gentlewoman.
Yes, I have an amendment at the desk.
A gentleman has an amendment at the desk. We'll pause for it to be distributed.
Mr. Chair, I reserve a point of order.
The gentleman from Montana reserves a point of order. The clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Ms. Velasquez of New York, designated as 13.
Thank the clerk. Without objection, this amendment is considered, read, and the gentlewoman from New York is recognized on her amendment.
Thank you, Mr. Chairman. I am offering this amendment with the intent to withdraw in order to raise this important issue, and I hope we can work on it together as this bill or another bill moves to the floor. One of the main reasons we're here today is to build a cryptocurrency industry that is fair and inclusive for all stakeholders, especially our constituents who have invested in digital assets like stablecoin to diversify their income stream and improve their quality of life. Across party lines, we aim to establish a regulatory framework that is coherent and has teeth, one that assures every individual that their government stands behind them, empowering them to make the most of their investment without falling prey to unchecked speculation or regulations designed to benefit a select few. To do this, we must confront a major loophole in our federal tax system: the ability of wealthy U.S. citizens to pay zero federal taxes on capital gains, interest, and dividends from their digital assets simply by residing in Puerto Rico for 6 months out of the year. My amendment seeks to close that loophole. Since Hurricane Maria in 2017, Puerto Rico has become a testing ground for influential members of the U.S. blockchain and crypto community. Nearly 3,000 crypto enthusiasts have established residency there, not to support the local economy, but to legally sidestep federal taxation. This influx has created deep tensions in a jurisdiction where the poverty rate hovers near 40%, and where these tax benefits are unavailable to locals. Puerto Rican investors have been left behind in an economic landscape that increasingly feels rigged. And I am certain that if more Americans on the mainland currently preparing to pay their taxes knew about this, they will be just as outraged. Equally alarming is the potential loss to the federal treasury. Here we are trying to look for every penny, firing off the federal workforce. Well, why don't you act on this? I invite you to join with me in correcting this wrong. An IRS whistleblower recently disclosed that at least $10 billion is being reported annually as Puerto Rico source income in order to avoid federal taxation. And look, you could look at all the articles that have been written. Why are cryptocurrency evangelists flocking to Puerto Rico? Puerto Rico's crypto community enjoys a tax haven, but does Puerto Rico benefit? At a time when the federal government is actively seeking new sources of revenue and working to establish a coherent regulatory framework for stable coins and digital assets, we simply cannot allow a crypto tax haven to expand unchecked within a U.S. jurisdiction. So, some may argue that my proposal threatens Puerto Rico's competitiveness, but the facts tell a different story. Between 2020 and 2026, Puerto Rico is projected to lose $4.5 billion in revenue from tax exemptions granted to individual investors. That is nearly a third of the island's entire general fund for 1 year. Meanwhile, the island continues to struggle with severe economic challenges. Puerto Rico should remain competitive, but not by turning itself into a tax shelter for the ultra-wealthy that prices out small investors and local entrepreneurs in both the territory and the mainland. This is not just about closing a tax loophole. It's about restoring fairness, protecting federal revenues, and ensuring that every American regardless of zip code, equally benefits from the promise of this new technology. I respectfully urge your support for my amendment. Let's get this right together. Thank you, and I yield back.
Gentleman yields back. The gentleman from Montana.
Mr. Chairman, I insist on the point of order pursuant to Clause 7 of Rule 16 of the Rules of the House of Representatives. The amendment is not germane because it is within the jurisdiction of the Ways and Means Committee, not within the jurisdiction of the Committee on Financial Services, and therefore violates Rule 10 of the Rules of the House of Representatives.
Yes, Mr. Chairman, I know all that.
Yes, gentleman, does the gentlewoman withdraw her amendment?
Yes, but I would like for you to work with me and other members in reaching out to the Ways and Means Committee. I think this is a very important issue. If we intend to deal with the deficit, and it just, this is morally wrong. And I ask you to join forces with me in addressing this.
I'd be happy to work with the gentleman. Gentlewoman's reputation and knowledge for the care and prosperity on Puerto Rico are well known to this committee, and look forward to working with you. Gentlewoman withdraws that amendment. Is there additional amendment?
One more.
Mr. Lynch is recognized.
I believe I have an amendment at the desk.
We'll wait for it to be distributed.
Mr. Chairman, I reserve a point of order.
Gentleman from Montana reserves a point of order.
The clerk will report the amendment.
An amendment to the amendment in the nature to...
Without objection, the amendment is considered as read. The gentleman, Mr. Lynch, is recognized for 5 minutes on this amendment.
Thank you, Mr. Chairman. Mr. Chairman, this amendment would remove a provision of the bill that states that if the primary federal regulator fails to review a stablecoin issuer's application for approval within 120 days, that application is automatically approved. At a time like now when federal workers at various financial services regulators are being illegally fired, placed on administrative leave, given limited resources and limited access to their workplaces, it is unreasonable to expect that federal regulators can meet this deadline. In the meantime, Elon Musk and his Doge committee continue to interfere with independent financial regulators, attempting to strip them of resources needed to conduct statutorily mandated work. How would a financial regulator, which is already stretched on resources prior to this election, be able to conduct an adequate review of an issuer's application? Also, the sequencing in the bill allows stablecoin issuer applicants to swamp the CFTC with applications which they are not familiar with, and they've never done this type of work before. No one has, and they continually lack adequate numbers of employees properly trained to conduct this new responsibility. If this committee was truly invested in providing a thorough and robust regulatory structure for stablecoins, it would be giving financial regulators significantly more resources, not less, providing an issuer with an automatic approval if a regulator is unable to process an application, while also stripping that regulator of resources, is not in the best interest of the public. This provision will allow issuers to slip through the cracks without adequate review, and I urge my colleagues to ensure our financial regulatory system remains robust and remove provisions that allow for automatic approval. Thank you, and I yield back.
The gentleman yields back. Is there further debate on the amendment? Mr. Lawler of New York is the ranking member. The ranking member, Ms. Waters.
Thank you.
Recognized for 5 minutes to strike the last word.
I move to strike the last word. I would like to thank Mr. Lynch for offering this amendment, which is crucial to ensure our federal regulators have the time to properly render a decision on the payment stablecoin issuers' applications. This amendment ensures that applications are not deemed approved simply because the regulator waits out the clock. Under the Trump administration, the provision in this amendment could lead to a massive loophole in the bill, allowing all payment stablecoin issuers to be approved regardless of if they meet the requirements or not, if the regulator only waits long enough. We know that Trump's own stablecoin will be going through the process. And knowing what we know about Mr. Trump and the way he does business, the way he intimidates everybody, and the way he changes the rules in the middle of the game, and the same thing with Elon Musk once he issues his own stablecoin as well. We cannot allow them to go through the regulatory process with a rubber stamp. And I'm sure they're poised to do so. So I urge members to support this amendment, and I yield back.
The gentlewoman yields back. Does the gentleman from Montana insist on his point of order?
Mr. Chair, I withdraw my point of order.
The gentleman withdraws his point of order. Is there further debate on the amendment? Ms. Wagner, the former ambassador to Luxembourg, is recognized for 5 minutes to strike the last word.
And the chairman of the Capital Markets Subcommittee. I'm sure you meant to say that too. And I thank you, Mr. Chairman. And I have to say I strongly oppose the removal of this provision of the Stable Act. This is simply good governance, Mr. Chairman, where congressionally enacted law requires a federal agency to review a completed application. It must do so and be incentivized to do so. We can't let a pocket veto become a means of Operation Choke Point 3.0. Too many applications before regulators under other frameworks previously have been allowed to lapse without appropriate review. American businesses and consumers deserve efficient processing of applications, Mr. Chairman, to bring issuers within the regulated perimeter. The least the government can do is process applications within the time allotted by Congress, Mr. Chairman. So again, I strongly oppose the removal of this provision, oppose the gentleman's amendment, and I yield back.
Will the gentlewoman yield?
I'd be happy to yield to the chair.
The gentlewoman yields. Appreciate your comments, appreciate your leadership in the broader financial services space, but particularly the engagement on this important piece of legislation. I think as we come in the home stretch of the amendments, what we're seeing is a series of bills that are really duplicative rather than diving in and adding into some of the structure of the bill. I'll speak in more detail on the amendment in a minute, but I do think we have a huge opportunity here as we think and step back to 50,000 feet for a moment. What we're looking at is a legal landscape that was really throttled by the Biden administration for 4 years. You have Gary Gensler at the SEC putting forward rules and regulations that are pushing this innovation and development offshore. We've now shifted dramatically. We now have pro-crypto folks inside the administration. We've had great engagement from different agencies on this legislation. And this is a moment in time to really move back into the United States and domicile the innovation and development in the U.S. And so I think as we look at some of these amendments, and again, I'm going to comment on this amendment in full in a minute, but as we look at some of these amendments, I think it's as if the baseline is perfection rather than the baseline being the economic reality around the globe. So we're in an environment right now where stablecoins are being issued across the globe, some well-founded, well-backed. We have cryptocurrencies being issued, some well-founded, well-backed, some that maybe are less so. And what we have is a huge opportunity to put forward a regulatory framework to address the risk that is being discussed by my colleagues across the aisle, to scale that risk, to protect American consumers, but also at the same time benefit from economic development and growth here in the United States. And so as we step back big picture, I feel as if some of these amendments that have come before us today is as if there is a utopia of perfection on the other side. And at a previous hearing, we were talking about what happened when the Obama administration provided access to Iran of millions of dollars of cash. So as we recall, cash was literally like flown to Iran. And then the question was, what are the protocols in place once cash is in the hands of a regime like Iran? And the reality is there's very little control or mechanism, so that is not a good scenario. This gives us an opportunity to dramatically improve upon that. And so I don't want it to be lost in this broader conversation and discussion that we're having today, that is as if the risks that are being purported by my colleagues on the right would move us in that direction. I think the reality is that there's serious and substantive risks that exist for a lot of these challenges, and how do we address them? It should be a broader part of this conversation. So where cash is a default for a lot of people, or you could use cigarettes or anything else, let's just not let perfection be the enemy of the good. I'm going to come back to this in full. I'll yield back. The gentlewoman's time has expired. Does any else seek recognition? The gentleman from New York, Mr. Lawler, is recognized for 5 minutes to strike the last word.
I move to strike the last word. Mr. Chairman, on this great bill that you've put forth, I believe it's 75 pages. At any point in those 75 pages, do the names Donald Trump or Elon Musk appear in the text of the bill? Mr. Chairman? Do the names Donald Trump or Elon Musk?
The gentleman's yielding to me now.
Yes.
I yield back. No.
No. Okay, great. So a 75-page bill that has been written for the purpose of establishing clear definitions and a regulatory framework for payment stablecoins, and has no mention of the names Donald Trump or Elon Musk, and yet throughout the course of this day, my colleagues on the other side of the aisle have spent hours talking about Donald Trump and Elon Musk. I'm very glad that nobody over there was playing the drinking game, because you would be absolutely inebriated if you were. The fact is that this bill is necessary to ensure a regulatory framework that ensures that stable coins are safe, that they are secure. The one-to-one ratio with the dollar is critical to ensure that we don't have a situation that some of my colleagues talked about earlier, concerns that the federal government would have to bail out stable coins. Yet, interestingly, many of my colleagues on the other side on another bill shortly are going to be opposed to a ban on a central bank digital currency, which is kind of ironic, given that they're so concerned about the potential of bailing out stable coins. But on this particular amendment, to echo the words of my colleague, the chair of the Capital Markets Subcommittee, the fact is so many businesses rely on the federal government or state government or a local government to make timely decisions. And oftentimes the government fails to do that. And it has a compounding negative impact on these businesses. And so the purpose of that section is to say that the government and the regulatory body has a responsibility to make its determination in a timely manner. And if they fail to do that, then the application is deemed approved. And so hopefully they will do their jobs effectively and that won't be a problem. But businesses should not be harmed by the failure of the regulatory body to act within a timely manner. And again, the whole purpose of this bill, which has nothing to do with Donald Trump and nothing to do with Elon Musk, despite the hours of commentary we've heard today, the reality is that this is about setting up a regulatory framework to ensure transparency and accountability within the stablecoin market. That is the objective of the bill. And again, it requires a uniform federal floor. It requires payment stablecoins to be backed one-to-one by high-quality liquid assets. It requires issuers to establish procedures for redemption and publicly disclose those policies. It requires monthly public disclosure of reports detailing the total number of outstanding payment stablecoins and the amount and composition of backing assets. It establishes tailored capital requirements, liquidity standards, and risk management requirements for operations, compliance, reserve asset diversification, cybersecurity, and information technology through a joint rulemaking by the primary federal regulators in consultation with state regulators. And it prohibits permitted payment stablecoin issuers from paying interest or yield to holders of their payment stablecoins. This is a necessary bill. It is something that has broad bipartisan support. 3 members of the Democratic Conference are supporting this bill as co-sponsors. The bill is going to pass, and yet we've spent hours listening to diatribes about Donald Trump and Elon Musk, which has nothing to do with this bill. I yield back.
The gentleman yields back. The gentlewoman, Ms. Velasquez, is
Yes, I move to strike the last word.
5 minutes to strike the last word.
Mr. Chairman, you don't need to use the name of Donald Trump and Elon Musk to know what's going on. If you read the article by Reuters, it says here how the Trump family took over a crypto firm as it raised hundreds of millions of dollars. And then CNBC, maybe they were drunk. Trump-backed crypto bank joins stablecoin wars with new dollar-pegged token. So don't come here and talk about Democrats raising the name of Elon Musk and Donald Trump. We know what's going on. Thank you. I yield back.
The gentlewoman yields back. Is there further debate on the amendment? Mr. Nunn of Iowa is recognized for 5 minutes.
Well, thank you, Mr. Chair, and this has been an illuminating conversation. We have the opportunity to lead on the world stage in innovation with your act, the Stable Act, or we have the opportunity to shirk responsibility and turn over the innovation, the dependability, the ability to track and stop illicit financing, and give it over to those more aligned with a RMB market out of Beijing than a dollar-backed leadership out of America. Look, I make no bones about it. I am proud to support Chairman Stiles' Stable Act. We have the opportunity to manage and move money that is rapidly transforming in this space, and stablecoins are offering us a powerful opportunity to create a modern and efficient payment system that candidly not only will reshape the economies of Main Street communities like mine in Iowa, but drive a benefit to every single American, both in their ability to feel secure in a US-backed stablecoin, but also to eliminate things like transfer fees, overdrafts, costs that inhibit the ability to make purchases, everything from a home down to that first car or even buying eggs at the supermarket. Stablecoins provide us the ability to know what the value is going to be. And when it is backed by the American dollar, it provides us the ability to proliferate not only around the world, but to drive more people to invest in things that not only are produced in America by Americans, but make us a preeminent leader for good in the world. I will offer, though, without congressional action, we risk limiting not only the growth of stablecoins, but of the role America plays for that force for good in the world. As we've noted here, the United States, through debates like this, have vested good ideas. But if we fail to act, we are going to let other actors, whether they be in London or Singapore or offshore, potentially fill the void. We will see bad regulation like the kind seen out of the European Union take hold throughout the world. Or worse, we will allow the worst kind of actors, those in Moscow, in Beijing, in Tehran, own this operation space. And with it, it won't just be a competition against the U.S. economy or the undermining of the U.S. dollar, but it will become an information superhighway for illicit funds to be used in things like human trafficking, cartel management, the proliferation of illicit drugs, and worst of all, the funding that will go to the very root of those things that threaten us most. Terrorist actions and state sponsors of terrorism that can culminate in real threats, like we're seeing today in Iran, of trying to build their own nuclear regime by using illicit funds. We only need to look at what the Department of Justice focused on last week, disrupting nearly $200,000 intended for Hamas. Stablecoins could have provided a better security blanket for this on the front end. Last year, the U.S. used blockchain, something stablecoin would run on, in an international effort to dismantle a Russian money laundering network, resulting in over $22 million that were seized. This is what the American dream is capable of when we use our innovation to track these down versus pilfer it away out of fear and, candidly, Mr. Chair, ignorance on the issue. Together, I believe that both Republicans and Democrats have the opportunity not only to lead on this, but open up a broad new future and innovation in what can happen in stablecoin and grow our economy. And to your credit, Mr. Chairman, this is an opportunity that the Senate can learn from what we do in the House closest to the people, and something I have heard time and time again from leaders in my community that want to see this innovation take place. And those innovation leaders might not only be in the classroom and in the academic institutions, but they're also the merchants on Main Street. They're the hometown farmers who want to be able to see this as they pass it on to their next generation and can make commodity decisions based on something that's stable. And clearly, Mr. Chairman, as you've noted, there's nothing more stable in our future than an economy that is successful. And stablecoin has the opportunity to help make that possible across our area. I hope that this is not only something we can pass today, but I look forward to marching this forward into the future of America's innovation and economic dominance. With that, Mr. Chairman, I yield back.
The gentleman yields back. Is there further debate on the amendment? Mr. Lynch of Illinois is recognized for 5 minutes to strike the last word. Mr. Foster of Illinois, I apologize, Mr. Foster.
No problem. I will yield my time to the ranking member.
Thank you very much. I move to strike the last word. We've talked a lot today about the many concerns with this bill. Listen, my biggest concern is Trump and the fact that he is brazenly sponsoring his own stablecoin as Congress prepares to vote on legislation. But I'm not just concerned with the blatant corruption of a president controlling and writing the rules for a stablecoin. I believe that what we are experiencing feels like a coup d'etat, one that, if not stopped, threatens the very fabric of our democracy. Trump has undermined our constitutional freedom of the press, freedom of speech, the process, and an independent judiciary. He's taken full control of the Department of Justice, and with executive orders is exacting revenge on anyone he considers an enemy. His efforts to undermine this government also extend to the private sector, where he is threatening corporations and law firms to bend the knee to him. If Trump's effort to undermine the freedom of the press, in his efforts, one of the first actions was to revoke the Associated Press's access to the White House press briefing room after AP refused to refer to the Gulf of Mexico as the Gulf of America. He also cut funding for the Corporation of Public Broadcasting and has filed lawsuits in courts against media outlets. In a speech at the Department of Justice, he threatened the press by describing two major outlets as, quote, really corrupt and illegal. And just last month, he fired numerous journalists at the Voice of America. And as he's suppressing the media, he's stacking the White House press briefing room with Trump loyal outlets who will parrot every word he says. This pattern of intimidation is a direct attempt to silence dissent and replace truth with propaganda. Trump is also attacking freedom of speech, thought and expression, as well as due process by threatening the funding of universities and abducting, imprisoning, and endangering the lives of immigrant students who hold views that Trump just does not like. He's attacking our independent judiciary for daring to uphold the law and block his illegal actions. He and his regime are threatening impeachment of judges and dismantling of the judiciary. He has fully asserted his control of the Department of Justice and has made clear his attempt to use all levers of the DOJ to exact revenge on anyone he disagrees with. He's weaponizing the Department of Justice to make good on his campaign promises to prosecute Democrats and anyone he considers, quote, the enemy from within, which is eerily reminiscent of Nazi Germany. And finally, he's turned his eye to the private sector, deploying the DOJ and his executive orders to force parts of the private sector to bend knee or suffer the consequences. This includes seeking revenge by revoking the security clearances and security details of President Biden, Secretary Clinton, Vice President Harris, and Chairman of the Joint Chiefs of Staff, Mark Milley. And he's targeting law firms that have represented Democrats, forcing them to capitulate or to be barred from appearing before judges. Before I close, I want to point out one of his executive orders that prohibited foreign aid to South Africa as a political favor to Elon Musk. Elon Musk is threatening the president of South Africa. He wants to put his battery factories in South Africa. As a result of apartheid, and we got rid of it, then there was reconciliation. In that reconciliation, it points out that the black South Africans in particular, who have been prohibited from being a part of contracts and government and all of that, that he wanted Ramaphosa to get rid of that, and if he didn't, he would tell Trump to stop all foreign aid. And that's what Trump has done, use USAID to stop the aid to South Africa because Elon Musk won his battery factories there without a 30% participation by black South Africans. And then he had the audacity to stir up the Afrikaners, the white South Africans, and tell them, if you don't like what's going on, come on to the United States. While he's deporting people, he's inviting this. This is what is going on. This feels like a coup d'etat. This feels like all of what we understand about how coups take place is what is happening with the President of the United States of America. And so, ladies and gentlemen, while we are dealing and trying to make stablecoin something that will not be a ripoff to the citizens of this country and that we have safeguards around it, all of this that I'm describing is going on, and you know it is. You know this feels like a coup d'etat with the press, with the judiciary, with private law firms, on and on and on, and even education, that he is dismantling and threatening and intimidating. We'd better beware, and I am very concerned, and I yield back to Mr. Foster.
Yield back my time.
Gentleman yields back. The gentleman from Montana, Mr. Downing. Is
Mr. Chairman, I move to strike last word.
So recognized.
So I share my colleague from New York, Mr. Lawler's quandary here. I understand this bill that we're talking about here, and thank you for all your good work on it. There's been a lot of work that's gone into this bill. But I see this as a bill about innovation and about a framework, a regulatory framework. I don't see this as a bill about the president, and I'm really confused why we seem to have spent the majority of our time talking about the president, where we really should be talking about a regulatory framework and how this solves some very real problems and how this promotes innovation in the United States of America. And these are two things that I really like about this bill and that are really important to me, innovation and regulatory clarity. And I'm going to start on the innovation part. I started my career as a research scientist at the Courant Institute of Mathematical Sciences at New York University, surrounded by some of the smartest people I've ever worked with. And we were changing the world. We were innovating. And the things that we did there, I'm incredibly proud of. And I left there to do a startup company that I was fortunate enough to successfully merge with the nascent Yahoo Incorporated back in the 90s. Talk about innovation. We were, again, doing things that nobody ever thought about, changing the world. That was all happening here in the United States of America. I'm incredibly proud of the work that we did, again, surrounded by smart people doing incredible things. And then from there went into technology ventures, so helping other innovators change the world, helping them figure out how to raise money, how to build their companies, how to be successful in taking their ideas and innovating. So then fast forward from there, the last 4 years before I was in this office, before I ran for Congress, I was the securities regulator. I was the commissioner of securities for the state of Montana. And one of the things that really struck me is in being the securities regulator is there was so much ambiguity, regulatory ambiguity in the digital space, in the crypto space. The SEC seemed to be unfriendly and somewhat ambiguous on this space, and that was difficult for us to deal with as a regulator. We had to deal with everything from BlockFi to FTX, and saw obviously a lot of things happen. And really, as a regulator, what I attributed a lot of those problems with is we did not have a reasonable regulatory framework to have a lot of these innovations happening in the United States of America. And so obviously we saw one of the biggest headline getters there being offshored. And I think it's incredibly incumbent upon us to have a regulatory framework that encourages that innovation to stay here, because we have adversaries that are going to try to leave us in the dust. And they're not going to have the opportunities, or they're going to surpass us if we don't continue to bring a reasonable framework into the United States of America. And most companies just want clarity. I talk all the time about, if you're putting together a business plan, you're trying to run a business, what you want to know where that bar is. And you can always plan for that bar. And if you plan for that bar and you know that bar is not going to be moved or it's not going to be swinging like a pendulum, you can do incredible things. You can plan your capital, you can plan your investments. So having a bar that's stable, I think, is incredibly important. And so, I want to thank all of my colleagues for the great work they've done here. I appreciate the dialogue we've had today, but I'm very excited about this because this gives us the regulatory clarity with the sideboards that we need so that we can actually be global leaders in this space. And I think that that's what we want to continue to do, is be global leaders. And by creating this regulatory clarity and making it easy to understand what the expectations are, what those sideboards are, to bring this type of industry into the United States and make sure that it is here, that it is dollar-backed or dollar-based, I think is incredibly important, not just for this industry, but also for continuing to grow the value of the dollar. That's one of my other concerns, is making sure that that is the global reserve currency, and we continue to add to that. So I'm very excited about this work. Mr. Chairman, thank you for all the thoughtful work you put into this. Thank you to my colleagues who have reached out to stakeholders to really make this the incredible piece of legislation that we have in front of us. And I'm just excited about having this so that we can continue to innovate and we have clarity moving forward into the 21st century. So on that, I yield.
The gentleman yields back. Is there further debate on the amendment? The gentleman from North Carolina, is the gentleman from North Carolina some more seeker recognition?
Yes, Mr. Chairman, thank you.
You're recognized for 5 minutes to strike the last word.
Thank you, sir. Just as I've listened to this debate, I had to sometimes check, and I checked with my good friend, Mr. Downey, here to make sure that we were actually on what bill we were on at times, because it sounded like we were trying to relitigate the 2024 presidential election at many times. But, this bill is about bringing crypto, bringing digital assets up to date. I think the latest stats that I've seen show that roughly 30% of the American people either own or use cryptocurrency in some form or another. And this legislation, Mr. Chairman, is very well thought out, and I just have to tip my hat to you, to the work that you and the others did in working on this legislation and getting stakeholders involved, and getting folks and consumers involved, getting folks from the industry involved to come up with something comprehensive that provides for the rules of the road, which is very important. It provides for consumer protection. It provides for transparency. It provides numerous safeguards so that digital assets can be used in this growing economy. Now, the reality is where America has failed to act, capital has left our shore. These funds, these investments have gone offshore, have gone to other countries. And as the world's premier superpower, as the strongest economy in the world, we owe it as a nation, frankly, to the international order, for lack of a better way, to have this in the United States, because we are the soundest economy here. We have the most predictable laws, and it only makes sense that you adopt this plan. And so this proposal, and I know it's supported on bipartisan basis, I frankly am surprised it's not unanimous. And I regret that there are all these other distractions about the president and anyone else, about members being concerned or having gripes with what's happening there. I personally support the president. I think he's doing a great job. But regardless of that, this bill on its own merits is a good piece of legislation. And I would say that regardless of who's in the White House, because it's going to provide that certainty that Americans need to be able to continue to invest in digital assets, to continue to use digital assets in commerce. This is not going anywhere. The arguments against it are kind of like the arguments for improving, the wheels on, the wooden wheels on a wagon or something. I mean, this is, and it's not just the future, it is today. When I look around this room, I see a lot of young folks, and I see generationally, younger folks want to use more and more digital assets. And I think because they understand the technology. I get the feeling that from a generational standpoint, there's some folks, this is a new technology and there's a lot of fear about it. Well, the purpose in adopting this law is to provide those protections so that everyone, regardless of their knowledge or background or comfort with technology, can participate in this market. And so it's been well thought out, and of course we've aptly, I got to say, Mr. Chairman, we've aptly debated all of these amendments. We have fully discussed. I think we've been here since, I believe, 10 a.m., and we're still on the first bill. And I think it shows the true deliberative nature of this body and of this committee in really working to try to come up with legislation that is going to improve the economy of this great nation. So I would reiterate what many have said on this side of the aisle, and frankly, a couple on that side of the aisle, in support of this legislation That is the result of months and months of work and meetings with stakeholders that will, if we adopt it, if we can get past all of the political rhetoric and all this other stuff, pass this bill, because Mr. Chairman, if we pass this, we're doing right by the American people. And with that, I yield.
The gentleman yields back. Is there further debate on the amendment?
Move to strike the last word.
Gentleman from Texas is recognized to strike the last word.
Mr. Chairman, I yield my time to my colleague, Congressman Lawler.
I thank you, sir, for yielding to me. Look, a lot has been said over the last, 10 hours of debate over this one bill. Much time spent focused on the President of the United States and a businessman, Elon Musk, that have nothing to do with the content of the actual bill. And we've heard a lot of debate, a lot of discussion, almost none of it centered on the actual language in the bill. A lot of solutions in search of problems that don't exist, and a failure to recognize the critical importance of having a regulatory framework, one federal standard, a uniform standard, put in place to ensure that the United States and that our businesses, our companies, are leaders and innovators in this critical technology and digital currency. And so I think this legislation on the whole is important. I think this amendment would negatively impact the passage of this bill, which is something that both parties have worked on over multiple Congresses.
It looks like we're
Both parties have worked on to make sure that there was bipartisan buy-in when it comes to this legislation. And in fact, we have 3 members across the aisle who are co-sponsors of this bill. There is bipartisan support in the Senate. So certainly this bill seems to have broad consensus. And it's unfortunate that we wasted 10 hours on a whole lot of nonsense rather than actually advancing this bill forward and moving on to the other bills that are on the agenda today. And I would reiterate the point, some of the amendments that were put forth today talked about the concern about bailing out stablecoin companies and using taxpayer money to bail them out. And yet, some of my colleagues on the other side of the aisle are going to be opposed to legislation that would prevent a central bank digital currency. If ever there was something that would create concern about the impact on taxpayers, it would be a central bank digital currency. So, we've had a very hearty discussion today. Mr. Chairman, I don't know if you have any additional thoughts, but I would like to yield the remainder of my time to you.
The gentleman yields to the gentleman from Texas. The gentleman from Texas, I think, has yielded to me. Thank you.
Yes,
I appreciate my colleague from Texas. Mr. Lawler, he said a lot.
He said it before.
But I think what's so important here is the substance of the underlying bill. And what we have seen is distractions from the core context of what we're trying to do, which is put forward a legal framework for stablecoins here in the United States to encourage innovation development to occur domestically. We have heard a litany of amendments that have come forward. Some have not even been serious. Some have been of substance, and I appreciate those of our colleagues who brought substance to the table in an area where we want to make sure we're getting the regulations right. The duplicative nature of some of the amendments brought forward, I don't think have moved us further in this discussion. We want to make sure that we're right-sizing the regulation, that the environment in the United States is inviting to really unleash the capital to deploy in Web3. As we think about the benefits that the United States has had from the development and innovation that's occurred domestically in Web 2, we want to make sure that the United States is the home for Web 3. We know we need this regulatory environment in the United States, and I think at the end of the day, we're going to see a strong vote on the final underlying bill. Recognizing the time, I yield back. The gentleman's time has expired. Is there further debate on the bill? Gentleman from Indiana, Mr. Stutzman, is recognized for 5 minutes.
Mr. Chairman, I move to strike the last word.
The gentleman is recognized to strike the last word.
Thank you, Mr. Chairman. And again, first of all, thank you, to you and the hard work that you've done on the underlying bill. One of the things that I've noticed just in our conversation today, and I know there's a lot of slow walking the bill, but that's what's happened over the past decade, and we've seen a lot of technology throughout the past 10 years and how this industry continues to formulate. And I just feel like we can't just sit still and do nothing at this point, and that we need to move forward. There's a lot, there's always going to be some unknowns, and there's going to be concern, but business moves quickly. And there's going to be other folks around the world, particularly in China, that they're not sitting still. They're not waiting for us to move forward on some sort of framework for payment stablecoins. And I believe if we don't move, that we then will be left in a spot where we have to try to fix problems. So I would just continue to encourage this committee to move forward. We've sat here and listened through these amendments, but I believe that the work has been done and we know what we need to do. And with that, Mr. Chairman, I'll yield back the balance of my time.
Gentleman from Indiana yields back. Who seeks recognition? The gentleman from Wisconsin is recognized.
Thank you very much, Mr. Chairman. I just want to talk real quick on the substance of the amendment as proposed, because we've had a good, solid conversation as we're here in the home stretch of this markup. But let me just go back and loop this back in on the substance of the underlying amendment as proposed by Mr. Lynch. And I oppose the removal of the provision in the Stable Act. The provision simply provides that where the federal payment stablecoin regulator fails to render a decision on a complete application within the time period specified 120 days, which is consistent with the timing of other federal services contexts, such as the FDIC application review, the application shall be deemed approved. The simple good governance where congressionally enacted law requires a federal agency to review a completed application must do so to be incentivized to do so. So here's really the bottom line as it relates to the amendment. We can't let a pocket veto become a means for Operation Choke Point 3.0. Too many applications before regulators under other frameworks previously have been allowed to lapse without appropriate review. And so American businesses and consumers deserve efficient processing of applications to bring issuers within the regulated perimeter. The least the government can do is process the applications in a time allotted by Congress. So I'd encourage my colleagues to vote no on the amendment as proposed. As we are in the home stretch, let me just take one more minute because there's been some crosstalk and some conversation. I just think it's worth noting that the Stable Act creates a really robust framework for centralized payment stablecoins backed by high-quality, real-world fiat assets. We know that. It should be noted it's not our intention to sweep in non-payment stablecoins. So this includes decentralized stablecoins. So non-payment stablecoins have different use cases and risk profiles than centralized payment stablecoins. We'd want to address these novel risks. If we want to address those novel risks, we'd need to do so in separate legislation. We crafted the Stable Act to cultivate the innovation potential of payment stablecoins so they can be used for payments, in particular in the United States. The act is not intended to cut off a burgeoning blockchain-based product that is far different than the payment products we're seeking to legislate today. In my final comments, we've had a robust conversation, a robust debate. I appreciate the participation of everybody in what's now approaching a little over 9 hours of debate, of amendments on the text of the bill. I am of the firm belief that this is our opportunity to make sure that the US dollar remains the world reserve currency, that blockchain technology is really unleashed in the innovation and development occurs here in the United States of America, not abroad. I appreciate the robust conversation today. Mr. Chairman, I will now yield back.
Gentleman yields back. Is there further amendment to on this amendment? Whose amendment is this? Is there further debate on the amendment? If there's no further debate, the question now occurs on the amendment offered by Mr. Lynch. All those in favor, please say aye. Any opposed? Nay? Nay? In the opinion of the chair, the nays have it. The nays have it. The amendment is not adopted. A recorded vote has been requested. All those in favor of a recorded vote, raise your hands. A sufficient number have raised their hands, so a recorded vote is so ordered pursuant to Section C5 of the committee, Rule 3 of the committee rules. Further proceedings are postponed. Is there further amendment to Mr. Stiles' amendment in the nature of a substitute? The gentleman from Ohio.
Mr. Chairman, I have an amendment at the desk.
Gentleman has an amendment at the desk. We'll wait to have it distributed. This is
his first one.
Commodity backed ones.
So you'll offer, talk about it and say how it was going, and then he'll go and say, oh, I look forward to working with you. But it's clunky.
Yeah, I got you.
Thank you.
Yep.
Let's hear from the clerk.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Davidson of Ohio, designated as 49.
The amendment will be considered as read, and I now turn to the gentleman from Ohio for 5 minutes to talk about his amendment.
I thank the chairman. My amendment, this amendment is not complicated, and frankly, it addresses a concern expressed by Mr. Meeks, that this bill is not yet adequately protect state-based regulatory frameworks. In spite of substantial progress from where the Genius Act left off in the Senate, we still have some things that are missing. The New York
The New York Department of Financial Services has the nation's most time-tested and proven regulatory framework for stablecoins. Along with fiat-backed stablecoins, they have approved commodity-backed stablecoins for settlement purposes. Back in September of 2019, Paxos Gold became the first regulated gold-backed settlement token. One Paxos Gold token represents 1 troy ounce of gold. So it's stable, but in a different way than a fiat-backed stablecoin. Fiat stablecoins or a payment stablecoin represents $1 per token. This token represents physical custody of 1 ounce of gold, and that's in fact how the New York-based trust company is regulated. They have regular audits of 1 ounce of gold stored in a vault and monitored by the New York Department of Financial Services. It's a straight one-to-one backing of physical custody of gold, no derivatives, futures, leases, or contracts. And if we let this landmark stablecoin bill roll out without even a nod to the state-based regulated product, which commodity-backed stablecoins reflect, we're ignoring the reason that we're providing a federal regulatory framework in the first place. Gold has been used in conjunction with money for about as long as humans have understood the entire concept of money. So talk about stability, people trust gold. This is simply a secure way to use it at the speed of light, just like other stable coins. I believe this committee should remain serious about new payment technology, including the recognition of already legal commodity-backed stablecoins as regulated by the New York Department of Financial Services. I think first, do no harm, and the idea that we would skip the moment to create a federal regulatory framework is a big missed opportunity. So let's not sleep on this opportunity to keep commodity-backed settlement in play. I encourage all of our colleagues to support this amendment, and I yield.
Who seeks recognition? Ranking member.
Thank you very much, Mr. Chairman. I was reading, because this is the first time that I've seen Mr. Davidson's amendment, and I think it has some value here. It has some interest, certainly. And I'd like to, if I may, have a colloquy with Mr. Davidson so I can better understand what this attempt to do is. A commodity-backed settlement token insurer may issue a commodity-backed settlement token consistent with regulation imposed by state community-backed settlement token regulators. That sounds, if it's a sensible thing, could I do a colloquy with you, Mr. Davidson?
Certainly.
As I understand it, this is something that you've been working on for quite some time.
About 3 Congresses now.
And what is the greatest opposition to what you're attempting to do?
Well, I've dialogued with Mr. Himes from Connecticut about it in the last Congress, and he didn't understand. I think initially people thought that because it's referred to as a commodity-backed stablecoin, people were viewing it as trying to stay stable as $1, but backing it by gold. And of course, gold moves in value relative to dollars. 1 ounce has gone up quite a lot over the past few years. And it reflects inflation to that extent. Some people view gold as a better store of value in a lot of ways, and they've held physical gold. In this case, the gold is stored physically in vaults. New York Department of Financial Services audits those vaults, and they either have the gold or they don't. So frankly, you don't even have the kind of risk that's involved in treasuries where you have short-term treasuries, they're traded in markets, and they too change in value, which requires all kinds of hedging strategies. Gold is really simple. You either have it or you don't, and if they say they have, say, 100,000 ounces of gold, they could issue 100,000 tokens. If they have 200,000 ounces of gold, they could issue 100,000 tokens, or they could issue up to 200,000, but it's all priced in the number of ounces of gold that is actually physically present. So in that sense, the 6 or 7 years that it's been regulated in New York, the CFTC, Commodity Futures Trading Commission, has never engaged with it. That's not to say there's never been fraud in commodity-backed markets. but there's no derivatives contracts, there's no leases, there's no normal triggers for the Commodities Exchange Act. It literally only counts physical custody for its stability. And it represents, in the case of this token, 1 ounce of gold.
I want to understand some definitions here. Community-backed settlement.
Commodity-backed settlement token. And frankly, that was a term that we worked on with Mr. Himes. I don't know that if he loves all of it yet. He's been busy with his Intel work. But he was concerned that if we call it a payment stablecoin, people would confuse that as the same thing people mean by a fiat-backed stablecoin. And we're like, okay, fine, we'll call it something different. So we looked at the company that is offering this already in the market since 2018, 2019, and they refer to it for use as a settlement instrument, so we called it a settlement token.
How many commodity-backed stablecoins have depegged?
Well, I don't think it's possible to depeg in the sense you either have the gold or you don't. This is the only one that I know of that's regulated in the United States, and they've always passed their audits. They have physical custody of it, so like I say, you either have the gold or you don't. And the auditors go audit the vaults.
You said something about the gold standard? What did you? What other commodities are other than gold? What other commodities are backing these coins? Okay, we've been talking over here. We want to know what other commodities are backing stable coins other than gold.
I don't know currently, but if you could imagine a future token, the United States, for example, has a strategic petroleum reserve. Lots of companies have gold. Once the U.S. was on the gold standard for much of the U.S. financial history, we depegged from gold back in August of 1971, and part of the logic was, A, there's just too much liquidity demand to maintain a true gold-backed U.S. dollar.
And do you
but it was backed by petro. It was essentially the petrodollar.
All right.
Oh, you'll just, time has expired. Who seeks recognition?
I do, Mr. Chairman.
The gentleman from New York is recognized.
I yield to the ranking member.
Gentlewoman yields to the ranking member.
Mr. Davidson, do you have the support of any of the members on your side of the aisle?
Well, I believe most of the members on my side of the aisle support it. I haven't spoken to every single one of them. They know I've worked on it for a long time. And I do believe I have support from one or more members on your side of the aisle, but I'd love to have this be adopted by unanimous consent.
Well, there's still a lot of discussion to be done. How do these coins interact with commodity futures?
Well, they would be different because they're not, they're regulated as stable coins. So a company that was offering this as a regulated stable coin doesn't accidentally go to a regulator and say, hey, I want to offer a stable coin backed by gold. But you could envision a future where, just like we may have tokenized securities, we will have tokenized commodities, and you could pick any commodity on the exchange, corn, wheat, soybeans, cotton, and there will probably be tokenized commodities, and the Chicago Board of Trade would regulate that. Presumably CFTC would provide oversight of tokenized commodities. This does not trip the Commodities Exchange Act, and in fact includes a provision at the end to say that nothing in this amendment limits the Commodity Futures Trading Commission. And when do they normally get tripped on something that involves physical custody is market manipulation, and that doesn't affect the stablecoin nature of it. Somebody obviously has to buy the gold to be able to put it in the vaults for it to be audited. Whoever's buying that gold could engage in market manipulation. In that case, CFTC would engage with that and enforce the law there. But the stablecoin issuer stores it in a vault and seeks to be regulated as a stablecoin issuer. So it's very clear that it's distinct from a tokenized commodity.
Well, let me just maybe wrap this up with, I understand that you have been interacting with the regulators. What do they think about these coins?
Well, they've had, it's not entirely hypothetical. It's been in existence in the New York DFS as a trust company since 2019. So it's proven, it's been truly stable. You've never audited this and found that, well, they don't actually have the gold. They actually conduct the audits, and New York isn't known for its light touch regulatory approach. So in that sense, as I've talked with folks from state-based regulatory frameworks, they certainly don't want to blow up something that already exists. And if we are providing a state pathway, we wouldn't want to limit what states have said is safe for their consumers. And like I say, historically, gold has been viewed as a safe haven. So in that sense, it's the most stable of the stable coin ideas.
So Tether is backed by gold. Does this exempt Tether?
I think Tether might have a gold product, but Tether isn't regulated in the United States. And by the bill, if Tether, whether they're fiat-backed stablecoin, Tether, US dollar Tether, or their gold-backed stablecoin were to want to be offered inside the United States, they would have to comply with the US regulatory framework. And if they decide to be regulated somewhere that the United States ultimately deems as an equivalent regulatory framework, well, then the Secretary of Treasury could deem them that way. But it would be the same in the sense that unless you come into compliance with the U.S. law, then it wouldn't be able to be offered to U.S. citizens.
Well, that's what I was wondering, if you could, explain how other countries regulate these coins. That's what I kind of wanted to understand.
Yeah, I mean, similar to New York DFS is my understanding. They basically audit it, and you either have physical custody or you don't. So in that sense, like I say, it's the only real way you can mess up a gold-backed stablecoin is to say you have this many ounces of gold and you don't. And there's no, because it doesn't, if the gold price went up or down, your claim is to the ounces of gold, not to the dollar value of the gold.
Well, thank you so very much for taking the time to answer some of these questions. I wish I'd had more opportunity to talk with you about this. I think that you've put a lot of time in on this issue and other issues relative to crypto. And I respect that you have not only become very expert at this entire subject of crypto and stablecoins in particular. And so I wish that we'd had more time to deal with it.
I thank you very much.
You're welcome.
Gentleman kneels back. Who seeks recognition? If there's no more, I'll recognize myself for 5 minutes. So I want to thank Representative Davidson for his continued work over several years to commit that commodity-backed stablecoins have the ability to operate and continue to do so in the United States. As he noted, the New York BIT license has permitted this since 2019, and this issue has been of importance to particularly our representatives on the committee from the state of New York. Mr. Davidson, if you could answer some questions. It's my understanding that this language is not fully vetted and signed off on in your proposed amendment from the House Ag Committee. Is that your understanding too?
Yeah, we engaged in a long-term dialogue. We provided the disclaimer saying nothing limits your jurisdiction. I think the chairman's at a point where he's willing to get there, but there are some staff concerns that they want to be certain that just as the ranking member mentioned, that the settlement in a payment stablecoin or a settlement token isn't confused as a tokenized commodity, right, which would clearly be in the Ag Committee's jurisdiction here in Congress. And, I think that we've satisfied that. I think that some of the Ag Committee members think that it's satisfied, but I do think the staff still has some lingering concerns.
Yeah, that's my concern, and I know we've had Democratic engagement on this side of the aisle to work with you on language too in this area. Is that also your understanding?
Yeah, my understanding is that one or more Democrats is prepared to support the amendment.
But, the ranking member says, hey, maybe we'd benefit from more education there.
Yeah.
So for anybody that's like first hearing about a commodity-backed stablecoin, I appreciate it because, even Mr. Himes, who's, pretty proficient on fiat-backed stablecoins, didn't understand that it wasn't pegged to the dollar. It was really a token that was matching the ounces of gold.
That's helpful to me. I would, because of this, trying to get this language right with the Agriculture Committee, I'd ask you if you'd consider withdrawing the amendment and working with me to get it to the right way with the committee of jurisdiction. And I also want, it's clear to me there's significant engagement here on the Democratic side from the ranking members' questions. Is that something you'd consider?
Chairman, especially based on the dialogue I've had with you, with Ag, and now with the ranking member, and frankly a number of colleagues on the other side of the aisle, I'd love to see it make the final passage and adopt it into the framework. I'd be happy to, by unanimous consent, withdraw this amendment.
The gentleman withdraws the amendment. We are committed to working on this. It's an important issue. It's an important component of this, and I think the Ag Committee's concerns are legitimate but easily explained, and I want to thank the member, as the ranking member did, for his passion and support. Is there additional amendment to Mr. Stiles' amendment in the nature of a substitute?
Chairman, I have another amendment at the desk.
Mr. Davidson? We'll pause while the amendment's distributed.
That's the one.
Sorry. All right, the clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 2392, offered by Mr. Davidson of Ohio, designated as 43.
The amendment, without objection, will be considered as read, and I now ask the gentleman from Ohio to spend 5 minutes describing his amendment.
I thank the chairman. This amendment protects self-custody. It's modeled after my bill, the Keep Your Coins Act, which has massive support throughout the DeFi and crypto community. My amendment explicitly protects self-custody of an individual's assets and their right to engage in self-directed transactions. Section 1 of President Trump's executive order, signed on January 23rd, states in Section 1, subparagraph 1, it says, it is therefore the policy of the administration to support the responsible growth and use of digital assets, including by protecting and promoting the ability to transact with other persons without unlawful censorship and to maintain self-custody of digital assets. Mr. Chairman, the right to transact is not granted to us by any government. Throughout human history, individuals willfully traded, bartered, and transacted with each other, not because they were granted permission by anyone else. So why should a different standard apply to any other currency? I believe that the underlying bill must explicitly protect property rights and the right to transact. Further, self-custody embodies the core principles and the core promise of decentralized finance, or DeFi, empowering individuals with direct control over their own assets, free from intermediaries who can freeze, seize, or otherwise censor them. An account-based system, by contrast, which is the concern here, that will only wind up with an account-based system without this protection, limits the future. Without the adoption of this amendment, I fear that we'll have a repeat of what's gone on where, account-based gatekeepers, banks, exchanges, bureaucrats, regulators can unilaterally dictate access. Those who oppose self-custody are saying they don't really trust you with your own money, but they want custody to be limited to a third party who can effectively be controlled by them. Moreover, there's a very real recent history of overregulation and the consequences that show my concern isn't hypothetical, it's already been happening. In January, the Consumer Financial Protection Bureau rushed a rule trying to limit self-custody and claim jurisdiction for their agency. Or take the FinCEN guidance in 2020 where unhosted wallet rule was proposed and halted only after 65,000 comments slammed it for threatening privacy and innovation with burdensome requirements. Then, of course, there's Operation Choke Point and Elizabeth Warren's foolish anti-crypto army, which was soundly rejected in the last election. These aren't hypotheticals. They're documented assaults on crypto's potential, proving that self-custody is a necessary shield against a rigged system. I encourage the adoption of my amendment, protecting law-abiding individuals and their ability to have self-directed transactions. That I ask adoption of this amendment, and I yield back.
Gentleman yields back. Chairman, I'm going to recognize myself for opening comments on this particular matter, and then I'll turn to my friend, the ranking member. Really, and Mr. Davidson knows this professionally and personally, I really appreciate his consistent leadership on digital assets issues over, I guess the whole time we've served in Congress together. And as the ranking member said, he is clearly a crypto policy member who's done his homework and worked hard on this issue long before we had a president that was supportive of stablecoin bills and market structure legislation. And self-custody is an important part of our agenda in this Congress, and it's certainly something that's recognized as Mr. Davidson noted. It's noted explicitly in the President's executive order, and I know it's something that's being looked at by the regulatory agencies. I was proud to work on language that Mr. Davidson helped author in the last Congress when we did our market structure bill, FIT 21, that protected America's ability to self-custody. The ANS of Mr. Stile today absolutely ensures that self-hosted wallet providers are not considered custodians. It's specifically carved out of this bill, and in that regard, this draft is superior to the work in the 118th Congress and that of the Senate bill. So I would argue that we've made progress. We had self-custody outlined in the market structure bill that passed the House with 71 Democratic votes in the last Congress. And Mr. Stiles' amendment in the nature of a substitute that we are considering today and amending today has clearly enshrined in the document that self-hosted wallet providers are not considered custodians. So self-custody will be, in my view, a better fit in our market structure bill that the House will start considering next week when Mr. Stile holds his first hearing on it. And we're currently drafting it. So I look forward to working with my colleague to incorporate self-custody language in our FIT 21 2.0 bill in working with Chairman Stile as the subcommittee begins to address that concept next week with a hearing and then taking in views from both Democrats and Republicans over the month of April. But I do believe that it best fits in market structure, and therefore, and with the progress we made, and I appreciate his help, but I'm going to oppose this amendment. Gentlewoman, ranking member is recognized to strike the last word.
Mr. Davidson, I understand that this amendment is definitely intended to protect privacy. Is that right?
It is intended to protect privacy, but frankly, if everything stays account-based, a lot of the unbanked and underbanked people will still not be served. It truly is meant to be similar to cash, and that's exactly why it's important that it's in the stablecoin bill because that is a means of payment. In the market structure bill, that bill deals with securities or commodities or utility tokens. Those things aren't used as payment instruments, and the unbanked and underbanked in a digital age will use these kinds of self-custody the same way people use cash today. I think that's why we have to protect self-custody.
I think when I had an opportunity to raise some questions with you, I asked about regulators. And I'd like to hear you talk about what you have found out from the regulators. What has the interaction been on this issue?
Well, thank you for the question. The concern has been that some regulators have tried, in the name of protecting consumers, said, we don't want you to have access to that. They feel comfortable with an account-based future, that a lot of people have drawn to the crypto industry because they don't like the account-based present. They want to be able to direct their own payments in a digital age the same way they do with cash. There's a reason they're not always participating in the current financial system. And if all we do is create a digital replica of the current financial system, frankly, the space isn't even that interesting. It doesn't change things for the individual. If people can use self-custody as a means of payment, small businesses could settle directly with that consumer and not have an intermediary charging them fees like Visa and MasterCard do. So your interchange fees and your payments, and that's why the industry that has the status quo has spent so much effort lobbying for years to kill this very provision. They want to kill the industry, and if they can't completely kill it, they want to keep it account-based because they want to make the money that they're making by being intermediaries today. You don't disrupt that if you keep it account-based. You only disrupt that if you let people direct their own payments.
So how's this issue dealt with other nations?
Well, in other nations, it's protected, and I mean, that's why when you look at Tether, Tether's 90% of the transaction volume in stablecoins today. Part of the reason we're trying to create a federal regulatory framework for stablecoins is so that we have a U.S.-based regulatory framework that counters what Tether's doing. It's great that Tether's U.S. dollar token, U.S. dollar Tether, is backed by U.S. treasuries. That's real progress. There was a time I referred to Tether as a time bomb because they weren't disclosing what they were backing their token by. Now they're backing it by U.S. treasuries, but they're not backing it by a U.S. regulatory regime. Part of the reason we're trying to do this federal regulatory regime is so that we do have a trusted U.S. dollar settlement instrument. And my point is a lot of people want to interact with that in a way where they control their money, not some account that they're sitting there working with the same way that they're rejecting banks today. They're rejecting that account-based future in the crypto world. That's where self-custody is. And the reality is that's never going to be the majority of the market. The majority of people want their money kept safe by some other custodian at a bank account or something similar to that. But they will want to control some of it. And this is exactly what this amendment does.
So let me just put the question to you. Are you asking for support?
Yes, ma'am.
You would like support?
I would love unanimous support. I understand the chairman isn't yet ready to provide it, but candidly, part of the reason he isn't is he fears that he will lose support from Democrats.
Thank you very much. I yield back.
Gentleman yields back. Others seek recognition. Mr. Liccardo from California, recognized to strike the last word.
Thank you. I'm going to strike last word. Thank you for the amendment, Mr. Davidson. And I know you're very thoughtful, and I appreciate your passion for self-hosted wallets and the ability they give individuals to engage in this very important industry in a way that is on their own terms. My concern is the breadth of the language as we look at the terms may not issue any rule or order that would impair. And I know how courts are going to interpret something that broad. And I think that's really broad, particularly in a post-Chevron world. And I think no matter how imperative the need for regulation might be for something we might all agree about, for example, around cybersecurity, for example, or national security, or systemic financial soundness, or fraud prevention, or even just someone invents a mechanism to help somebody who's got a self-hosted wallet and they've lost their key and they can somehow get their key back. We've all heard about those disaster stories. I appreciate that there are limits here that only apply to lawful uses. But my concern is, first, because they're self-hosted wallets, there's no means for a regulator to detect what is a lawful use. But even if we assume every use is lawful, of course it's not going to be, but let's say it is, there are lots of lawful purposes that may still create a lot of systemic risk, and we may still really need some regulation. So I'm just concerned about signing on to something this broad, and I appreciate.
Would the gentleman yield?
Certainly, yes.
I think the impaired language is important because, frankly, when I was first introducing the Keep Your Coins Act, which is a standalone bill, the Canadian truckers were being blocked from accessing their bank accounts in Canada because they were protesting COVID. Now, Canada doesn't have the same Bill of Rights that we have in America, but we did see people filtered and censored and, frankly, surveilled in ways. And that's exactly why the word is used, is to say, look, you can't basically come up with your own way to impair it. But you can go after illegal things. So if the United States had passed a law that says you can't do this, well, then, of course, it can be shut down. And wallet providers can already shut down addresses. So no transactions, that's how they comply with sanctions, for example.
Might retain my time. I appreciate the point. However, as I mentioned, I'm very concerned that ostensibly lawful uses can still pose systemic risk.
I understand your
concern. For that reason, I won't support it. Thank you.
The gentleman yields back. The gentleman yields back. Who seeks recognition? The chairman of the committee, Mr. Stiles, recognized to strike the last word.
Thank you very much, Mr. Chairman. Just want to echo my comments. I align myself with your comments, Chairman Hill, but want to reiterate in the full room my commitment to work with my friend and colleague, Mr. Davidson, on this in particular as we enter the robust conversation that I know is in front of us in the market structure bill. I think there's some real opportunities to make sure that we get this language right. I think self-custody, there's an absolutely important role that it plays, and I'm committed to continuing working with you, although I won't be supporting this amendment here tonight.
Would the gentleman yield?
I yield to the chair.
Yeah, let me just add one other point that my friend from Ohio certainly knows, which is he's recognized the improvement we made in your draft, Mr. Chairman, about an important component that is a change, which was that self-hosted wallet providers are not custodians. And I just would offer to both of you that if you have additional language changes within the context of what we're talking about today that's, more narrow, but at the same time moving in the right direction that you heard from Mr. Liccardo and others, we're open to hearing that as well. So I yield back to the gentleman from Wisconsin.
And I'll yield back to the chair.
Gentleman yields back. Who else seeks recognition on Mr. Davidson's amendment on self-custody? If there's no further debate, the question now occurs on the amendment offered by the gentleman from Ohio. All those in favor, please say aye. Those opposed, say nay. Nay. In the opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted.
I ask for a recorded vote, please.
Gentleman from Ohio requests a recorded vote. All those in favor of a recorded vote, raise your hands. A sufficient number have raised their hands. A recorded vote is so ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, further proceedings on that amendment are postponed. Is there another amendment to Mr. Stiles' amendment in the nature of a substitute? Seeing no further amendments, without objection, the previous question on the substitute is ordered and recorded votes on the pending amendments have been postponed. Once those amendments are taken, the committee will immediately vote on the adoption of the amendment in the nature of a substitute, and then we'll, then we'll consider the question to report the measure. We'll now move to consider our next bill. Pursuant to notice, I call up H.R. 2384, the Financial Technology Protection Act, introduced by the gentleman from Iowa, Mr. Nunn. The clerk will report the bill, copies of which were distributed in advance.
H.R. 2384, to establish an independent financial technology working group to combat terrorism and illicit finance and for other purposes.
Without objection, the bill is considered read and open to amendment at any time. For what purposes, the gentleman from Iowa seek recognition?
Thank you, Mr. Chairman. I have an amendment in the nature of a substitute at the desk.
The gentleman has an amendment in the nature of a substitute, copies of which were also distributed in advance. The clerk will report the amendment.
An amendment in the nature of a substitute to H.R. 2384, offered by Mr. Nunn of Iowa.
Without objection, the amendment in the nature of a substitute is considered read and will serve as the base text for purposes of amendment. The gentleman is now recognized for 5 minutes on his amendment.
Well, thank you, Mr. Chairman. And given the nature of the fact that we are talking about the future of America's not only stable coin, but the role that digital assets will play, and given the nature of the night, we will be expeditious in this run-through. First of all, I want to thank everyone who has been a partner in moving Financial Technology Protection Act of 2025, H.R. 2384, forward. It's a privilege to lead it, but I know this is done with a lot of work on both sides of the aisle. Let's be clear. Blockchain technology and digital assets are here to stay. The U.S. can be a leader in this. We therefore must create an environment where our innovators can both thrive here domestically in the United States without being exploited by our adversaries abroad. The transparent and traceable nature of blockchain enhances our law enforcement's ability to combat both cyber crimes as well as recover funds that may be stolen from those in our community and those that might actually fuel, through illicit means, our enemies. These capabilities have already led to massive forfeitures, seizures of illicit funds, and high-profile prosecutions. In fact, Mr. Chair, just last week, the U.S. Department of Justice used blockchain technology to disrupt money intended for Hamas, an Iranian-backed terrorist organization, to the tune of $200,000. What more, in recent months, the U.S., using blockchain, participated in an international effort to dismantle a Russian money laundering network, resulting in over $22 million seized, certainly money that would have been used against U.S. national interests. Unfortunately, as someone who serves as a counterintelligence officer, I've seen firsthand how many times terrorists and adversaries have exploited technology for the purpose of illicit money laundering. And that's why today we introduce the Financial Technology Protection Act. So what does this do? First of all, it is the result of bipartisan effort to establish working groups of key federal agencies, intelligence experts, private organizations, private sector leaders, academics, and others who can work to combat terrorism and illicit financing on a digital platform using the best possible technologies and practice procedures in place to drive this to the cutting edge. Together, these professionals will help develop legislation and offer a regulatory proposal to strengthen anti-money laundering efforts and address security risks to prevent illicit financing activities in the United States. Now, these efforts are essential in protecting not only our financial system, but also in holding those bad actors who are also competing in this space, whether they be in Moscow, Beijing, Pyongyang, or Tehran. Passing this bill is vital to enhancing America's national security, protecting our digital assets, and ensuring that the next generation of financial technologies is developed here domestically in the United States and with our common allies. This is a common sense piece of legislation. And last year, I was very happy that it passed this chamber unanimously. Now is the opportunity to seize on this momentum. I want to thank the groups that provided us with the technical assistance and the expertise to really drive this working group as a key best practice. Those include the Blockchain Association, the Digital Chamber, the Crypto Council for Innovation, and many others. I also appreciate the invaluable technical support from the U.S. Department of Treasury. Finally, and it is with great gratitude to my colleagues here that I extend my appreciation to my co-lead on this bill, the ranking member of the intelligence community and a longtime friend, Representative Jim Himes. I'm proud to lead this important legislation, and I urge my colleagues to support its final passage as this complements what we're aiming to do through the evolution of stablecoins here in the United States and the promotion of digital asset innovation right here in America. With that, Mr. Chair, I yield my time.
Thank the gentleman for his work. Gentleman yields back. Who seeks recognition? Mr. Stile.
Mr. Chair, I move to strike the last word.
Gentleman's recognized.
Thank the chairman. I want to thank Representative Nunn and Representative Hines for their continued leadership in combating illicit finance in financial services. I strongly support the bill and urge my colleagues to vote in favor of it. It's timely and it's pragmatic. The bill builds on important work that began back in the 115th Congress between then Representative, now Senator Budd, and Representative Lynch. They introduced the first iteration. Since then, the legislation's gained strong bipartisan support because the threat is not theoretical. The threat's real. It's complex. It cuts across political and partisan lines. And today's updated legislation strengthens the original framework by establishing an independent financial technology working group to combat terrorism and illicit financing. The working group represents a practical, targeted mechanism. And in particular, from stablecoins and tokenization to decentralized finance and AI-powered payment tools, emerging technologies are reshaping global finance and the illicit finance landscape in real time. The bill is not about micromanaging innovation. It's about giving our national security community knowledge, tools, coordination that they need to ensure the United States doesn't fall behind the bad actors exploiting gaps in our system. The working group will unite experts from across the board, private sector, leaders in blockchain analytics, fintech, cybersecurity, and together the group will collaborate to navigate these transformative technologies and the novel threats they present. The goal of the working group is straightforward: study emerging threats, identify gaps in the current AML CFT framework, and recommend smart, targeted reforms. A report annually to Congress gives us clarity and ability to move forward in that doesn't grant sweeping new authorities or force emerging technologies into outdated regulatory frameworks. Instead, it's recognizing really our greatest asset in combating new threats is far better where information and collaboration are stronger. By building on the foundation laid by previous iterations, this creates a clear, thoughtful, and forward-looking next steps to secure the future of American finance while preserving the innovative spirit that drives it. Appreciate the work of Representative Nunn, Representative Hines. This kind of bipartisan, nonpartisan, really, work that's being done here to combat illicit finance is worthy of our of our support, and I encourage my colleagues to vote in favor of the bill. Mr. Chairman, I'll yield back.
Gentleman yields back. Is there anyone who seeks recognition to speak on the amendment and the nature of a substitute? Ms. Ranking Member.
We're supporting this bill. We're just adding an amendment.
Are you going to call for your amendment? Hey, Maxine.
Well, you want us first speak on the bill. Okay.
She's not going to speak.
Okay.
Okay, hearing none, we will move on to amendments. Does anyone wish to offer an amendment to the substitute? Okay, right here. Hearing none, the question now occurs on adoption of the amendment in the nature of a substitute offered by the gentleman from Iowa, Mr. Nunn. All those in favor shall signify by saying aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment is the nature of a substitute is adopted. So moved. Okay, the question now occurs on ordering the bill H.R. 2384 as amended, reported to the House with favorable recommendation. Those in favor shall signify by saying aye. Those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. A recorded vote is requested, and all those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on the question is postponed. Okay, now it's my bill. I've got my statement sitting there. Okay, we ready? Pursuant to notice, I call up H.R. 976, 1071, repeal to protect small business lending act, introduced by myself, Mr. Williams from Texas. The clerk will report the bill, copies of which were distributed in advance.
H.R. 976, to repeal the small business loan data collection
Without
requirements.
objection, the bill is considered read and open to amendment at any point. I now recognize myself. I want to thank Chairman Hill for including my legislation in today's markup, as well as all of my colleagues who have co-sponsored this important effort. This critical legislation will put a stop to the excessive and unnecessary collection of personal information from small business loan applicants, safeguarding entrepreneurs from intrusive reporting mandates. The CFPB's rule represents yet another overreach that harms Main Street. Rather than helping small business, it creates new barriers for both current owners and aspiring entrepreneurs trying to secure the capital they need to grow and thrive. Section 1071 mandates that financial institutions collect and report sensitive personal details of small business loan applicants to the CFPB. There is a growing concern that portions of this data, potentially including information that could reveal the identity of individual applicants, could be made public. These details belong in the hands of lenders and borrowers, not published for broad access. Moreover, the implementation of Section 1071 threatens to erode the foundation of relationship banking by pushing lenders towards a one-size-fits-all standardized loan process. To meet the rules requirements, banks and credit unions will be forced to gather extensive data, such as race, ethnicity, and sex. Factors have no bearing on credit worthiness. These burdensome mandates would divert time and resources away from serving customers, increasing compliance costs, and ultimately make loans more expensive and less accessible. We must not allow privacy and common sense to become afterthoughts in the small business lending process. As chairman of the House of Small Business Committee, I'm proud to sponsor 1071 repeal to protect Small Business Lending Act to remove these burdensome requirements. I urge all of my colleagues to support H.R. 976, and I yield back the balance of my time.
Seek resolution.
I have an amendment in the nature of a substitute, copies of which have been distributed in advance. Clerk will report the amendment.
An amendment in the nature of a substitute to H.R. 976, offered by Mr. Williams of
Without
Texas.
objection, the amendment in the nature of a substitute is considered read and will serve as base text for the purpose of amendment. Is there anyone who seeks recognition to speak on the amendment in the nature of a substitute? Gentlelady from Texas.
I move to strike the last word.
You're going to yield to the...
This bill that seeks to repeal the Consumer Financial Protection Bureau's long overdue small business lending data rule is yet another attempt by Republicans to thwart necessary progress towards a more equitable and inclusive lending environment. CFPB's small business lending rule requires lenders, including banks, credit unions, and other non-bank lenders, to collect and report certain data on small business loan applications. This critical CFPB rule was required by Section 1071 of the Dodd-Frank Act, and I was pleased to work closely with Ranking Member Velasquez to ensure that section was included. We've seen how helpful the Home Mortgage Disclosure Act, or HMDA, has been in providing transparency to the mortgage market, helping regulators to identify discriminatory practices like modern-day redlining. So we drafted Section 1071 to provide similar transparency to the small business lending market. In the early days of the pandemic, we saw how the biggest banks prioritized their concierge clients in the first round of the Paycheck Protection Act, that is the PPP, leaving millions of small business, especially those owned by women and people of color, out of the program. So I worked hard with Ranking Member Velasquez and former Treasury Secretary Mnuchin to secure a $60 billion set-aside for community financial institutions, including MDIs and CDFIs, to ensure PPP loans reach these underserved businesses. Many more were helped, but recent research found that Black-owned small businesses were 9% less likely to receive a PPP loan compared to white-owned firms. Make no mistake, if we had this CFPB small business data rule in place before the pandemic, we would have had much more data on who was receiving support and who wasn't. And Congress should have taken additional measures to ensure underserved small businesses got the support they need. CFPB's rule is an important step towards transparency and fairness in small business lending. I appreciate that the CFPB is phasing this rule in, giving community banks and credit unions adequate time to prepare to comply with the rule. But the arguments that this rule will stop small business lending is a red herring. Again, financial institutions have complied with HMDA for decades, and yet they continue to make mortgage loans. Greater transparency will promote diversity and ensure that all businesses have a fair chance to thrive. Republicans are fighting to repeal this rule, not because it burdens small lenders, but because the largest financial institutions don't want to collect this data. And let's be clear about why they don't want accountability. It's because they want to continue discriminating against Black and brown business owners without consequences. If lenders weren't engaging in discriminatory practices, they wouldn't be afraid of reporting this data. Their resistance to transparency is itself evidence of the problem. If members of this committee truly care about small businesses and want them to have access to credit in a transparent, fair marketplace, then you must oppose this bill. I urge all members to vote no, and I yield back.
Is there anyone else who would like to be recognized?
Mr. Chairman.
Mr. Chairman.
Gentleman from Kentucky.
Move to strike the last word, Mr. Chairman. Mr. Chairman, thank you so much for your leadership on H.R. 976, the 1071 repeal bill. You are a business person. You understand the importance of access to credit. And so there's no one on this committee that understands the damage that 1071 will do to small businesses and entrepreneurs than you do. And so I appreciate your leadership, both on this committee and as chairman of the Small Business Committee. And I urge my colleagues to support Roger Williams' bill, H.R. 976, the 1071 repeal to protect Small Business Lending Act. Small businesses, as everyone hopefully knows here, are the backbone of this country. We all need to work tirelessly to protect their privacy and access to banking services. Unfortunately, 1071 section of the Dodd-Frank Act introduces unnecessary regulatory burdens, compromising the privacy of small business owners and reducing access to affordable credit for small businesses. The federal government should not be mandating burdensome data collection that interferes with the relationship between financial institutions and the small businesses that they serve. Community financial institutions understand the small businesses in their local communities, and they offer them loans that are highly customized to their financial needs. Much more customized, by the way, than mortgages subject to the HMDA law. As was evidenced with the Paycheck Protection Program, financial institutions are more than pulling their weight in the small business lending marketplace, and they do not need more red tape that interferes with this critical work. Furthermore, requiring financial institutions to collect detailed personal data on small business borrowers raises serious privacy concerns that Section 1071 leaves largely to the discretion of the Bureau. And the Bureau, under former Director Chopra, demonstrated in their final rule on 1071 that they will not adequately safeguard this data and ensure it cannot be used to identify small business owners and the loans they are receiving. This is very troubling, given that the Bureau had a massive data breach by one of their own employees. So the CFPB could not protect data that they did have, and then went on to finalize a rule collecting even more data. Concerningly, the final rule implementing 1071 shows that wide data is collected will be abused by partisan administrations to further increase costs for lender. Former Director Chopra circumvented the intent of Congress, who statutorily required 13 data points and mandated the collection of 81 separate data fields. That's why there's a lawsuit, and that's why this law will likely be struck down in the courts, and this regulation will be struck down in the courts. Forcing financial institutions to gather and report this unnecessary data means higher costs, which are ultimately passed on to small businesses. As an American Bankers Association survey of banks said, one-time cost to implement the rule would range from $113,000 to as high as $7.5 million, with ongoing compliance costs potentially as high as $2 million. I want to thank Small Business Committee Chairman Roger Williams from Texas for his important work on this critical issue, and urge my colleagues to support this important legislation. In the time remaining, let me address my friend and colleague, the ranking member, on what she said. And I want the ranking member, to hear this, and I want the ranking member of the Small Business Committee to hear this, because what my friend from California said is just not true. What she said was, it's a red herring, that this is some kind of effort to protect big banks. I want to tell you a story of one of the smallest community banks in my district. About $200 million in assets. Tiny community bank. And their niche, their focus, their expertise is small business lending. That's what they make their bread and butter on. And guess what? They serve minority-owned businesses in my district. They are the source of credit and capital for minority and women-owned businesses, veteran-owned businesses in my district. They are proud of their service of minority-owned businesses in my district. And you know what they told me about this regulation promulgated by former Director Chopra? They said, we're going to exit small business lending. And the minority-owned businesses, the women-owned businesses, the veteran-owned businesses in our district in central Kentucky will no longer have access to the loans that we have provided to them for decades. For decades.
Oh, please.
So if you actually want to protect minority-owned businesses, why are we doing what we thought we were getting rid of, which is race-conscious decision-making, gender-conscious decision-making? We should be evaluating the creditworthiness of business owners based on the content of their character, based on their creditworthiness, not based on their race, not based on their gender, not based on their sexual orientation, based on their merit, based on the fact that they are proud, profitable, minority-owned
Would the
businesses.
gentleman yield?
In a minute, I think
Yes.
you'll have your time.
Mm-hmm.
We should get away from race consciousness in America, and we should repeal 1071 because of its race bias. And we should protect the small community financial institutions like my constituent who supplies credit to those minority-owned businesses based on their character. I yield back.
Mr. Chairman. I move to strike the last word.
Is there anyone else who would like to be recognized?
Yes, Mr. Chairman, I would like to strike the last word.
Recognize the gentlelady from New York.
Thank you, Mr. Chairman. Here we go again. Another Congress and another attempt by my Republican colleagues to tear down Section 1071. Last Congress, Republicans couldn't nullify this rule through a Congressional Review Act. So here they are, attempting to block it through another means, this time through repealing the underlying statute altogether. As a conferee on the Dodd-Frank Act and one of the central architects of this section, I understand better than most that what this section does, and perhaps, more importantly, what it doesn't. Through my time as both chair and ranking member of the House Small Business Committee and a senior member of this committee, I have seen for far too long women and minority-owned small businesses experience obstacles in accessing capital. Indeed, this morning, we held a hearing about access to capital in the Small Business Committee. Right, Mr. Chairman? And what were we hearing from the witnesses there? The problem that they were having accessing capital. I have seen for far too long women and minority-owned small businesses experiencing obstacles in accessing capital. Part of the reason is the lack of data and transparency related to small business lending. The scant data that does exist continues to show that these businesses lacked the same access to external financing when compared to white-owned firms. And during hard economic times, the barriers to accessing capital are even greater. The Paycheck Protection Program highlighted the disparities between white-owned businesses and businesses of color. The Federal Reserve Bank of New York found that PPP loans only reach 20% of eligible firms in states with the highest densities of Black-owned firms. And why do you think that Chairman Minucci, that the Secretary Minucci, set aside $60 billion? Because in the first 2 weeks of rolling out the PPP program, it showed that it went to the rest of the borrowers that have a pre-existing relationship with banks in this country. So in order to correct a wrong, he decided to set aside at our request, and then the numbers change. I dismiss the notion that under former Director Chopra, the CFPB did not conduct outreach or failed to incorporate industry's feedback. The CFPB conducted considerable outreach to small firms, which included convening a SUBRIFA panel in October 2020 to hear suggestions and recommendations from small entity representatives. This was in addition to adhering to the required APA notice and comment process where the Bureau considered thousands of public comments. The arguments in support of this legislation centers on the notion that the rulemaking is excessively burdensome for smaller institutions. However, Director Chopra appeared before this committee and told us that approximately 2,000 banks are exempted from the rules reporting requirements. So I don't know what you're talking about. Just like the data requirements for HOMDA did not negatively impact the mortgage lending industry, this rule will not be detrimental to the small business lending market. On the Small Business Committee, we have heard testimony that this rule will accomplish 3 things. First, this rule will help the market better address both the lack of access to affordable capital and the rise of irresponsible lending by enabling everyone in the financial services arena to see which financing models are successful. Second, it would allow lenders to help tailor their products and services to meet their borrowers' needs. And third, it will spur additional investment in small businesses without having to create another government program. It has been 15 years, and we are still debating the merits of this section. And those 15 years included a lawsuit and a federal court order against the CFPB during the first Trump administration. I urge my colleagues to vote no on this legislation. I yield back.
Gentlelady yields back. Is there anyone else who'd like to be recognized?
Green from.
Mr. Chairman,
Gentlelady from Texas is recognized.
Mr. Chairman, I move to strike the last word.
You can proceed.
Thank you, Mr. Chairman. I want to start by reminding everyone what Section 1071 of the Dodd-Frank Act is really about. It's about access to the American dream, about whether a woman in rural Texas, a Latino entrepreneur in Houston, or a first-generation immigrant in San Antonio can walk into a bank and get a fair shot at a small business loan. That's what Section 1071 was meant to protect. It's about fairness, transparency, and equal opportunity. It's about shining a light on who is being approved and who is being denied and why. Unfortunately, that has made some people uncomfortable, and that's obvious, and some of the remarks haven't been made. Uncomfortable to the point they want to now do away with this rule. So now, instead of focusing our efforts on fixing disparities in lending, we're here today debating whether to repeal the very tool that helps us expose and address these disparities. Repealing 1071 doesn't help small businesses. It helps lenders hide the truth. I represent one of the most diverse districts in the country. I know firsthand how hard it is for many minority and women-owned businesses to get financing. And it's not because they don't have good ideas or a strong work ethic. It's because of barriers built over decades, bias, discrimination, and lack of access. I was born and raised in rural South Texas. I saw small businesses struggle to survive, not because they lacked a ban, but because they simply couldn't get a loan. In many rural towns, there aren't banks and credit unions on every corner like there is in the big cities. Sometimes there's only one bank or none at all. You may have to go to the next town to do your banking. And even in Houston, where I live now, many small businesses during the pandemic couldn't even get a PPP loan. We had to go in and do a carve-out to force the banks to provide loans to small businesses. That's why Section 1071 matters. It gives us the data we need to determine who's being left behind and to take action. A transparent market will be a competitive market. With transparency in lending, banks are driven to compete and offer better terms. We need to stop pretending that the status quo is neutral. Frankly, it's not. The data shows that minority-owned businesses were less likely to receive loans during the pandemic. This has already been talked about. And that's not just a talking point that we're using, it's a fact proven by the data. Repealing 1071 is just another attempt to keep us in the dark. As I've said before, discrimination flourishes in the darkness. Transparency is what makes a market fair, competitive, and accountable. Let's call it what this is, a backdoor attempt to undermine the Consumer Financial Protection Bureau and roll back protections for our most vulnerable entrepreneurs and communities. I urge my colleagues, please, don't turn out the lights. Don't vote for secrecy. Don't abandon the small businesses who depend on us to stand up for fairness. I urge my colleagues to vote against this resolution. With that, Mr. Chairman, I yield my remaining time to my colleague, Ms. Velasquez, the chair of the ranking member of small business, if she needs the time.
Thank you for yielding. Mr. Chairman, sunlight is the best disinfectant. And if we want to understand why so many areas, including rural communities, are underserved, we must collect data to further understand the problem. It is incorrect and disingenuous to say that the final rule has 81 data fields that an applicant needs to complete. You are misconstruing multiple selections or answers to a single question. An applicant can have multiple answers to a question, but it's still only one data point. You cannot count multiple answers as multiple data sets. I yield back.
Thank you, and again, I urge all my colleagues to vote against this amendment. It is about fairness, it is about opportunity, and it's about the American dream for all. Thank you. With that, I yield back, Mr. Chairman.
Gentlelady yields back. Is there anyone else who'd like to be recognized?
Thank you, Mr. Chairman, and thank you for working on H.R. 976. This is really important to me. I've spent so much of my life working in community banking, I mean decades. Starting out in investing in a bank in the deep Mississippi Delta. Towns like Wilmot, Arkansas, population maybe 400, 70% African American. Eudora, Arkansas, maybe 1,400 people, 90% African American. For years, I worked in those communities. I know how people in business and households manage their money, worked every day to put food on the table, how they used banking services. And I know from personal experience the problems in trying to implement 1071. You know, it wasn't a cakewalk. Our great ranking member of the Small Business Committee in her advocacy for this bill said it right. It's been 15 years. It's because Mr. Obama didn't put this rule out. Mr. Richard Cordray didn't put this rule out. President Trump and his directors in those 4 years, he didn't put that rule out. It took a lawsuit against the CFPB from the left to get Rohit Chopra to take on this rule because it's complicated and it's really tough and it has negative connotations on people trying to borrow money, like my friend Mr. Barr outlined from personal experience in his district. 1071 was amended to require depository and non-depository institutions to report data. And the data points are all-encompassing. 81, it's true. Sorry to say it's 81 data points. And when you compare it to the Home Mortgage Disclosure Act, which is used as its model on 1 to 4 family home loans, that's only about 40 data points. But it's absolutely one of the most expensive rules small banks try to compete with. But what's the difference, Mr. Chairman? There's a big difference. A home mortgage is a homogeneous product. Because of the federal secondary mortgage market, it's a cookie-cutter product. The underwriting points are well known. A small business loan is exactly the opposite. Every small business loan is different. Is it secured by commercial real estate? Is it secured by furniture and fixtures? Is it secured by equipment? They're all different, whether it's an ag small business loan, starting a new pizza restaurant, starting a home-based business, they're all different. And therefore, they're subject to a lot of different credit characteristics. But it's not based on race or gender. It's based on complexity of trying to do the underwriting in small business. It's very challenging. And it's very different from the Home Mortgage Disclosure Act on a very cookie-cutter thing called making a mortgage secured by a home. And if I traveled over the last 3 months, it's the single biggest concern of our community banks is 1071. I know Chairman Barr agrees. I know members have traveled and heard the same thing because they believe it will drive them out of the small business lending business. It will be too costly, too complicated. Borrowers will be turned off by it. And I know the loyal opposition will say, well, this is just voluntary. You don't, the rule says you don't have to report it, but the rule also says if you don't report it and we find there's a pattern of your bank never reporting data because you say all the small businesses decline, they're going to presume they were coerced, making that relationship between the bank and the borrower even more difficult. So I really commend Chairman of the Small Business Committee, Roger Williams, for saying we should not implement this rule. And I've urged the Trump administration, we should not implement this rule. It needs to be modified. Community banks will be driven out of the small business lending business. You'll have borrowers who will actually say it's not a small business loan, it's a real estate loan, to avoid this disclosure. And finally, who will be the beneficiaries? Less regulated online small business lenders, and you'll take the last profitable community-based business away from the community banks. Community banks need every loan they can get to serve their community. And so I'm supportive of Mr. Williams. I oppose this rule, and I yield back the balance of my time.
Chairman yields back. Is there anyone else who'd like to be recognized?
Green from Texas.
Recognize Congressman Green from Texas.
Thank you, Mr. Chairman. I appreciate those who have spent their lives working with people of color. I've spent my life being a person of color. I know what invidious discrimination looks like. I know what it feels like. I know what it smells like. Example, I and several of my colleagues, upon graduating from law school, decided that we would open up a business as lawyers. We went to a bank and we received a loan. We paid it back timely, never missed a payment, and decided that we would get a second loan. The loan officer looked at our documentation, knew that we paid back timely, never missed a payment, and the loan officer denied us the second loan. We made a plea. Why? The loan officer said, because you shouldn't have had the first loan. I know what invidious discrimination is like. Thank you for working with people of color. I've lived my life as a person of color. There is no one so blind as he who won't see, not he who can't see. You choose not to see the invidious discrimination that exists in this society. It is not a meritocracy. It is a society where skin color makes a difference. I've lived my life in this skin. You see a different world, and you choose not to see the invidious discrimination. And not only do you choose not to see it, you choose not to allow the necessary empirical evidence that can present it to you in great clarity. You choose not to see that. You would do everything that you can to avoid having the empirical evidence presented. I dare you, dear brother Mr. Barr, if you're serious about what you said, I dare you, let us do some testing. Testing reveals the facts. Testing shows that persons of color who are eminently qualified will get loans and pay more points, get less money, eminently qualified than a white person. Mr. Barr, I dare you to challenge me, and let's do this. Let's do the testing. I also dare you to look at H.R. 166, the Fair Lending for All bill that passed this House under the leadership of the Honorable Maxine Waters. That bill makes it a penalty to defraud a customer who is acquiring a loan. Currently, if you defraud the bank, there's a $1 million penalty that you can pay, and you can go to prison. But if the bank defrauds the customer because of invidious discrimination, then you have a lawsuit. Mr. Barr, you and I are friends. Nothing that I said was intended to degrade or demean you. It was intended to help you to see a world that you've never lived in, that you cannot understand because you've never been there. And for you, it's a meritocracy. But it's not for us. I'm empirical evidence. It is not. So I beg you, let's do the testing. By the way, the president has issued an executive order that would embrace what you're talking about. The president is a person who seems to think that if there's a problem, diversity, equity, and inclusion is at the root of it. Airplane crashes, well, without getting any empirical evidence, the president concludes, oh, that's DEI. What an insane thing to say. This kind of fatuous folly ought not be tolerated by you, dear brother. You're an intellectual. Open your eyes. There is no one so blind as he who won't see, not he who can't see because he doesn't have the vision to read or write, but he who, for whatever reasons, declines to see the empirical evidence. I'm going to yield my last 30 seconds to you until I claim back my time.
I thank my friend, and you know what, we all have different experiences, and I appreciate that. I appreciate that. You absolutely have had a different experience, and I appreciate that, your different perspective. And we are friends, and we learn from each other. Would the gentleman be willing to talk to the small bank in my district who is the creditor of many minority-owned businesses, who told me that if this regulation goes into effect, they're going to exit the business. And they're never going to make another loan. to
Reclaiming my
any
last
business,
10 seconds.
Any business, whether they're minority owned or not.
Reclaiming.
Would the gentleman yield?
I would ask my friend, I would ask my good friend, would you be willing to hear?
The gentleman's
my-
time has expired.
I believe the time belongs to me, and I tried to reclaim it, and you didn't acknowledge me. So I expect more time. I expect more time.
The gentleman's time expired.
The gentleman's time did not expire because the gentleman tried to reclaim his time, and you would not recognize me. I expect more time.
The gentleman has 30 seconds.
I thank the chairman. Dear brother, and I say this because I have a deep abiding affinity for your humanity. Dear brother, I have bankers in my district. They are small banks because they are minority banks. And they don't tell me what you're telling me. So what I'm saying to you is this: let's do the testing and get the empirical evidence. Let's send people into a bank, well-qualified black people, and let's send white people in who are less qualified. I'm using white and black because that's what this is, black and white. Let's do that, and let's see what the empirical evidence shows.
Would the gentleman yield?
The gentleman has only 10 seconds
Well,
left.
just really quickly, I would urge the gentleman to listen to different perspectives as he's urged me to. And one of the different perspectives is that
And the
small
gentleman's
community
time has
banks
expired again.
will leave the business of lending to small businesses,
The
including
gentleman's
minority-owned
time
businesses.
has expired. I invite the gentleman
The
to
gentleman
carry
seeks
this
someone to yield
conversation.
time to him.
Who seeks recognition? Hearing none, we'll move on to amendments.
Mr. Chair, Mr. Chair. Mr. Chair. Yeah,
Dr. Foster,
yeah, I'd like to be recognized.
gentleman's recognized.
First off, I have learned a heck of a lot in the last few minutes just watching the scars that have taken so long to heal.
Could you speak in your mic, please?
Yeah, okay. I'm going to remember forever the last several minutes watching, good people just describe the scars my experience with small banks was a young kid, excellent experience. And we just, they came in, they trusted us when we were not really that solid, and they were great, and that enabled our company to grow. It never really occurred to me that maybe that was because of my race. I don't know. I just, it just was never an issue in my mind. I grew up in a university town in Madison, Wisconsin, and it wasn't an issue. There were lots of non-whites in that town, but they were all like university professors, and so that it was a different situation. So I'd like to yield equal time to both of these two gentlemen to continue that discussion, because we have a lot to learn from each other in this. And so, do you want to start first, Andy, and just say, but try to split the time?
I thank my friend, the gentleman from Illinois, and I appreciate the conversation because it's true. We all have different experiences, and we do need to learn from each other. The point that I'm making is that what I am being told by my constituents, who are small business lenders, is that the burdens associated with the 1071 data collection rule will force them to exit small business lending. Now, these are the very same lenders that are the principal source of credit for minority-owned businesses in the community which I represent. My question to my friend who has a deep understanding of invidious discrimination, and I respect that, and I respect his opinion about that, why would the gentleman want that? Why would he want creditors, lenders, American dream providers of minority-owned businesses to leave the market? To me, that is counterproductive to the goal, which is to defeat discrimination, to defeat invidious discrimination. That's what we want. We want the American dream for every American based on the content of their character.
Okay, all right. Now,
That's what we
all right,
want.
I'd like to reclaim my time and give it to Mr. Green.
Thank you for yielding. Dear sir, it probably has not occurred to you that the banker that you're talking to has engaged in invidious discrimination. And it probably has not occurred to you that that very banker knows that if he produces the empirical evidence, it will expose him as a person who has not engaged in fair lending. This is what happens. And you've cultivated a climate in this country wherein all you have to do is indicate that this is going to cost us too much to handle paperwork when it's costing the persons who are trying to get the loans a lack of a home to build equity in so that they can send children to college. It's costing the persons who can't get the loans to have the money necessary to pay bills that they might consolidate. They are suffering too, but they're suffering because of a lack of finance, and you're talking about paperwork. Well, there may be some paperwork involved, but it's not so much paperwork that it won't help some person to get a loan that probably will be denied. And I challenge you again. All we have to do is do the testing.
Will the gentleman yield?
No, I won't yield just yet. Testing is the methodology by which we get the empirical evidence. You want to end the testing. That's the thing that makes the difference.
So can I?
I'll yield back to Mr. Foster. It's
Reclaim
his
my
time.
time and yield it.
Just real quick. So one of the comments from one of these community banks was the way that Chopra wrote the rule was that the questionnaire has to be presented to the small business applicant first before underwriting starts. Before you get to the objective creditworthiness of the borrower, irrespective of these irrelevant, immutable characteristics of the business owner that we all say we shouldn't care about. They have to fill out what the sexual orientation of the owner, what the race, what the national origin, what the gender is. And then and only then do you get to the merit-based question of whether or not this small business should get the loan. What does it say to the
He has yielded to me.
applicant?
Here's what it
These
says.
issues are
Here's
more
what it
important.
says before the time expires, because nobody else is going to yield to me. Here's what it says. It says that whenever you have the opportunity, at some point you see the skin color. And at that point you make decisions, either consciously or unconsciously, about that person. It happens every day in this country, not only in banking, it happens in institutions across the length and breadth of the country. And if you're too blind to see, simply because you choose not to, eliminating this evidence will help you to remain blind.
Yeah, my
Gentleman's time has expired.
Thank you.
I thank Dr. Foster for yielding the time and allowing our colleagues to have this good discussion. Is there anyone else to be recognized? Hearing none, we'll move to amendments. Does anyone wish to make an amendment to the nature of Mr. Williams' amendment in the nature of a substitute?
Mr. Chairman, I have an amendment at the desk.
The gentleman from New York has an amendment at the desk. We'll pause and let it be distributed. You need another water or something? The clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 976 offered by Ms. Velasquez of New York, designated as 2.
The amendment will be considered as read.
Mr. Chair, could I reserve a point of order?
The gentleman from Michigan reserves a point of order. Thank the gentleman. The gentlewoman from New York is recognized for 5 minutes to discuss her amendment.
Thank you, Mr. Chairman. My amendment is simple. It will delay the underlying legislation from taking effect for 1 year in order for the director of the CFPB to certify to Congress several important steps. One, that the small business lending market has become more transparent. 2, large lenders are providing disclosures on loans to small businesses that are substantially similar disclosures by lenders under TILA. 3, the CFPB has gathered and made publicly available certification that terms associated with small business loan have become more transparent. And 4, that no lenders are including a confessions of judgments as part of their origination terms. We have heard a lot of rhetoric here today about how small businesses lack access to capital, which is true, and how the underlying bill will help facilitate more loans to small businesses. Well, there's also a lot of information demonstrating the lack of proper disclosures and the use of confessions of judgments are reducing the availability of loans to small businesses as well. Research produced by the Federal Reserve has established that the small business disclosures used in today's marketplace often leave business owners unable to make informed comparisons about the price of financing. This has significant consequences for small businesses, as additional research has found that the average monthly payments charge small business owners to be almost double what these small businesses could afford to pay. In fact, one article published by Forbes has compared online small business lending to subprime mortgages that helped fuel the financial crisis. TILA requires transparent disclosures in consumer finance, but does not apply to small businesses. Transparent price disclosure is the foundation of free markets. Without it, market competition on price fails to occur effectively. California and New York have already passed legislation requiring these disclosures because they understand small businesses that are inhibited from making informed choices may overpay for credit, impacting their ability to grow their business and hire more employees. Many of other states are passing similar legislation as well. Additionally, in recent years, small business lenders, including many community banks, that the other side argues are so overburdened by the Section 1071 rule, have required borrowers to sign confessions of judgment just to receive their loan. Because cash flow is so vital to a business survival, many owners feel they have no choice but to sign away their right to save their business and provide for their employees. By signing a confession of judgment, borrowers essentially waive their legal rights regarding any legal dispute that might arise. And if one does arise, the lender can unilaterally declare a default and take actions against the small business owner. Moreover, by utilizing this confession of judgments, these lenders have hijacked our courts by getting rubber-stamped judgment from county clerks without notice or court hearings. Many times, small business borrowers only find out about a judgment against them after the lender begins seizing their bank accounts or other assets. In fact, lenders have used these confessions of judgments to win more than 32,000 judgments against small businesses in state courts. While confession of judgment have been outlawed at the federal level since 1985 under TILA for consumer loans, it has not been extended to commercial loans. By ending confessions of judgment in commercial lending, we can stop some of the abuses that are crippling honest small business owners. So if you care about small businesses and their access to capital, like so many on the other side of the aisle do, then should support transparency, efficient markets, and ending an outdated lending practice that is driving so many small businesses into bankruptcy. I yield back.
The gentlewoman yields back. Who seeks recognition? The gentlewoman from Missouri, the chairman of the Capital Markets Subcommittee, Ms. Wagner, is recognized to strike the last word.
I move to strike the last word, Mr. Chairman. And I thank you for recognizing me, and I thank my colleague for her amendment. But it simply, Mr. Chairman, is not necessary. There are many, many ways to track the transparency of small business lending in our financial system. Banks already report data on loans made to small businesses in their consolidated reports of condition and income, called the call reports, as mandated by the Federal Financial Institutions Examination Council. Specifically, Schedule RC-C, Part 2, requires detailed information on bank loans to small businesses and small farms. Therefore, small businesses and small farm lending data is also collected by federal banking regulators under their Community Reinvestment Act, the CRA regulations. The FDIC also periodically conducts the Small Business Lending Survey, it's SBLS, a nationally representative sample of U.S. banks that offers important insights into their small business lending practices. All 12 Federal Reserve banks also jointly conduct an annual Small Business Credit Survey, the CBCS, that includes information on non-depository lenders. Section 1071 is duplicative of these data requirements and is an unnecessary burden on financial institutions given they already report and collect on lending to small businesses. The fact is, community banks and credit unions are essential pillars for supporting small businesses, not just in central Kentucky, but also in my second congressional district in Franklin County, in Warren County, in St. Charles County, and in St. Louis County. They are important for these small businesses and essential pillars that foster local economic growth. And I think this was especially evident during the pandemic. And since it was brought up, I just want to say that when small community financial institutions, they played a pivotal role, issuing some 60% of all Paycheck Protection Program loans, those PPP loans. And by focusing on relationship-based lending, community financial institutions were able to offer a more personalized, a more responsive approach, and enabling them to process loans more quickly and ensure small businesses received the vital funds that they needed, especially in the early critical stages of the PPP rollout. Section 1071 misses the mark by failing to recognize the highly customized nature of small business lending. This approach risks undermining the very communities that rely on the flexibility and personalized service that community financial institutions offer. I've long been concerned that Section 1071 would divert scarce resources away from core lending activities and customer service, pushing these institutions to focus on unnecessary and burdensome compliance requirements, further restricting their ability to support small businesses effectively. For these reasons, Mr. Chairman, I oppose the amendment, and I urge my colleagues to support the underlying bill of Mr. Williams, our chairman of the Small Business Committee, and I yield back.
The gentlewoman from Missouri yields back. Who seeks recognition? The ranking member of the full committee, Ms. Waters, is recognized to strike the last word.
I move to strike the last word.
You're recognized.
I am so pleased and proud that Ms. Velasquez is here, taking up this issue because of the long years that she have worked with Small Business Administration, and she went over what happened during COVID when the big banks took care of their concierge clients, created their own panels, and we had to go back and work, and we worked with Mnuchin until we got more money to make sure that we were putting it into small and minority banks. Now, Mr. Barr gets all excited when he talks about these kinds of issues, and we're forever trying to educate him and to help him to understand what we go through in order to receive fairness, justice, and equality. You talk about merit, You talk about only receiving loans based on merit. Let me tell you what we know about merit and what we face every day of our lives. We watched unqualified, stupid, ignorant others get opportunities that we cannot have access to. Let me give you an example. This is not having to do right now what we're doing with 1071. Take a look at what's happening with this new administration. I'm looking at Matt Gaetz, the Attorney General of the United States of America, who has all kinds of problems, sex trafficking, alcohol, you name it. And I know a lot of blacks who are more qualified, have better backgrounds in education and everything than a Matt Gaetz. But no, it's not about merit, it's about color. Look at Robert Kennedy. You don't get any crazier than that. His cousin sent us a well-documented memorandum, letter, whatever you want to call it, telling us how crazy he is and how he mixed animals in blenders. And now we've got to deal with this crazy man and the fact that we're entering into maybe a measles epidemic. He doesn't believe in vaccines. Oh, but he got his on merit because he's smart, he's qualified. Give me a break. And then you've got Pete, what is his name? Hedgegath, with the Defense Department. I don't want to talk about it because a lot of people get over their alcohol problems. I don't know about him. Oh, but he got his on merit. And then there's Linda McMahon. All she knows about is those phony wrestling matches that she's in charge of, that she owns. But guess what? She got to be the head of the Department of Education on merit. What the heck does those wrestling matches got to do with our children, Pell Grants, and Title I loans that we need so much? Oh, but they got it on merit. Oh, and then there's Mike Waltz, the National Security Advisor and former White House member. He added a reporter to group chat signal because he's on merit. He's so smart. He got this job because he absolutely understands how government works and classified information. So we're going to give you another lesson about merit. We're going to talk to you again, and I want to tell you, you can't say, oh, maybe they're Republicans. They got black smart Republicans who can't. We got one black in this administration over at HUD. We got plenty smart black Republicans that get these jobs, but they can't get it on merit. But you got all of these stupid, ignorant, undeserving people who are now running the country. Wow, don't talk to us about merit. We go through this every day. Now, I want to ask you this, Mr. Barr. You are extending opportunities to expand banking. You said that we need to have more community banks. Did you include in that minority banks? Did you include in that minority banks? I bet you did.
The gentlewoman's time has expired, and the chair reminds all the members to honor the rules of decorum in the House when describing members of the cabinet.
No.
Yes.
No.
Yes.
No.
Yes.
No. When Mr. Barr keeps up with that kind of conversation about merit, we have to keep teaching him.
The ranking member.
We have to keep teaching him.
Ranking member, I really invite you to ask Mr. Barr out for dinner to do that.
I appreciate you so very much, but you tell Mr. Barr to stop this crap.
I will have a special meeting with him after the session concludes. If there's no further debate, the question now occurs on the amendment offered by the gentlewoman from New York. All those in favor, please say aye.
Aye.
Those opposed, please say nay. Nay.
They want the qualified.
In the opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted. A recorded vote has been requested. All those in favor of please raise your hands. A sufficient number having raised their hands, a recorded vote is so ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceeding on this amendment is postponed. Is there an additional amendment to Mr. Williams' bill? Seeing no further amendments, without objection, the previous question of the substitute is ordered and recorded votes on the pending amendments have been postponed. Once those votes are taken, the committee will immediately vote on the adoption of the amendment in the nature of a substitute, and then we'll consider the question to report the measure. We'll now move to the next consideration of the next bill. Pursuant to notice, I call up H.R. 1919, the CBDC Anti-Surveillance State Act, introduced by the gentleman from Minnesota, the Majority Whip, Mr. Emmer. The clerk will report the bill, copies of which were distributed in advance.
H.R. 1919, to amend the Federal Reserve Act to prohibit the Federal Reserve banks from offering certain products or services directly to an individual, to prohibit the use of central bank digital currency for monetary policy and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. For what purpose does the gentleman from Minnesota seek recognition?
Mr. Chairman, I have an amendment in the nature of a substitute at the desk.
The gentleman, in fact, has an amendment in the nature of a substitute, copies of which were distributed in advance. The clerk will report this amendment.
An amendment in the nature of a substitute to H.R. 1919, offered by Mr. Emmer of Minnesota.
Without objection, the amendment in the nature of substitute is considered read and will serve as base text for the purposes of amendment. The gentleman from Minnesota, the Majority Whip, is now recognized for 5 minutes in support of his amendment.
Thank you, Chairman Hill. Today we are marking up the Anti-CBDC Surveillance State Act, a bill and an issue I am proud to lead on because our government should never be in the business of creating tools for financial surveillance. Unlike decentralized cryptocurrencies such as Bitcoin, a CBDC is a digital form of sovereign currency that is issued, monitored, and managed by a central bank. In short, a CBDC is government-controlled, programmable money that, if designed without privacy protections of cash, could give the federal government unilateral authority to surveil Americans' transactions and restrict politically unpopular activity. We've already seen examples of governments weaponizing their financial system against their citizens. In China, the Communist Party is using a CBDC to track the spending habits of its citizens. Closer to home, in Canada, the Trudeau administration froze the bank accounts of citizens involved in the 2022 trucker protests. The Biden administration was actively researching a CBDC, and they would have gone ahead and created one if it weren't for such resounding opposition in Congress, evidenced by hundreds of members of Congress who have supported this bill. Power-hungry bureaucrats will stop at nothing in their quest to gain control over the very people they're supposed to be working for. President Trump recognizes this, and accordingly, one of his first executive actions in office was to ban the United States federal government from ever creating a CBDC. We must codify this in law. Although the Biden administration was willing to trade Americans' right to financial privacy for a surveillance-style CBDC, the Trump administration and congressional Republicans surely are not. Last Congress, this bill passed out of the House of Representatives by a 216 to 192 vote. So far this Congress, this bill has 114 co-sponsors and support from groups ranging from the Independent Community Bankers Association and the American Bankers Association to Club for Growth, Heritage Action, and the Blockchain Association. The Anti-CBDC Surveillance State Act ensures that the United States digital currency policy is in the hands of the American people, not the administrative state. So, it reflects our American values of privacy, individual sovereignty, and free market competitiveness. I'm grateful to my colleagues for working with me on this issue to ensure our federal government is never in the business of creating such an obvious tool for financial surveillance against its own citizens. And I thank the chairman for including my bill in this markup today. And Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? Ranking member.
Thank you very much, Mr. Chairman. I move to strike the last word. Among the various restrictions established by this legislation, this bill would prohibit the Federal Reserve banks from offering products or services directly to individuals, researching, testing, or issuing a retail central bank digital currency, or CBDC, and prohibiting the Federal Reserve from using a retail CBDC to implement monetary policy. What is most concerning, however, is that this bill includes new language that stipulates that the Fed lacks authority to issue any CBDC, which would harm efforts to test or issue a wholesale CBDC that could only be used by financial firms. For these reasons, I oppose this bill. It is critical that we distinguish between the two different types of CBDCs and their functions. For example, consumers could get retail CBDCs from the Fed or a financial institution, and wholesale CBDCs would not be used by individual consumers and instead would only be used for transactions among financial institutions and the Fed. The Fed must be free to fully explore the potential benefits and challenges of CBDCs, especially wholesale CBDCs, which may allow for new technical capabilities and arrangements in interbank payments, clearing and settlement, including the use of tokenized platforms. In the past 6 years, most central banks throughout the world have started examining the issuance of CBDCs. According to research from the Atlantic Council, there are currently 134 countries exploring a CBDC, with the United States trailing all of its G7 peers in simply researching and developing a CBDC. Now, rather than ensuring the United States wins the digital currency space race against powers like China, Republicans are making baseless attacks against a CBDC that does not even come close to existing. If Republicans really cared about consumer privacy, where is their outrage at the fact that the big tech firms are vacuuming up data about every American, or that unelected billionaires have seized access to consumer data through hostile takeovers of federal agencies? The Fed must continue to study CBDCs, which we can design to balance consumer privacy, national security, and innovation. Now, Mr. Chairman, I just kind of mentioned, Elon Musk and the billionaires and all the data collection that they're involved with. Why, in invading our agencies, the first thing they put their hands on is all of the data in the agency? I believe that the billionaires are intent on monetizing all of this. And I think the day will come when we will rue the time that we had to pay attention, and we did not. And I will yield back the balance of my time unless Mr. Green wants to get at it again. I yield to Mr. Green.
I yield back to you, Madam Chair. Excuse me, that's about 1.5 years away.
The gentleman yields back to the ranking member who yields back.
Yield back.
Who seeks recognition? Mr. Davidson recognizes strike the last word.
I thank the chairman. I thank Mr. Emmer for his bill. Frankly, the future of money is probably the most important policy debate going on in Western civilization. And that's at a time where there are lots of critical policy debates going on. The future of money could either be something that embraces freedom and privacy and opportunity for millions, if not billions of people around the world. But central bank digital currency represents the biggest threat to that. It is a dystopian future for money that corrupts money from a tool used as a means of exchange and a store of value into a tool for surveillance. Surveillance that allows the central government, not an intermediary, but the central government to act not just as the spy and surveiller, but as the intermediary in every transaction. They could filter, cancel, shape everything about it. And some of the proponents of CBDC say that's a feature. They could issue you money that expires or has terms and conditions, and they could stimulate or incentivize the economy in all sorts of ways. And the scary thing is, Western governments around the world are embracing this idea. Andy Barr, Chairman Barr, led a Codel to Europe last year, and we saw that the Bank of England was working on a central bank digital currency that they acknowledge isn't popular with the public. Nevertheless, they're working on it. The European Central Bank, maybe the biggest champion of this idea, is Christine Lagarde, their central banker. And they also acknowledge, not popular within Europe, nevertheless, they're working on it. They're building out architecture. The Bank of International Settlement in Basel, Switzerland, is acting as the central banker to the central banks. And they're trying to set up a framework that is interoperable with China. China is using it already and imposing it on a dystopian system of control that links it to social credit. And that's why you see many of the proponents of central bank digital currency saying that the way that you access this is with a digital ID. And they say it's just to keep you safe. But our founding fathers recognized the core premise here with the Third Amendment. Maybe you could keep every household safe if you put a garrison of soldiers on site, but that's not why they would be there. They would inherently be there to intimidate, to coerce, to censor. And if the regime that implemented it was the most benevolent in the world, eventually human beings down the line would use it for its evil purposes. This system shouldn't be, it should be studied, and this bill doesn't prevent the study of it, but it shouldn't be designed or developed or tested. Allowing central banks to design and develop this is akin to in the Star Wars movies when the evil empire built the Death Star. As long as they promise not to turn it on. The trouble is, once they turn it on, they've got all the power that it yields to them. We shouldn't let our own central bank design it, test it, build it, and we certainly shouldn't let them implement it. If someday there is a need for us to do that, Congress could vote on it, and we should reserve our power over this incredibly dangerous system that would become an intermediary between every single person and their own property. Every dollar you make, every dollar that's given to you, every dollar that you spend or send to someone else would depend on a permissioned system where the government is the grantor of that permission. The right to transact predates any government. The government doesn't give you the ability to transact. And in our system of government, the government doesn't give us the rights protected by the Bill of Rights. It simply says the government will not infringe on them without cause and due process. Frankly, this is linked to the same concept I'm trying to protect with self-custody. Because the reality is when you give the government the power to regulate your ability to transact, someone will abuse it. And we've seen that abuse over and over again with agency after agency. This is a dangerous bill. Every dystopian fiction that you read, Brave New World, 1984, you pick them, they all depict money in a future that is corrupted. This is the means of corrupting the money. The book of Revelation, which I consider scripture as billions of people around the world do, depicts it as an evil system. And eventually, I believe it'll happen, but it's always depicted as evil, so we should resist it. We should all support this bill and maybe even stronger language in the future. The future of money really is the most important policy debate we're having today, and we have to be on the right side of it. I yield back.
Gentleman yields back. Seeks recognition. Mr. Sherman.
Mr. Chairman, I was here in this room some 412 hours ago when we began this markup. And I heard you very clear in talking about stablecoin when you said, if you don't want to use it, you don't have to use it. So if you like it, use it. If you don't like it, you don't use it. I would say the same thing about a central bank digital currency. If you don't like it, don't use it. there seems to be an apparent massive inconsistency here. We are told with every crypto bill, my God, China's going to do it. We have to keep up with the competition. We don't want to drive the crypto industry overseas. We've got to keep up with these other countries and what they're doing. And then when it comes to a central bank digital currency, we're told, my God, Europe is doing it, China's doing it. We can't possibly follow them. They're wrong. Don't do what the other countries are doing. Now, this appeared to be an inconsistency until I realized that both comments are absolutely true to the guiding principle, which is, if anything helps the crypto bros make billions, it's good, and if anything might compete with cryptocurrency, it must be stopped. Seen in that light, the policy of the crypto industry is very consistent. But they come to us and they say, crypto is going to help the unbanked. It's going to be electronic. It's going to be so convenient. It's not now. It's incredibly expensive to use. Imagine trying to buy a sandwich if all you owned was a Bitcoin. But here we have something that's going to be electronic and be what everybody wants, which is US dollars. And it is blocked. And again, that is not an inconsistency. It's true to their primary principle. If it doesn't make money for the crypto bros, it must be stopped, particularly if it competes against them. So we are told all the time, you got to vote for crypto if you believe in innovation. This is a bill solely for the purpose of blocking innovation. Then you look at how the bill is drafted, because I was just describing what the proponents are trying to do. And although they've added new language a little bit at the end of the bill, from the way they drafted it last time. This bill still, if you read it carefully, is a word salad of anti-government, pro-crypto buzzwords that would prohibit the Federal Reserve from doing anything with electricity. It takes us back to the 19th century. Today, if the Fed is going to buy $100 billion of Treasury bills from J.P. Morgan, they do it electronically. They are paying for those with a digital liability of the Federal Reserve. They're wiring them the money. Well, that's prohibited by this bill. Instead, you have to hire a fleet of Brinks trucks and pay for those the way you would do before there was any electricity at the Federal Reserve. I hope very much that the bill is interpreted, if God forbid it becomes law, the way the proponents describe it rather than the way they've written it. Now, we're told that because Canada froze the bank accounts of anti-vax truckers, I don't know if they did or not, we should have a payment system that makes it impossible for the American government to freeze the bank accounts of sex traffickers, convicted tax evaders, drug dealers, and charlatans of various types. I can only describe this bill as patriotic anarchism. Those who want a strong America while destroying the powers of the federal government to be strong in any way. So we have a bill here that makes it impossible for the Fed to come into the 21st century, because that might take profits away from the crypto bros. And earlier today, just 400 hours ago, we began discussion of a bill designed to help the crypto folks make money. So I look forward to working toward a better payment system that allows people to pay in dollars and to receive dollars, which is what they want to do. And if instead we have a bill that takes the Fed back to the 18th century. I yield back.
Gentleman yields back. Who seeks recognition? Chairman of the committee, Mr. Stile of Wisconsin. Strike the last word.
Thank you very much, Mr. Chairman. I support H.R. 1919. For several years, Whip Emmer has been at the forefront of championing legislation that safeguards the privacy and financial freedom of every American, and I commend Whip Emmer for his leadership in this regard. At its core, this bill sends a strong and unambiguous message. The federal government should have absolutely no role in developing or issuing a U.S. central bank digital currency that could be used to track, control, or monitor the financial lives of American citizens. The introduction of a U.S. CBDC would grant the U.S. government unprecedented access to Americans' most private financial details, from what they purchase to when, where, and potentially even why. This is a fundamental shift in the relationship between the government and its people, one that should be deeply concerning to all who value liberty. It's not a typical scenario. We've already witnessed dangerous consequences of China's digital yuan, which embodies surveillance tools and ties financial access to government compliance. That model is not only incompatible with our United States Constitution, but it's also a direct threat to our freedoms. Emmer's bill is a critical step in protecting that right, ensuring that unelected bureaucrats at the Federal Reserve impose a CBDC behind closed doors. This legislation, or it cannot impose, if not noted, there cannot impose a CBDC behind closed doors. This legislation affirms that any decision of such monumental consequence must go through the proper channel of Congress, full transparency, accountability of the American people. And let me be clear, the bill doesn't stifle innovation or halt the development of digital financial technologies, as was previously suggested. On the contrary, it's protecting America's rights to use digital assets freely without the looming threat of every transaction being monitored by the United States government. The American economy thrives on choice, thrives on competition, and on liberty, not on coercion and control. That's what is truly at stake here. Fortunately, the private sector is already leading the way in bringing the U.S. dollar into the digital age. From stablecoins to other innovative financial technologies that are thriving, to a U.S. CBDC that are rooted in free market, or alternatives to the U.S. CBDC that are rooted in free market principles. These innovations are transforming global finance, making payments faster, cheaper, and more accessible. They're also financial advancements Congress should support, not a tool for centralized control over money and individual behavior. So I encourage my colleagues to support the Anti-CBDC Surveillance Act. Send a clear message. The United States is going to lead in financial innovation, but we will not sacrifice individual liberty in the process. Thank you, Mr. Chairman. I yield back.
Gentleman yields back. Who seeks recognition on Mr. Emmer's ANS? Mr. Lynch, recognized to strike the last word.
Thank you very much, Mr. Chairman. Look, Mr. Sherman was correct when he said the reason that this bill is going forward to ban a central bank digital currency is because it would compete with private stablecoin issuers. There's a direct parallel to what we're going through right now and what happened after the Civil War. After the Civil War, when the United States faced its war debt, at that time there were probably 300 different currencies in circulation. Most of them script from big companies, railroads, hotels, individual states and state banks all generated their own form of currency. But once the greenback was passed, once the precursor to the dollar was passed, and Americans knew that they could trust that currency, all those other scripts, all those other currencies went to zero. They were out of circulation in a matter of a few years because trust was the thing. Trust. People trusted that their money was secure. Everybody had the same type of currency. The value was consistent across products. And that's why the dollar gained dominance in this country. What's happening right now is there's 200 stable coins out there of all different, the Dogecoin, you name it. If we allow the Federal Reserve Bank to develop a trusted digital currency, all those wacky stable coins will go to zero. And that's why this bill is on the floor, is going to the floor. It's to protect the stable coin issuers, plain and simple. The other thing that I want to put a lie to is there's talk about total surveillance. I got news for you. Allowing private industry and the private crypto market and people like Elon Musk and Zuckerberg to vacuum up all the personal information that Americans have, and they give them every day, and then giving them the power to issue a stable coin allows them the opportunity to target customers right down to their last purchase and know exactly what their living situation is. And here's the thing. Because of the third-party doctrine that is ingrained in our Constitution and it prevails right now and is supported by the Supreme Court, the government has direct access because the information you give to the private companies, these stablecoin companies, and Musk and the others, is no longer private. Because once you put your information out in public, it doesn't have the right to privacy attached to it. So once you put all your information out there in private hands, it is discoverable by the government. And they do it all the time. So that's a false premise that you're going to protect people by allowing them to give all their information to private companies, especially to digital platforms like X and Meta. The government in the past has seized information from Meta, seized information from individual platforms whenever it needed to. So the whole idea that you're protecting privacy is a facade. This is strictly to help the crypto bros and to eliminate any type of competition that the Federal Reserve might pose to that effort.
Would the gentleman yield?
I would.
The gentleman's point is completely invalidated if you protect self-custody, because the data doesn't go to the crypto bros or anyone else. If you've got self-custody, it is your data. So I would encourage the gentleman to vote yes on my bill to protect self-custody, which would be relevant for all transactions.
Reclaiming my time.
Yield back.
So every time you press I agree on your phone for an app, you're allowing them to vacuum up your information. If you ever took a moment to read the 600-page, cooperation agreement that most of these apps require you to
I would
click
encourage
yes
the
on.
gentleman to co-sponsor my It's Your Data Act or the Fourth Amendment.
Reclaiming my time. Reclaiming my time. It just puts the lie to everything that you're proposing here. It'd be nice if we protected the American people for a change instead of protecting crypto.
Gentleman yields back. Who seeks recognition? Seeing no further recognition, I'll recognize myself for 5 minutes. I rise in support of Majority Whip Emmer's bill, H.R. 1919, the Anti-CBDC Surveillance State Act. This committee strongly believes that any U.S. central bank digital currency must be authorized by Congress. The Constitution grants Congress the sole power to coin money, and this shall not be altered for a U.S. CBDC. Since the 117th Congress, committee Republicans have voiced significant concerns about a U.S. CBDC. Committee Republicans have published principles emphasizing a potential Fed-issued digital currency must maintain the dollar as the reserve currency and the preeminence of the U.S. payment system, not impede the ongoing development of stablecoins, promote private sector innovation and foster competition, and address privacy and security protections. After spending the past 2 Congresses examining a potential U.S. CBDC through the lens of these principles, I believe that many of the needed improvements in the U.S. payment system can be achieved through updates to the existing payments infrastructure and innovations led by the private sector. In fact, these improvements are already well underway. Payment stablecoins have seen explosive growth. Fintechs are offering custom, user-centric payment solutions, and artificial intelligence is being marshaled to improve fraud detection and prevention in real time. Pursuing a U.S. CBDC, on the other hand, would drastically change the structure of the U.S. financial system and alter how the Federal Reserve conducts monetary policy. Moreover, There's significant and concerning risk associated with a CBDC that cannot be ignored. A CBDC enables the government overreach and undermines the foundational liberties that make our country free. As member of Congress, we cannot allow this. That's why I'm pleased that we've the opportunity to advance the Anti-CBDC Surveillance State Act here tonight. I want to extend my sincere gratitude to the Majority Whip, Tom Emmer, his staff who've worked with my team for years, and several other members of this committee, certainly including Mr. Davidson, Mr. Ogles, and others, to ensure that we clarify any ambiguity around the Federal Reserve's existing authorities. By integrating ideas from many members' efforts, we've crafted safeguards to prevent the U.S. from replicating China's attempted surveillance state through its digital yuan, while still leaving room to innovate our payment system in a way that's aligned with American values. Because of this, I urge my colleagues to vote in favor of the Anti-CBDC Surveillance State Act. I yield back the balance of my time. Who else seeks recognition? Hearing none, we'll move to amendments. Does anyone wish to offer an amendment to Mr. Emmer's A&S? Hearing none, the question now occurs on the adoption of the amendment in the nature of a substitute offered by the gentleman from Minnesota, Mr. Emmer. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion chair, the ayes have it. The ayes have it, and the amendment is in the nature of a substitute is adopted. The question now occurs on ordering the bill 1919 as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. Those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. A recorded vote has been requested. Please raise your hand if you seek a recorded vote. A sufficient number having been raised, a recorded vote is so ordered pursuant to Section C5 of Rule 3 of the committee rules. A vote on this question is postponed. Pursuant to notice, I call up H.R. 478, the Promoting New Bank Formation Act, introduced by the gentleman from Kentucky, Mr. Barr, the chairman of our Financial Institutions Subcommittee. The clerk will report the bill.
H.R. 478, to require the appropriate federal banking agencies to establish a 3-year phase-in period for the de novo financial institutions to comply with federal capital standards to provide relief for de novo rural community banks and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. For what purpose does the gentleman from Kentucky seek recognition?
I move to strike the last word.
Does the gentleman have an amendment at the desk?
Yes, I do have an amendment in the nature of substitute.
That was distributed in advance. The clerk will report the amendment.
An amendment in the nature of a substitute to H.R. 478, offered by Mr. Barr of Kentucky.
Without objection, the amendment in the nature of a substitute is considered read and will serve as the base text for purposes of an amendment. The chairman of the Financial Institutions Subcommittee is now recognized for 5 minutes to describe his amendment.
Thank you, Mr. Chairman, and thank you for your Making Community Banks Great Again agenda, for your leadership on advocacy for community banks, and for including this legislation in today's markup. Community banks, as I think members on both sides of the aisle would agree, are the lifeblood of Main Street America and the backbone of the U.S. economy. However, an almost complete halt of de novo bank formation, along with consolidation stemming from increased compliance costs, ballooning capital requirements, and banking regulators' negative posture on healthy mergers and acquisitions, has led to an increase in banking deserts in the United States, especially in rural areas. Only 60 new banks have been chartered in the past decade. In contrast, more than 2,000 new banks were formed from 1990 to 2008. Shockingly, from 2002 to 2022, the number of FDIC-insured banks declined by nearly half. These concerning statistics largely stem from burdensome regulations that make it nearly impossible to form a de novo bank. That's why I introduced the Promoting Access to Capital Act, which takes steps to do exactly that by providing flexibility to promote de novo formation. I've reintroduced the bill as the Promoting New Bank Formation Act. This legislation provides for a 3-year phase-in period for de novo financial institutions to meet federal capital requirements. It lowers the community bank leverage ratio, or the CBLR, for rural community banks to 8.0% from 9.0% during the first 3 years of operations. It requires the federal banking agencies to promulgate rules setting the CBLR lower for the first 2 years of operation to allow for a phase-in period. It removes some restrictions to allow federal savings associations to make agricultural loans, and it requires the federal banking agencies to conduct a joint study on trends in de novo financial institutions. Banking deserts lead to many Americans being kept out of the banking system, harming their financial well-being and ability to achieve economic prosperity. Small financial institutions serve the most small businesses in the country and families in local communities. We must foster an environment where these institutions can form, restoring dynamism and competition in the U.S. banking system. My colleagues on both sides of the aisle have recognized in the past how important small community financial institutions are for our communities and our economy. To promote their creation and longevity, I urge my colleagues to support this legislation. And I would note in conclusion that members of both sides of the aisle of this committee have talked a lot about their support for community banks, for community financial institutions. I would submit that financial stability is served by the diversity of our banking sector. And when you have a lack of small bank, new bank formation, and you have more concentration in larger banks, and you don't have the counterweight of a vibrant, dynamic community bank ecosystem, that creates systemic risk. That fosters the too-big-to-fail bank dominance that people talk about. If members are concerned about systemic risk, if they're concerned about too big to fail, if they're concerned about a lack of diversity within the banking sector, then I submit this is the solution. Help us alleviate the regulatory barriers, the barriers to entry for new bank formation so that we can have that diverse, dynamic community bank ecosystem that will serve as a counterweight to large banks, systemic banks. This is the way to get new business formation rolling in this country and deal with financial inclusion needs of our communities. With that, I yield back.
The gentleman yields back. Who seeks recognition? Mr. Lynch, recognized to strike the last word.
Thank you. It's ironic, and I think it's counterintuitive to, on the one hand, support a stablecoin bill that creates more favorable conditions and in a more permissive regulatory scheme that will compete unfairly with small community banks, and then in the next breath say how we need to protect community banks. The more than just diversity of banks, I think what our community banks suffer from is lack of a level playing field. Lack of a level playing field. They've faced competition from fintech platforms, and now they'll face competition from stable coin issuers and others that will have a more permissive regulatory environment to operate in. And as a result, I think these smaller banks will find it harder to compete. I wish your theory was sound, and because I do agree. You know, in my towns, like in a lot of towns in America, it's that local community bank that's contributing to Little League and you know, the local efforts. And if somebody's house burns down, you know, it's always that local bank that's out there trying to help families out. And with fintech, which was, you know, sort of nose under the tent, it became less personal. You know, people started, you know, especially this younger generation. I don't blame them. You know, it's just the way they grew up. But you know, my two girls, I think, have been to the bank twice for spring break so they could get traveler's checks. That's about it. Everything else they do on you know, electronic platforms right off their phone. That you know, they say that's progress. But I worry about the same institutions that the gentleman from Kentucky worries about. I understand, you know, I've lived at times in farming communities. I know how important that is for our farmers, especially small farmers. But I do believe in the previous act, we did damage to the chances of those smaller banks surviving. And while, you know, I'll probably vote for this bill, for your bill, and you know, hope for the best. But I do think we're also doing some things here that are detrimental to the survival of these small banks and the creation of new banks that you'd like to accomplish. So that's all I got to say. I'll yield back. Thank you.
Gentleman from Massachusetts yields back. Who seeks recognition? Mr. Green of Texas, you seek recognition? No. We're still on the basis. Ranking member on the base text.
Thank you very much. We all support community banks and would like to see more new banks form, or what we call de novo banks. Unfortunately, instead of working with Democrats on how best to support the creation of new banks, Representative Barr is offering his partisan bill once again that focuses only on deregulation. The research suggests that the number of new banks formed every year is impacted much more by broader economic dynamics than regulatory hurdles. For example, a Fed study showed that the number of new banks is strongly correlated to the Fed funds rate and interest rates in general. Moreover, an FDIC study concluded that most de novo banks do not fail during their early years if they have higher capital relative to established banks, but they fail more frequently when they don't. Instead of promoting safety and soundness to ensure new banks can thrive, this bill will actually lower capital requirements for de novo banks, phasing those in for the first 3 years. This approach raises safety and soundness concerns, and at the end of the day, it's not even clear that this approach would actually result in more new banks. While the bill focuses on new banks, I would further note the bill does nothing to support the creation of new credit unions. Of course, we're having this debate after President Trump's regulators are shrinking their examiner workforce, and after Trump put a target on the back of community development financial institutions, that's CDFIs. I don't know why he's seeking to minimize their work despite the strong support Republicans and Democrats have provided to CDFIs over the years, including $12 billion in capital and grants we provided during Trump's first term. We should be working together to ensure the administration doesn't clip the wings of CDFIs and work to create new CDFI banks and credit unions instead of deregulating and setting banks up there. Let me just say this. First of all, we've had bipartisan support on community banks and CDFIs, and what we talked about during COVID when we got the extra money after the big banks had created their own portals and took care of their concierge clients. We worked together, and the small banks and the credit unions all got new capital by which they could make available to small businesses. Now, I support the idea of expanding community banks. I do believe that they relate to the community. These relationships help them to understand the community better, and I believe that's good for everybody. But if you are really serious about expanding these banks, one of the things you would not do is put them in jeopardy by not making sure they have enough capital. And CDFIs, I don't know why Trump is have them under attack. I think this is another way that he thinks he's getting at diversity, equity, and inclusion, which is outrageous. I would work with you on expanding. Mr. Barr, listen to me. Don't be talking to him while I'm talking to you. Okay.